That South Africa has myriad problems on all fronts, I think, is a given. Criticism, grandstanding, and point scoring really is a national sport. Noise is, though, the essence of democracy. But the time has also come for us to collegially and with level heads start to look for real solutions from all sectors of society. And that is the idea, the premise behind Moneyweb's new podcast series. It's called Fix SA. I'm Jeremy Maggs, and I've been in the business of talking to and interviewing people for years and years. And this podcast is going to offer tough conversations around South Africa's national problems, spanning service delivery, governance, social cohesion, and the economy, and a whole lot more. But here's the difference. Our intention is to interrogate creative ideas and workable solutions on how South Africans can navigate and ultimately solve problems, drawing on the insights of South Africa's top business leaders. Starting in early November, you can download episodes every second Friday on moneyweb.co.za, the Moneyweb App, Apple Podcasts and Spotify, or follow Moneyweb News on social media for more updates. I'm really looking forward to you being part of Fix SA. Moneyweb, your trusted source for business and investment insights.
The Moneyweb Frequently Asked Questions series. Part 1, all about shares.
Hello, I'm Simon Brown. Welcome to part 1 of Moneyweb's FAQ video series. In this series, we're going to give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I'll take you through all you need to know about shares and more. The most popular question, what are shares? Shares are listed slices of a company. Each share gives you the right to a share in the profit and a vote at the annual general meeting. They trade in an exchange, such as the JSE, whereby investors can buy and sell. Another popular question, why do shares exist and how do they work? In order for a company to raise money rather than a loan, they sell part of the company to new shareholders who essentially give the company a permanent loan. What are the different ways I can buy and sell shares? You buy them through a stockbroker or within a fund, such as a unit trust, an exchange-traded fund, or a pension scheme. Will I be taxed on my shares? If you make a profit, you will indeed be taxed, but only when you sell. Dividends, your slice of those profits every 6 months or year, will be taxed at a flat 20%. In the next video, I will highlight important information to consider before investing. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
Good morning and welcome to the second Moneyweb Better Investor Conference. My name is Ryk van Niekerk, I'm the editor of Moneyweb, and today we're going to talk everything about investments. Of course, everyone wants to build wealth, they want to retire well, and hopefully this conference will give you a few golden nuggets to make that process easier and most definitely more profitable. We've got many sessions today and they all focus on different aspects of investments. The first one is building a share portfolio for generational wealth. Now, many people want to invest for retirement, but there are also people who would like to leave a financial legacy for their generations to come. And I think that is one of the topics that will elicit a lot of responses, because in today's age, leaving a financial legacy is most definitely something many people want to do. The second session, we will look at stockbroking and how to get started. Many people ask me, how do I get started in the investment market? Now, obviously, the first thing is you need to start as early as possible. And this session will look at the mechanics of how you actually get started. How do you approach a stockbroker? And then also how to pick your first few shares. Then become a better investor. Now, that's what everybody wants to do. You want to really be successful. You want to beat inflation. And this session will look at what the markets are currently offering and how successful to construct a portfolio. Then we will look at investing offshore for returns and residency benefits. Many people not only want to build wealth offshore, but they also would like to get other benefits like residency. There are several products and opportunities available, and that session will ventilate those options. Then a technical session, and that is for people who have built a really significant investment portfolio. Should a person invest in their own personal name or through another structure like a trust, a company, or a derivative structure? Very interesting session that. Then we also look at cryptocurrencies. We get a lot of questions at Moneyweb about cryptocurrency. Is it an investment? Is it an asset class? How much should you invest in that asset class? What type of cryptocurrencies do you need to invest in? So a comprehensive portfolio of sessions we will have today, but we would like to hear from the audience. Please send your questions to events@moneyweb.co.za. Questions, comments, and the like. You can also type in questions on the YouTube channel, there on the chat box, and you can also follow us on social media. If you want to tweet some of the information you find very valuable, please use the hashtag BetterInvestor, and also keep up to date throughout the day. The sessions will also be posted on Moneyweb after the conference, so if you need to slip out today, you can actually watch them later. So welcome to this conference, and I hope you learn a lot. I am certainly looking forward to it, so let's get started. Welcome to the first session we have today at the Better Investor Conference, and we're going to look at building a share portfolio for generational wealth. Now, everybody wants to leave a legacy for their loved ones and the generations to come, and we will unpack the opportunities, the things to do and when to do it to build that portfolio, and we will focus on an equity portfolio. And with me is Renier de Bruin. He's a senior investment analyst at Sanlam Private Wealth, and he joined Sanlam Private Wealth in 2010 as an equity analyst, and he has been co-managing the multi-asset portfolios with the Director of Investments since last year. He's a CFA charter holder. He has an advanced postgraduate diploma in financial planning from the University of the Free State. He acquired that cum laude. He also has a BCom Honours in Financial Planning, cum laude. Renier, thank you so much for joining us today. Let's just set the scene. Many people would look at a portfolio for long-term investments, and I think the key question is just what is the difference between building a portfolio for your retirement so that you can retire comfortably and building a portfolio for generational wealth? Are there key differences between the two?
Good morning, Ray. Good morning, everyone. Thank you very much for this opportunity. So, yeah, let's distinguish between a portfolio for generational wealth and one for income for retirement. So, I think the first big difference is that if we talk about generational wealth, that really is referring to your assets that are in excess of those that is needed to fund your retirement. So we're really focusing on long-term capital growth here, while if you compare that to a portfolio for retirement, that is much more income focused, where you need to draw income over the shorter period. So the mix of assets will change then. For a income portfolio for retirement, you would focus a lot more on fixed interest, while if we're thinking about generational wealth, we're thinking about the assets that will produce the best return over the long term in terms of capital growth.
So there's most definitely a much longer term investment horizon. So how do you approach it? When do you decide, listen, let's start with this, and what are the key things you need to consider?
So I think firstly, let's think about which assets do well over the long term. So I think if I can go into maybe the first slide. I mean, if we think about, so the normal, when we think about portfolio construction, we first think about what is your objectives, what is your time horizon. So in this case, thinking about generational wealth, we're thinking of a very, very long time horizon, certainly one that surpasses your own life expectancy, so that you can pass on sizable assets to your heirs, who will then be in a position to use that to their own benefit, whether that is to start their own business, fund retirement, fund a property, pay for education, that sort of thing. So so focus on the long term. Then we also have to think about when we construct a portfolio, what is your focus on risk or your toleration of risk. Now, I think there's a clear distinction if we start thinking very long term how we should think about risk, because normally we think about risk as the certainty and the volatility of returns. So, for example, if we think about something like the money market, that is a very predictable, safe return that one can get. But then you can think about equities, which actually do better over the long term. But that is at the cost of more uncertainty over the short term, because in the shorter time frame, the returns you can get from the share market is a lot more uncertain and volatile, as opposed to, let's call it, safer investments from a volatility point of view. However, if we start thinking long term, I think you have to start thinking differently about risk, because your risk is not as much about volatility, because you will be able to ride, you have to be able to ride through the inevitable volatility that the market will provide. Your long-term risk is more about the impact of inflation over time. So if you just think about 1960, if you had 100,000 Rand then, 60 years later, that is just in terms of impact of inflation, what you could have bought with 100,000 in 1960 now need 10.6 million Rand. So over time, your real enemy is actually inflation. That's the primary risk. It's not volatility of returns. Secondly, your other long-term risk is investing in assets that are not.
Well, it's quite clear that equities have outperformed the other asset classes significantly, but I'm sure that the dividends play a significant role. That income you receive during the period and the accumulated profits you make, and that has a significant impact. How big is the impact of the dividends on the total performance, especially looking at that graph, because it looks really, really, really significant?
Yeah, so on this chart, you can see that if you invested 100,000 in 1960 and you invested that in, say, the money market, you see that you had a very predictable, steady return, and that 100,000 would have grown into 34 million Rand. But I'll just remember the impact of inflation, which would be worth then 10.6 million. So basically, if you invested in money market, a very comfortable, smooth ride. But over this little bit more than 60 years, your wealth would have increased about three times in real terms. However, if you put it in the equity market, that 100,000 would have grown to 1.2 billion Rand, which in real terms, so that is if you remove the impact of inflation, your wealth would have increased about 120 times. But very interesting enough, this is if you include your dividends. If you exclude dividends and you basically just did not reinvest your dividend, your return would have been actually less than what you see here in the gold price. So that but if you look at the own market, your dividend yield would have been on average around 4%. And that 4%, if you just that incremental return, if you compound that over a very long period, that becomes a very, very important part of your total return eventually.
But that makes a massive difference. There's a big difference between 1.2 billion and, if I heard you correctly, a return if you didn't invest dividends of less than what the gold price appreciated with. So that must be one of the key focus areas.
Yes, yeah, so, right. So that just shows you the importance of dividends and reinvesting that over time. And once again, I mean, you can invest in companies that grow over time and pay less dividends. I mean, Naspers is a good example. And then you have got other companies, say, for example, like the banks, where the growth is lower, but you actually get quite a good dividend yield. I mean, if you just look at our banks, for example, I mean, it's difficult to really get excited about them. But just if you just look at any given period and you see how much of that total return that you receive is actually through dividends. You know, the banks have done remarkably well relative to the market on a total return basis, while the returns don't always look that great, just if you look at the share performance themselves. So certainly something you should not be neglecting. And once again, if you think about constructing a good share portfolio over the long term, one of the key ingredients, and I think we'll talk about that a little bit later, is to focus on companies that are very highly cash generative. And if you can pay a good dividend, that's usually a sign that the company is cash generative. And as we've shown here, that becomes a very important part of your return, especially over the long periods.
But looking at that graph, it shows you that volatility, short-term volatility, does not really have an impact. And I would assume the longer the investment period, the less impact volatility has on the total performance. I know you've got a new slide or another slide showing that, and it's actually quite, evident that risk and volatility reduces over time.
Yeah, so that brings me back to the point I've made earlier, is that, I mean, if you often have people coming to me and asking me, they've got, say, saved up a deposit for a house and they want to buy this house in 1 year's time. Should they invest it in the stock market and try to increase the value of their deposit? And my answer usually is, I don't know, and I wouldn't recommend that, because if you think about what the market can do over any particular 1 year period. So this is just the range of returns of our market since 1960. So your worst return over any 12-month period was minus 48%, and you certainly don't want to have that kind of return if you just save a deposit and see that value erode by half over one period. And on the top end, you could have received 125%. So from this point of view, it's a risky asset class from a volatility point of view. But once again, if you start thinking longer term, and certainly when we're thinking about generational wealth, that means we start thinking about time horizons in excess of 20 years. And you can see how the range of outcomes, so this is return, including dividends per annum, actually narrows over time. So if we define risk according to volatility, that risk actually reduces over time. And you can see the worst return you received out of the JSE All Share Index was 12% per annum over the last 20 years, and the best 26%. So the worst return would have outperformed the other asset classes. And that is why, if you start thinking long term, really equities become your best bet. However, that is if you have invested in the index.
Just can I ask you to go back to the previous slide, because there is a silent killer, and that is inflation. Do you have any indication of the net returns after inflation, or the real returns, and how the equity market outperformed inflation?
Yes, so in this particular chart, we've assumed you had 100,000 invested in 1960. That 100,000 adjusted for inflation today would have been 10 million rand. So that is, you can make the comparison. So if you think about the money market index, you have 34 million rand now. If you invested 100,000, but inflation is worth 10 million rand. So that means you've got basically 3 times inflation. That is the increase in your real value that you can buy with your assets. And you can see that big difference if you actually invested in equity markets. just materially. So even though this return in the money market looks very interesting, moving from 100,000 to 34 million rand, your real increase in wealth is not nearly as much because of inflation taking away so much of your returns. That is why we said, like, over the long term, volatility is not really the big risk. It is things like investing in assets that don't perform well, and then also the impact of inflation. However, investors should understand that if you take this high, where we see that equities over a long period has consistently outperformed, it does come with more, let's call it, it will test your nerves. Because there were times, like I've showed in the next slide, that the market comes down by 48% in 12 months period. And that is often where investors who had a plan with equities fall by the wayside because they simply can't stomach that volatility. And often then they sell at the wrong time. And that becomes material destruction to your wealth over long terms. So I think, once again, if you invest in equities for the reasons of building long-term wealth as the preferred asset class, you must be prepared more emotionally than anything else to be able to suffer those drawdowns and still believe in that case for equities.
Most financial advisors will tell you, listen, diversification, diversification, diversification for any investment portfolio. Now, looking at that graph, it seems like, you know, I would like to have all my money in equities. Of course, you can diversify within an equity portfolio, but do you think building a portfolio for generational wealth would then guide you to invest much more in equities than, say, in a portfolio for retirement?
Yes, absolutely. So once again, the first few charts that we've spoken about, that refers to the market in general. And obviously, if you build a portfolio, I mean, you have basically two options. You can buy the market, that's quite easy to do. So you can buy the index, and the cost of that is coming down all the time. So it's quite an efficient way to invest the market with one share, like a listed ETF. Or you can actually try to pick the shares yourself. Now, I think if I just talk to this slide that's currently on it, and what I've done here is I've just looked at the last 10 years, and I look at all the shares, all the companies that was included at any particular point during the past 10 years in the index, and look at what the total return was for that share over the last 10 years. And I didn't put the names down here because it would be a little bit too messy. But you can see what I've also done here is I've shown you the return of the all shares. So over the last 10 years, your total cumulative return for the market, South African market, was 153%. And now you can compare that all the companies inside our market, what their returns were over the last 10 years. And you can see the best return here, which was Capitec, that had a return of 1,100% over the last 10 years. But then you can also see there's quite a big tail of companies that firstly did worse than the market, and that was the majority of companies underperformed the market. And you can see there was quite a big portion, probably around 40% of the market, that gave you a negative return. And you can see even here there were a bunch of companies that almost where you lost all your capital. So once again, if you picked the wrong shares, and that could have been quite easily, because if you randomly picked, you had a 75 or at least 75% chance of picking shares that did worse than the market, you could easily do worse. So just to say equities outperform over time doesn't mean all equities outperform over time. And if you didn't have some of these big winners that basically drove all the returns of the market, your returns would have looked much different. So I think, and this is just over the last 10 years for the South African market, but if you do the same exercise for different markets or different time periods, you get the same answer. It's usually a very small percentage of the companies that drives all the returns of the market over a particular time period. So the question is, how do you make sure that you've got the winners and not the losers? And I don't think it's that easy, because I think if we maybe talk to some of the winners and losers on this chart and see, what are the lessons that we can learn here in terms of what are the common characteristics of the winners and what are the common characteristics of the losers. So let's start about, okay, so if we say, okay, we don't want to be passive, and remember, I think this chart actually makes a big case for passive investments, because especially if you are a private individual investor who doesn't have full-time ability or to really to analyze every company in detail, investing in the index is a sure way. Even though if you invest in the index, you'll end up with quite a long tail of investments that don't do great, but at least you are certain to have these big winners. And if you have a company that does 10 times your return, then you can have quite a few companies actually where you lose money. So if you had Capitec and you had Steinhoff in equal amounts, you still have had a good return, even though you had to write off one of the assets over time. So you have to have those winners. But I think if we say, okay, I don't want to be average, I want to be an active investor, let's see how we can at least try to avoid the losers. So there's two common characteristics in the losers here. The one is leverage. So if you think of companies like into properties, which basically got delisted, you had something like Steinhoff, you had Bright, companies where you lost more than 90% of your money. There were different reasons. In Steinhoff, there was accounting fraud. Some of the other businesses perhaps made one or two poor acquisitions. However, the thing that really resulted in this massive drawdown was the fact that there was leverage on the balance sheet, so a lot of debt, and eventually they couldn't service that debt, and then when you get into that position, you're either a forced seller at bad prices, or the creditors really take over the company at the expense of the shareholders. So once again, and then if you look at the companies that were the big winners, almost none of them had high levels of debt. So they didn't require debt to get their returns. It was really about operational excellence. And the other sort of common characteristics of companies where you've lost money over time were often companies that had good reputations, they were performing well, but the share just became too expensive. And after that, it resulted in poor returns. Things like Acura or a company like Aspen, which over a very long period captured the imagination of investors because of strong operational performance as well as share performance. But since then, because you're starting from a very expensive base, your subsequent returns become quite poor. So the big lessons to learn up when you do your own stock picking: firstly, avoid companies with too much debt, and do not overpay for companies. And once again, if you look at the market, there are always these two big emotional drivers. Let's call it biases that investors have, and usually that it accumulates, or it builds on itself, and that is fear and greed. So greed, we saw that like say in the crypto space all over.
Can I interrupt you there,
yes,
Neer,
sure.
because I want to go back to this chart because it's very, very interesting. If it was that easy to pick winners, looking at debt levels and the relative PE ratios to indicate whether they are expensive or not, most professional fund managers also don't beat the index. And it is very, very difficult to do. So the question arises, so if you do pick a winner, how long do you hold it? And how do you take your churn decisions and switching out of certain shares and going into others? Do you approach that differently with a portfolio to build generational wealth? Do you hold on longer onto those shares? Or how should you look at it?
I think that's a great question, because if I look at our own client base, so when we look at our own client base, you've got the two groups. The one where we manage the client's money with our own decisions, we call that discretionary managed portfolios, and then we've got a group of clients who do their own trading, and we basically just act as a stockbroker. And if we look at the sort of the clients that do their own thing, and unfortunately it's a small percentage that really outperforms the market, but generally those who do really well and they've built, let's call it generational wealth, were usually those that had that one company for 20 or 30 or 40 years that just compounded and did very well, and eventually became 80 or 70% of their portfolio. So very undiversified portfolio, which an active manager wouldn't want to own it in such a way. But yeah, I mean, those are the Capitec's, the Naspers, the old Rembrandt group of companies. Investors who stayed with those companies over a very long period did very well. But once again, I mean, for every one of those success stories, there were multiples that amount of companies over time that did not outperform. So maybe those were the outliers. But getting back to your question, when you sell a winning company, so I think I would actually think about differentiate it in two groups. So if we look at the South African market, we are, at least in international terms, have quite a cyclical market. So we've got a lot of mining companies, we've got a lot of financials, for example. And those companies may not necessarily do that well over the long term, but there are up and down cycles. And that is where we as active manager focused a lot of our attention to sort of try to have the companies at the right point in the cycle. So even though the company may underperform over time, they can do well in a particular cycle, and then you can outperform during that time. So if we have a company that's sort of more mature and cyclical, I would say if you have a valuation on the company, that is where we focus, and you get to that valuation, you should sell it. Okay. Yeah. Don't try to bet on it, keep on going higher and higher. Maintain valuation discipline. But I think often you have those companies that are more structural growth. So they might be still a little bit small, but there's a lot of market runway for them. The two examples of the strong outperforming companies in this group was Clicks and it was Capitec. And they both had relative decent market shares, but they were so good in their particular market, and they would just keep on growing their market share. And even though those companies looked expensive in traditional measures for a long period, if you sold them, you would have sold them to it. So let's distinguish between those two companies. A mature company, you sell when you get a decent price and you've made your money. I think when you have a structural growth company with clear market share runway, I think keep that a little bit long.
Yeah. Maybe it's age, but can I ask that the questions, and I see they are coming in, and please keep them coming, events at moneyweb.co.za. Email us your questions or post it in the chat box on the YouTube channel. I will put them to Renier. Renier, many people will tell you the investment universe is really not limited to South Africa. If you sit on Mars and you look at South Africa or the world and you want to invest, a very small portion of that investment will be in South Africa. So from the perspective of building this long-term financial legacy you want to leave, how should you look at geographical diversification?
Okay, that's a great question. So maybe just to put it in context, I've got a slide here that shows you the relative size of the market, and that is our home ground, and that is the companies we know and love. But it's important always to understand perspective. If we just look at the JSE and we look at the free float market cap, so those are the freely trading shares, in billions of dollars, we've got around $880 billion of tradable shares. That is only 1.2% of the tradable shares out there in the world. So once again, if you just define yourself to the South African market, I think you lose out on a lot of opportunities out there. And I think also if we think about the South African market, on the next slide, I just showed you the makeup of our market. So we've got you can see here our own market versus the MSCI World, so that's developed market equities. You can see we've got 38% of our market is in the mining sector or in the resources sector, versus the world is only 8%. So we are materially overexposed to the mining sector, and we know that the mining sector, even though it's gone through a few years of strong outperformance, we know that it's a very deep cyclical, very cyclical industries. So if you invest in most of your money in the all share, just understand that your fortunes are a lot more tied to specifically what happens in the resources sector. And then if you compare, say, to some of the more what we traditionally call defensive sectors, so like the consumer defensive, you can see that we are the lower weight, and certainly in healthcare, where a lot of the new innovation globally is happening. Unfortunately, we've got a very small weight in healthcare versus a much larger weight in the world. And also the other big difference, if you think about the fourth industrial revolution, we've got your traditional old economy businesses such as mining, such as financials. We have a very big weight there in the South African market. But if you think about the new generation technology business, there we actually have a big shortage of companies. It's only really Naspers and Process that operates in that space. So just once again, just an argument to think more globally when you think about. Obviously, if you invest globally, I think you must make make sure of the structure you invest in, because it brings other technicalities. But I think one of the panelists will address that issue later today.
Of course, as you've said, we see many cycles. Resources, for example, in South Africa, they performed very poorly for about a decade, and then suddenly there was a surge, and it really performed well. We've seen it in the technology sector in the US. Of course, there's some pressure on many of those big companies currently. But should you try and time cycles? I know timing is a swear word within the investment world, but how should you work that into a strategy?
Yeah, I think it's very difficult to get timing right. Obviously we as active managers do a lot of effort in trying to understand what we call the market cycle, and trying to be in the specific sectors at the right time in the cycle. We know that we will not get it right, but if you get it 60% right, I think you can add value. And I think if you look at the South African market, you have no choice but to sort of try to understand and play the cycle a little bit more, because we know that resources generally are not a structural outperforming sector over the long term. So you're probably not going to beat global equities over long term, and resources certainly haven't done that. Over the short term they have, so they have these cycles when they do phenomenally well. So I think sort of the approach that we have in our business is to sort of be a little bit counter-cyclical. So you should sort of understand, where we are on the cycle, whether, say, commodity prices are high or low. If they are low, then we would try to invest more in the sector, and if the prices are high, we'll try to reduce our weighting in that sector. So we have to play that game in the South African market. Often, if you look at global managers, they don't really do that, because the universe is much different. So they can invest more in these, let's call it boring quality compounders over time, where you actually get good returns over the long period. But that is a different game.
Well, that brings the question, are there more defensive sectors? And obviously there are many volatile sectors. How do you balance that long-term portfolio? How much do you allocate towards a more defensive sector, maybe like property, as opposed to something like technology and resources?
Yeah, so I think when you build a portfolio, you have to have a few principles. Once again, I think they say diversification is your only free lunch in investments. The fact is, like most people, no one can really forecast the future with accuracy. Everyone tries, and we always listen to gurus and people trying to, explain to us what is going to happen around the corner. But if you look at track records, no one really in this world has been able to consistently predict market cycles over time. You know, they were the one or two that were lucky, and then they became gurus overnight, and people started giving them too much attention. So, having said that, I think that is the case why you need to have diversification. And often my view is that, you know, if you have a diversified portfolio, but once again, diversification means not only, you know, between, say, bonds and equities. It means within equities, you need to have exposure to different sectors. And also to different geographies, because you don't know, you know, for example, we had this Russian invasion. So everything that you had in Russia became worthless overnight. And you don't want that. So you have to spread your assets over time. But when you buy assets, I think with every asset, you can make sure that the fundamentals are in place, that the valuation that you pay are appropriate. And that over time, all those assets should do well for you. However, they will not necessarily perform during the same environment. And once again, say, for example, you have some more defensive kind of businesses in your portfolio, and the world goes into a very difficult time period. We know that defensive shares will outperform you during that time, and then you can actually sell those shares and buy the other, let's call it more cyclical shares, when you're in a crisis period, because those things will become will sell down more, and because you have a diversified portfolio, that will actually allow you to capitalize on the market opportunities over time, and then you can outperform the market. But you need to have the currency, so you need to have assets that will hold up your portfolio in difficult times, and not only to make your portfolio more resilient, but actually to give you the war chest to capitalize on the opportunities. And a lot of people build wealth over time. You usually see the rich people, they enhance their wealth when the world goes through difficult times, because they're the ones who capitalize on the opportunities.
Can I ask that I get the questions here on the big screen? As I've said, age is a cruel thing. But a question from Sean. Life still happens when building generational wealth. So do you ring fence certain assets with shorter time frames, or do all assets sit in equity, long only?
Yeah, I think that's a great question. So I would say that the one thing with equities is that we know the bus is going somewhere, okay? But we don't know the journey. But you as an investor always want to make sure that you can choose where you want to get off at that bus. You don't want to get off at the bus at the wrong place. So with equities, when you invest in equities, you have to have a mindset that you can stay there for long term, and you don't want any life event to force you to sell equities at the wrong time in the cycle, because then you will destroy all the relative impact or relative benefit that equities have over time. So I would say that if you think that there might be any withdrawals, you should not keep that into equities. You should keep that into fixed interest, where you've got predictable income. So for example, your emergency fund that you have, which I think most people should have, or at least, maybe you've got a home loan, you just have maybe you pay your home loan down a little bit faster, and then you can access that equity, for that, as opposed to putting that in equities and being a forced seller at the wrong time.
Another question is about the exchange rate. Of course, the rand is very, very volatile. It has been one of the most volatile currencies in the world for many, many years. So how should you look at the investment currency, and how important is that in formulating the strategy?
Yeah, so that is very important. So you have to, when you invest, you have to think about what currency you're going to measure yourself in. And that currency should really be where you're going to spend your money going forward. So if you plan on immigrating, then you have to start thinking in the currency of the country you're going to immigrate, and make sure that your assets perform according to that currency. If you're a South African investor and you plan to spend your retirement here, you have to think of your returns in terms of rand returns. But I think there we actually have a great benefit in terms of just how the rand operates. because it allows you to mix your assets globally in quite an efficient way. If I maybe can elaborate on that. So if, for example, usually when the world goes into a tough period, what traditionally happens is the rand weakens. If the rand weakens and you hold offshore assets, the weaker rand actually safeguards your portfolio in that regard, because the weaker rand leads to higher returns on your offshore assets. So that is a great benefit. Obviously, in the good times, the rand tends to strengthen, and then you want to have, say, South African bonds, South African banks, retailers, that sort of thing, would do very well then over time. So I think you can play the balance, and the rand plays an important shock absorber, really, in tough times. But to get the benefit of that, you have to have offshore assets. But once again, I mean, to be honest, if you think about, even if you invest in the JSE All Share Index, I think the last calculation we did is that 70% of the revenue is actually offshore, non-rand earnings or non-rand revenues for the market. So even the all share is already quite a big rand hedge, or carries a lot of rand hedge benefit for us. So I think the typical South African investor, when they invest in local equities as well as global equities and other assets globally, it's got quite a good diversification, and I think the rand is actually a benefit in terms of smoothing out returns over time.
Let's talk about risk, because I think many investors they can't marry return and risk. In many cases, people take too much risk, and in many cases, too little risk. So how do you marry the two, especially within this long-term investment horizon, which forms part of the strategy?
I like that question a lot, because the one thing you said is, like, some people take too little risk. And that is, as I said, over the long term, what is risk? Risk is not volatility over the long term. Risk is inflation and poor performing assets. So once again, if you want to minimize long-term risk, you have to minimize two things. You have to make sure you beat inflation, and thereof, not every asset does that. And you need to have, let's call it, more perceived higher risk assets like equities, like property, which outperform inflation over the long period, but comes at the expense of shorter term volatility. So that is the one thing. So I think that your question is really, how do you define what is the appropriate risk to take? I think I would sort of approach it in a way that, let's break up your investment horizon into shorter pieces. So what is your 1 year investment horizon? So those are the assets that is for emergency fund, or the income that you need out of your assets over the next year. And then how is it over 2, 5, 10 years, 20 years, 30 years, 50 years? And then really, if you start thinking about the assets that are earmarked for, say, periods longer than 10 years, the majority of that should be in equities, because that equities, and when I call equities, remember diversified equities, because you can be in the wrong equities as well. But equities, because your risk that you want to beat over long term is inflation. But over the short term, your risk is absolutely different. It is what the markets will do over a short period, when equities are a lot more unpredictable. So then your risk that you manage is volatility, and there you need to have safer investments. So for shorter term investment horizon, have fixed interest and money market, longer term property and equity.
Then many investors can't do this on their own. They need an advisor, an asset manager who walks this journey with them. But in many cases, picking the right asset manager is a challenge. So how do you think people should consider which advisor and asset manager to use to achieve the best results?
Also a good question. So I always like diversity. So I would spread my assets across good asset managers. I often see, unfortunately, investors and sometimes the advisors, hopefully to a lesser degree, makes a lot of mistakes along the way. So you might start with a very good plan, but so many people get sucked into the past winners, and often say a particular manager has outperformed or performed well, and another one, which is probably also a good manager, had very poor performance. But they might have different styles or different focus areas, and the market environment was just more supportive for the one and the other one. And then often the mistake is that people think now, because this one had good performance, he's a better manager. And then they sell the poor performer one and buy the one just as the cycle turns. Or they start out in equities and the first market crash comes along and they said, this is too risky for me. And then they sell at the bottom and put it in the money market. So I often think that the best plan is to, and that is where advisors should earn their money, is more on the emotional side, because I don't think it's rocket science to put together a good, solid plan for an investor. You know, you have the right asset allocation mix, you make sure you have enough exposure to long-term growth assets, but then you need to stay the course. But it is emotionally difficult. And I think that once again, advisors should, that is the key job, is to make sure that when the environment is difficult, that they stick to the plan.
How important is tax planning as part of building such a portfolio? Because I think if you change or switch regularly, there may be a capital gains tax impact, and you know, how should you consider that?
Yeah, so whenever you make an investment decision, there are actually two decisions you make. So the first is, what are the assets that you invest in? And I think most of the time now we've spoken about that side of it. But then the second is, one, how should you package that asset? And there are plenty of options, and each one has their own tax impact. And it's very particular to an individual client, his own tax situation, etc., etc. So, I mean, if I can just name a few examples. I mean, you own equities or you own a balanced portfolio. That balanced portfolio could be held directly as a discretionary money. It could be in a retirement annuity. It could be in a living annuity. It could be in an endowment. It could be in a company. It could be in a trust. It could be in a company that is owned by a trust. So there are many parts, but that is also a very important part of your financial planning, to make sure that when you own the right assets, you own it in the right structure. And once again, it becomes very particular. I can't give advice in general. That is often where you need to have a financial advice. And unfortunately, the industry, for a person that's perhaps not in the industry, the rules become quite complicated and many things to consider. And that is maybe also where a financial advisor plays an important role, to make sure that you package your assets in the correct way.
Interesting question. Is there room for derivatives within such a long-term portfolio?
Yes. Yeah. If you ask Warren Buffett, he would say definitely no. I think, you know, like if we think about derivatives, really what derivatives achieve, so derivatives can achieve two things really. I mean, you can use it as a way to increase risk. So in other words, you leverage, you use it as debt to increase your exposure to assets. So that means your returns are higher on the upside and lower on the downside. Or you can use derivatives to mitigate risk. So you can sort of use it to provide insurance or protection. It comes at a cost, but to actually smooth your return. So it depends on the context you have, and often, you know, it depends on the market cycle. So for example, if you had very high returns in the market, you know, it looks a little bit frosty, you can actually use derivatives, but I would use it, say you use hedge funds, which would provide better protection when the markets draw down. But then obviously when markets are cheap, you can use leverage to increase your returns going up. So it's not something that I think you can use, you can say I must use it consistently. The one very important takeaway is, just remember, when you are invested in equities, inevitably there will be difficult times when markets are full. And the one thing you don't want is to be a forced seller when markets are low. And often if you use derivatives, the markets come down, you get margin calls, and now you are forced to give more margin, which you may not have, or you're forced to sell the share at a bad time. And often, if we think about companies that start doing badly, and the share becomes so cheap, then you often see people with big positions, with debt funding, and then the banks come in and they call on that debt, and then they force you to sell at the bottom, which depresses the prices even more, and then you do some serious wealth destruction at the wrong time. So if you use leverage or use derivatives to add leverage over time, just make sure that you, once again, your portfolio are prepared for those drawdowns, and you have got enough cash available to service that debt.
Then how good are South Africans at building such portfolios, building generational wealth? Obviously that is a very interesting strategy, but how good are they?
Yeah, it's difficult to answer that quite generic, but unfortunately, if you look at the statistics and you look at, look at unit trust. Now, you've mentioned that it's very difficult for most asset managers to outperform the index by themselves. And then you look at how the investors in those funds do relative to the funds that difficult to outperform. Unfortunately, the investors do even worse than the funds for the reasons we spoke earlier about, where they always try to run after the past winner, and they sell their losers at the wrong time in the cycle. So unfortunately, it's easy to make mistakes in the market. Once again, a key takeaway for me is, beware of emotions, because your emotions, and we also come to that, makes you are generally wired to make bad investment decisions, unfortunately. I think once again, get back to what I think you should do is make sure you plan, get the structure right of your portfolio, make sure you've got diversified assets with enough exposure to growth assets for your long-term money, and then you stick to that plan. And make sure that within the managers you use, you also diversify.
Renier, we'll have to leave it there. Thank you so much for sharing your insights with us. That was Renier de Bruin. He's a senior investment analyst at Sanlam Private Wealth. The next session will be at 10 o'clock, so stay tuned for that. That's going to be looking at how to start investing, how to approach a broker, and how to avoid pitfalls, and hopefully we will have some tips as well. So stay tuned. We're back in 5 minutes. Are you an amateur retail investor and want to become a better investor? If so, you should not miss the Moneyweb Be a Better Investor podcast. My name is Ryk van Niekerk, and every week I speak to the best professional investors, research analysts and traders about their personal investment portfolios. We talk about how they make investment decisions and hear what they regard as their best and worst investments ever. The idea is to find some golden nuggets from their perspectives and experiences to assist amateur investors in becoming better investors. Join me and my expert guests weekly on the Moneyweb Be a Better Investor podcast. Listen on moneyweb.co.za or the Moneyweb app.
The Moneyweb Be a Better Investor podcast. Show me the money. Moneyweb, your trusted source for business and investment insights. The Moneyweb Frequently Asked Questions series. Part 2, Investing 101.
Hello, I'm Simon Brown. Welcome to part 2 of Moneyweb's FAQ video series. In this series, we give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I will take you through the main facts you need to know about investments. The big question, what are the different types of investments? You've got shares, you've also got unit trusts and exchange-traded funds. Unit trusts are active, they buy and sell all the time, trying to do better than the market, whereas an ETF is passive. They buy and hold the market, giving you that market return. What about the risks involved in investing? You certainly can lose money, especially in the short term. Long term, quality companies do well and increase profits, and this will see the share prices increase as well. When is the right time to consult a financial advisor? If you're not comfortable managing your investments yourself, there's always a lot of help online. But a financial advisor can add real expertise, and Moneyweb's Click an Advisor is a great place to look for one. How do I monitor the performance of my investment portfolio? Your broker will help you with the value of your shares as well as news from the company. Financial publications such as Moneyweb also offer amazing content. How can Moneyweb equip me to invest better? Moneyweb has a great tools and data page, as well as company news and a great selection of podcasts and articles every day to help keep you informed. In the next video, part 3 of the series, Moneyweb's editor Ryk van Niekerk will unpack Moneyweb's premium subscription offering, Insider Gold. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
I'm Simon Brown. I'm host of Moneyweb Now podcast, and hosting this session, we're going to really be looking at stockbroking, how to get started, where to start. We've got a bunch of questions. I'm joined in this session by Grant Menkes. He is head of trading at Nedbank Private Wealth Securities. He's got some 20 years in the business, is a registered stockbroker. Grant, really appreciate the time today. I suppose let's kick off right at the beginning, which really is, when you're starting out, the first question you've got to ask yourself is not what do I buy and how do I buy it and how much do I need? What's your life stage? Where are you in the point of your career, of your earning, and how far, I suppose, from retirement?
Absolutely. Thanks, Simon. Thanks for the opportunity and welcome to everybody. So, yes, you've hit the nail on the head. You don't start out by just buying shares. We generally break up your investment life cycle stages into 3 sections. Mm-hmm. So your accumulation stage, which is from 20 to the age of 35. Then your preparation stage is from 35 to 60. And then your retirement stage is from 60 onwards. Every stage has its own short-term goals, long-term goals, your risk appetite, and of course your asset allocation. So if we use the first accumulation stage, these are young people 20 to 35 years old. Your short-term goal is to pay off your student loan, to buy a property.
Build assets and the like.
Yeah, and then start getting some your emergency reserves going, so some savings. And I think COVID made it quite clear that people didn't have enough emergency savings. The second thing is your long-term objective. So you want to start accumulating wealth, and you want to start planning for your kids' investment, their education. Now, if you think about the risk scale, you are very aggressive.
Yeah.
You want to invest in assets that have large growth, capital growth, growth possibilities, not a lot of distributions or dividends, and you want to invest in high-yielding bonds. So pretty much in a nutshell. The person who is in the preparation stage, 35 to 60, these are investment professionals. They are at the highest curve of the earning potential. They have the ability to save a lot more. So their short-term, long-term goals are different. So the short-term goals are generally, do I have enough money to pay for my kids' education? And of course, we have to spoil ourselves from time to time to have a nice holiday. You know, you work hard, play hard, get away on holiday. And then your long-term goal is around retirement planning. Because no matter where you are, you have to start planning for the day that you stop working, whether it's 60, 65, 63, depending on your employer. Your risk is now shifted to moderate. You don't want all that growth in those growth stocks. You want to start having a more balanced portfolio, and the balanced portfolio will have some blue chips or some large caps, and then, of course, investment-grade bonds. Now we get to the people retirement, so let's use 60 plus. These people want to preserve their lifestyle. You know, we always talk about, in South Africa, 6% of the people will retire comfortably. So you want to start that planning early, so when you retire, you maintain your lifestyle, and of course you're able to pay for your medical expenses. Your long-term goal then is estate planning. What do you leave for your kids? How do you separate the assets, the likes? Your risk profile is now shifted completely to moderate, you know, so passive almost. So you want to have assets like dividend income funds. You want to have money market investments. You'll still have some of your large cap stocks, but you don't want the drawdown from your investments to affect your lifestyle, because you want to maintain that lifestyle going forward. So 3 lifestyle stages: the accumulation stage, where you build your assets; the preparation stage is where you maintain it; and then, of course, when you retire, to retire comfortably. Let's just call it that.
Comfortably.
Yes.
And the retirement will be, to your point, you've got a boss and they come to you one day and say, that's it, you're of the age, don't bother coming back tomorrow type of scenario. But moving from the first to the second stage, it's not necessarily a hard line in the sand. It's a bit of it's a process as you sort of transition from one to the other. And for some folks, they might have perhaps, you know, maybe they want to retire earlier. Perhaps they're a little bit behind the curve and they started a little bit later. It is that sort of transition. It's like, well, I'm getting into the middle part now. We need to start perhaps pulling back on some of that risk. And then, of course, one day, eventually, the kids actually leave home.
Yes, exactly. So it's all about what is your risk at that point in lifestyle? What is important for you at that point? As you mentioned, you don't just take a hard line to say, listen, now I've hit 36, I restructure my entire portfolio, and now I change from growth stocks to large cap stocks. It is a transition. It's better done over time, and with the help of maybe a financial advisor or your stockbroker, you can have that discussion around what is a large cap stock. You know, is it in South Africa the top 40 stocks, or what is the bond issues? What are money market funds? So have a discussion with the stockbroker. And they're more than willing to help you.
Yeah, and that's, we'll come to more detail. A large cap, they're top 40, but there are top 40 stocks and there are top 40 stocks.
Correct.
And the other point that you've driven home quite clearly as well is that, I mean, we're talking around investing here, we're talking around stockbroking, but you've got other commitments within your life. You mentioned kids' education, you mentioned fancy bicycles and exotic holidays.
Yeah.
They don't happen in isolation or in silo from each other. It is that holistic picture. You said you start life, you're frankly paying off student loans.
Yeah, exactly. I think it's, as part of the investment life cycle, you have to have some goals and objectives. I think once you know what your goals and objectives are, you can then start building towards achieving them. So whether you want to travel and save for traveling, or the fancy bicycles that people have these days, or a holiday or kids' education, it starts early. Rome wasn't built in a day, but it can burn down in a day, kind of scenario. So the sooner you start investing, the better. People always ask you that question: when should I start? And the sooner the better. So if you think about someone, let's use a simple example. Someone starts in his 20 in that accumulation stage. They have 1,000 Rand to invest a month into whichever product. And the product is a low growth product, let's assume 6%, and you increase your contribution by 6% annually. By the time you retire at 60, that investment will be worth 3.8 million Rand. But if you're in a more aggressive product, so you still invest 1,000 Rand a month from the age of 20, you grow your contribution by 10%, you have a nice growth of the product as well, which grows by 10%. By the time you reach 60, your investment will be worth 15 million Rand.
Whoa.
So there's a massive growth. People always talk about the seventh wonder of the world, which is compound interest and compound growth. So that's the scenario. Now you start talking about someone who starts later. They had some issues, they didn't have savings, they start saving at the age of 40. So now you invest 3,000 Rand a month, and you have a low growth of 6%, and you contribute additional 6% annually. That product will be worth 2.5 million Rand by the time you hit 60. Now, again, have another product that grows by 10%, same investment, contribution grows by 10% as well. That will end up at 5.5 million Rand. But it just shows you the sooner you start, even with a small amount, 1,000 Rand a month, which I'm sure most people can start affording at the age of 20, 25, will really reap rewards by the time you hit retirement.
It is that. It's that time in that process. Absolutely nothing beats time. And a bunch of the viewers today will be, a bunch of them will be on this journey. Some will be young, in which case simply go out and start. I mean, when's a good time? This afternoon's as good a time as any. For folks who started late, we can't wind back the clock, but there are, I suppose, hacks in a sense. Put more aside, because you don't want to go too aggressive too late in your life stage. I mean, maybe you can do a side hustle, maybe you can push back retirement if possible, but certainly you don't want to arrive at the age of 55 and say, well, I'm going to go into the massively high risk.
Absolutely.
Because, I mean, we've seen how that can go horribly wrong.
Yeah, so it goes back to your goals and your objectives, and associated with that is your risk profile. So people always say, I want to invest and I want to make 10% return or 15% return. I think the second question that you have to ask yourself is, how much are you willing to risk with that investment? Yeah. And at the same time that you do that investment, the risk profile comes into play. And then what are the assets that you are investing in? Is it a risky asset? Is it a large cap stock? Is it a startup? Is it, we won't get into cryptocurrency, but what are you willing to risk your money on, and at what stage? So when you're younger, you have a long-term to retirement, which means that if you make a mistake, you can still correct it. But if you're in your late 40s or 50s and you've put all your eggs into one basket, one stock, I think our previous guy mentioned Steinhoff, and many people lost a lot of money in Steinhoff. So let's call it a fallen angel. But if you risk all your eggs in one basket and it goes horribly wrong, you're not going to be that person that retires comfortably and be able to afford medical expenses, not just living expenses.
Let's quickly go down that rabbit hole then. I mean, one of the keys we've mentioned, it's time. The more time you've got, absolutely that compound wonder of the world. But the other one is diversification. Warren Buffett says it's your only free lunch in the market. Because, there's always the story, if I put everything into Capitec, I'd be doing great. But you might have put it into African Bank or Steinhoff or Tongaat or one of the many fallen angels. You need to have that diversity, not just across stocks, but across even assets. You've mentioned bonds, you've mentioned money markets, and have a little bit of each, which the percentages will depend on where you are on those stages.
Yeah, exactly. I think, so equity gives you a certain payoff profile. Money market gives you some guaranteed income or a dividend income fund. And then you have some bonds, high yielding bonds or investment grade bonds, like I mentioned before. So as you create your portfolio, it's not just about diversifying, I want Anglo's, Billiton, Sasol. Your portfolio these days, most stockbrokers can offer you a multi-asset class account, which means you can have equities, you can have bonds, you can have unit trusts, offshore investments. So it's around getting the right balance at the right time. So it is a balancing act, but I think there are enough investment professionals and stockbroking firms out there that has evolved over the last 20 years. 20 years ago, I remember the first online share trading platforms have evolved, and now there's a plethora of opportunities and choice for investors out there. As you mentioned, I represent Nedbank Private Wealth Securities, so we're one of the solutions out there. But it's around the client being comfortable with who he's investing in. It's not a risk thing in terms of who you invest in, because everybody is regulated either by the FSCA or the JSE, but it's around who do you trust to talk to and who you trust to manage your money or have a discussion about.
Yeah, it's those discussions around it. And then it starts to open those questions of, is it shares? Is it perhaps collective investment schemes such as unit trusts, exchange traded funds in the passive space? And that often can be overwhelming. I typically say to folks is, you know what, get yourself a unit trust or an ETF, because at least now you're in the market. Now you can start to see things going up and down. It's not an equity, so it's not going to shoot the lights out. It's also not going to collapse in a heap. And sort of start learning the ropes by taking some smaller positions, perhaps, as you're learning and understanding all the rest that fits around it.
Absolutely. I think ETFs has allowed investors to get that interest in the market. So firstly, you're spending your hard-earned post-tax money, and you are choosing a product in the ETF space. I think there are over 100 listed ETFs at this point in time. So whether it's sector-related or market-related or a combination of local and offshore assets, or if you want to get access to the MSCI World Index, you can now do it. You mentioned it's not as, I will use the word sexy as owning an individual share, but it's also not as risky. By having a ETF, you're asking a asset manager to manage that basket of shares on your behalf. It has very low volatility, which means it's a nice, almost I will call it a passive investment, but it gets you interested in the market. You start understanding what that sector looks like. What are the shares in that sector or that basket that you would rather want to own on an individual basis.
Let's move into what do we do before we start. And I mean, part of it is, make that decision. And a lot of folks are thinking, well, the first part of, I'm starting, which ETF matters, which share. Actually, there's a lot that comes before that in terms of just getting smarter around markets. The lingo, I mean, we've probably dropped some words here which have got people scratching their heads already this morning, and we're trying not to, but there is a lot of fancy words in the industry. Yeah. It's small things like navigating the website.
Yeah. I think, so I'll speak on the Nedbank Private Wealth Stockbroking behalf. So we have created multiple training videos that is published on YouTube as well as our website. It is available pre-login, so it talks to how do I navigate the website? How do I place a trade? How do some market lingo, what is PE ratios, what is headline earnings and the likes? Some basic economic information, some technical analysis, and of course the very important one is how to place a stop loss.
Yes.
So we cover all of those items, and then it assists the investor around what is available through this website. In addition to that, we have a call center that they can call. It's published on our website, and the people behind the calls are also investment professionals. They've had more than 5 years experience in the market, and they've hopefully seen most of it these days, and can answer basic questions. We also have a trading desk, so if the questions get a bit more complex, they have the ability to escalate that to someone who's a registered trader and can answer those questions.
I want to hone in on stop loss, because a lot of folks are going to think, hang on, stop loss is more a function of trading, which is the shorter term in nature. We're talking investing, which is the longer term, years, decades, ultimately into your retirement. The point being is that even as an investor, you need a point at which you say, this isn't working and I'm losing capital and I need to exit the position.
Yeah, so stop losses started out, I think, years ago with derivatives because they are so volatile. But if you think these days, like I said initially, you have 100 Rand to invest or 1,000 Rand to invest. how much am I willing to lose? That is where your stop loss is. Whether it is, we'll use a more word, trailing stop loss, which means if the market retraces a certain rand value or percentage from last traded price, or a fixed price at which you want to exit. That's very important. The other thing around, we talk about investing. We have had some fallen angels, which means that long-term goal of that share had a massive issue, or there are other stocks that are actually come end of life. We use Kodak, for example.
Yeah.
You know, the market has moved. We spoke about it earlier on. I have a old camera, which I was quite impressed with, which had 10 megapixels. And now the cell phones that we have these days have multiple megapixels more than that camera. But that industry or that stock came to end of life. And you should make a decision around cutting it before it gets to end of life. Pay the taxes if applicable. Move on to the next stock that will allow you to meet your investment goals. Because diversification and rebalancing isn't just about changing the percentage weightings in your portfolio. It's around relooking the stocks. Do they still meet your objectives? And if not, make a change, move on to the next one.
So I've got a question from Sean I want to come to in a moment, but you mentioned rebalancing, and let's quickly touch on that, which is quite simply that you know, you buy a stock and it is great, and so it becomes, you know, it does spectacularly well, it becomes a huge part of your portfolio. That now becomes a risk, or, you know, to your point, there's a loser. We were speaking a moment ago about, as you move through the different life stages, how you need to adapt your needs and requirements. You're managing the portfolio. Part of that is going to be, well, I need to maybe cut back on this position a bit, or all of it. And I know a lot of folks worry about tax, but you're only paying tax if you're making money.
Yeah, exactly. I think it's the byproduct of making money.
We'll preface this by saying we're not tax experts, we're not giving tax advice.
100%. I think when you start out with your portfolio, it's, like I said, in the preparation phase, it's a more balanced portfolio. So let's use stock ABC. Stock ABC has done something incredibly well, and the stock triples in value. So you wanted it to be a balanced portfolio. It's now 30% of your portfolio, which means you've got single share concentration risk, which is nice to see when you look at your portfolio. Mm-hmm. When you start looking at what are the risks of this stock retracing below where you bought it, and that's where you have to make the decision, and it's a tough one.
Sure.
To say, listen, I'm reducing this holding to a certain point, and then investing into the next thing. But it's at that point there are other stocks that have the ability to grow, maybe not as 300%, but 10, 15% over the next couple of years, and will give you decent return. Maybe the one that's shot the lights out has hit its ceiling, and it's never going to go any further. And the market, the rest of your stocks, is going to take years to catch up to get it back to a balanced portfolio. And that's where you manage the risk. You don't want single share concentration risk in a balanced portfolio.
And it's a nice problem to have. Mine was Capitec. Back in the day, I think 2008, I bought Capitec at 20 Rand. And again at 40, and pretty much I've been a seller ever since, because it just keeps on overwhelming my portfolio. And yeah, in hindsight, sure, would have been better if I just sold everything, put it in Capitec and left it, but it's about managing the risk, because yes, Capitec's been a great investment story, but we haven't known that over the 15 years of journey. There have been risks, there have been issues, Viceroy and the like. Sean's asking, how does an investor evaluate overtrading by a broker, in essence, versus wealth accumulation for an investor? And I want to broaden his question a bit, which is, and it kind of comes into the next part, which is, you've spoken around the support that you can expect, people you can phone to, and this is going to depend, different brokers will have different offerings in that regard. How do you evaluate someone who can help you? I mean, my sense is it's a sit down, a cup of coffee and a conversation, and probably with a couple of folks to make sure you find the person who you like, who you trust, and who makes sense to you.
Yeah, I agree. I think I'll draw that back into people and interviews for jobs. You find a level of comfort with the person you're having an interview with. So that person will not only he's skilled enough to do the job. He got into the door.
Sure.
All right, that's your broker. You want to have a relationship with that broker. It's a long-term relationship. If you're 35 and you're planning for retirement, that's another 25 years that you're going to have to phone me at least twice a year to talk about your portfolio. So there has to be a relationship. You have to feel comfortable. Most of the guys are registered investment professionals. It's around having that relationship. So that's the one thing. And if you have that relationship, you can have tough conversations, because it's going to happen where I'm going to tell the client, we need to change your portfolio. And he must trust you, you know. So the relationship builds that trust over time, and then you trust the advisor who gives you that performance and that feedback. The norm in the market, if it's a discretionary portfolio, around over trading, because brokers can't trade on clients' accounts if it's not managed or not discretionary. So maybe it's some more jargon. The one is a self-service account, so non-managed, non-advised account, and the other one's fully discretionary, where we agree your stuff and I trade on your account.
And the other's DIY.
Absolutely. But the norm is around 20 to 25% of your portfolio is changed on an annual basis. So remember, the investment professional isn't there to generate income out of executing for you, because they charge an advisory fee or management fee. So it's more in their interest to have you in the right stocks that gets capital appreciation for you and him. Mm-hmm. It's not around the 50 basis points or 20 basis points or whatever, 75 basis points that he earns around rebalancing your portfolio consistently, because the cost will then outweigh the performance of the portfolio and he makes nothing. And
the client will wise up and take their money elsewhere. But I liked your analogy of it's a job interview. That's exactly what it is. I mean, that this broker, this advisor, ultimately they're working with you. It's a different type of professional relationship, but it is a professional relationship. Yeah. There's more to it as well. So now I've got myself all smart on the website. I've learned a whole bunch of jargon, and now it's a case of, well, okay, what to buy? We mentioned ETFs, but let's touch a bit on perhaps sort of the individual stocks and going and doing that work and that research. Some of it, I mean, you can listen to many of the shows out there. I'm sure you guys have got research you publish on your platform. And then, of course, the individual doing their own. Yeah, exactly. I think we're in an investment, fortunate position. We have an investment team because we do discretionary portfolios. And a requirement to manage discretionary portfolios is you have to do your own research. And if the regulator or the ombud comes in, they have to review your research. So you have to put hand on heart and stand by it. The research is published on our website post login. You'll most probably find research on the top 40 shares that we have in the market at the moment. It is a long-term investment research note. So it generally gets published twice a year post results of the company. It is 3 years to 5 years investment base. So we spoke about tax earlier on. If an investment is held for more than 3 years, it's not income tax, it's capital gains tax, so a lower rate. So that's why most of your investment holdings are 3 to 5 years in nature. It is a fundamental analysis of the company. What do they do? What industry they're in? What has affected them positively? What has affected them negatively? What is their headline earnings per share? What is their dividend that they are paying out? And then our investment team makes a recommendation. So generally, the market sees buy, sell, and hold. We make an investment recommendation, so it's fairly priced, underpriced, or overpriced. Gotcha. And then based on the recommendation, we don't give you a target price because it's 3 to 5 years in nature. We don't really care around what it does today or tomorrow or a week later. For entering it, but it's around the long-term view. So that's for the investor for the long term. In addition to that, we have clients who want instant gratification. Yeah. So let's. It's Tuesday. I've got plans for tonight. So the instant gratification comes either for derivatives or stocks, right? So we call it trade ideas, and these are short-term in nature. The trade ideas are also published on our website. It will tell you what stock to buy. It gives you an entry price because there's an exit price attached to it. And there's an entry and an exit price and a stop loss. Okay, upside, downside. Upside, downside, and then we say, and we give you a technical graph as to why we believe it and a little write-up around the company to substantiate why we're calling it. So long-term and short-term trade investment ideas and trade notes are available on the website. And the clients have used it successfully over the last 18 months that I've been with
So,
NetBank.
and this is the question that just popped up, no name there, but it is, from what you're saying there, when you're looking at the long term and equity, and weirdly it could be the same share. It could be Sasol, and it could be a long term view on Sasol, 3 to 5 years. Then it's going to be around the fundamentals. If it's a short term trade on Sasol, which would be days, weeks, maybe a month or so, that's when you turn to the charts and look at the technicals.
Yeah, so I don't want to offend the technical or the fundamental analysts out there, because they feel very strong around each of their own methodologies. But what I do is I look at the fundamentals of the company. What do they do? What do they produce? Which sector they're in? What is happening in the market? And then just to substantiate that, what does the technical analysis show? Simple technical analysis, moving averages or something like that, relative strength index, and then just say, listen, the market is pushing it up or it has reached its top for the short term. It is definitely a sell as well, which is what the technical analysis showed. Long term, it's going to go up in any case, time value of money, all that sort of stuff. But you can use both. We have the ability for clients to use both. And it's recommended that you use both in trying to make shorter term investment
That's what I do.
decisions.
I will find the share that I want to buy for the longer term, and then I will look at the chart and say, well, if it's currently falling, let's see if I can't get it a few rand cheaper. And I'm not the technical expert, but you can get a sense of what's happening there, and kind of get smarter around that. Yeah. There's also, in terms of the companies, and I think this is often overlooked, is that the viewers out there have got their own skills. They're in certain industries. Maybe they're in banking, so they understand the banks better than you and I would, perhaps, as an outsider. Maybe they're in mining, and they understand mining better. You've got your own skills, you've got your own experiences, and you never want to invest exclusively on that. But if you're building a preponderance of evidence, that can come to the process as well.
Absolutely. I think it's key that you play to your strengths. You mentioned banking, finance, mining. We've got a lot of engineers out there, doctors out there that know their industry really well. So they know what is happening not only in their mine, but they have friends and colleagues at other mines. What is happening with the possible strike action in mining sectors? What is happening with the rand-dollar exchange rate? How much output are they going to get? What is the price of that commodity doing? Rising interest rates in banks, what are the debtors books look like in banks? And it's not only the debtors book in terms of home loans, it is your credit card, it's your short-term loans, all of that is increased payments that is as a result of rising interest rates. It is good for us who have money in the bank, that little emergency fund that you earn more interest on it, or your money market funds. But there's the knock-on effect of, what does the banks look like in rising interest rates? And I think that's where you play to your strengths. You understand that industry really well. You might not want to invest in your own share if it's listed, but there's another share that you think is doing really well in the same sector. They might be the growth stock, and that's where it comes in. You can have two portfolios with most brokers. And I think that's an important point. You can have your whichever life cycle you're at, and the portfolio matches that life cycle. Then you can ask your broker to open up a secondary account. You say, listen, this is a more speculative one that I'm willing to risk a bit of money on. And then you can trade in all these other little products and stocks and risk a little bit more money to get additional capital growth. But it's not going to affect your retirement plan in the long run.
I take the point in that, actually, and it reminds me, way back in the day when I was younger and working at a stockbroker, we'd have folks who had themselves, and mostly they were in that sort of second stage. They were somewhere between their sort of 35 to 60, maybe in the 40s or 50s. They would have a nice portfolio which was being managed by the experts. And then they would arrive one day and say, could I take a 2% carve out or 1% carve out, put this in an online platform for me, let me try my own hand at it as well. If they completely messed it up, it was a small enough percentage, it wasn't going to damage them. And they would essentially have two accounts, one which the professionals did, one which they did. And some of these folks got really good, and as they got better and more confident, they could sort of take more from the managed side. The key point is, started small. Hey, learn to walk first.
Yeah, exactly. You know, whichever life cycle, and we refer back to the life cycle, you've now made a conscious decision to have a long-term investment, right? Whether it's that growth stocks that you want to have for 10 or 15 years, or the large caps. But something could happen in any of those large caps that you want to take benefit in something else that's happening. You know, so don't liquidate your long-term portfolio because there's a goal attached to that long-term portfolio. But maybe take the dividends that got paid out this last season and switch that over to your short-term speculative account, because it doesn't affect your long-term equity, and you don't want to sell out because there's capital gains tax and the likes. So keep it simple, and then grow with confidence. You might start trading equities on its own. You might grow and attend some seminars around derivatives, and then start trading bigger sizes with limited risk, of course, but have the ability to not only have to look at your account on a Saturday before the rugby or something, or in the morning, but actually have a look at it on a day-to-day basis. Because on the long-term portfolio, whatever happens day to day, the 1% move today, the 2% move tomorrow, 3% move the other day, it's really not going to affect your decision around holding the stock. But you can benefit from a 1 or 2 or 3% move intraday in your speculative account, and that will, create some more interest in that market.
But I like the idea around the dividends, that cash flow that comes. Dividends are important, but some cash flow arrives over the last 6 months. There's been some juicy dividends from banks and the like this year. Maybe take that, and instead of reinvesting, which would normally be the case, take that and put it into your shorter term speculative. As we're talking, and we kind of started at the point, and it's becoming clearer and clearer. It's around having a plan. And even before that, it's around knowing what your goals are. You spoke about your life stages.
Yeah.
That helps you understand your goals and your plan. But it really is sort of having that broader picture in mind, and understanding what you plan to do. And of course, the kids' education is a part of that, and maybe a 21st birthday holiday or something like that. Having a plan which is going to be dynamic in a sense, because life throws curveballs, pandemics, ailments, etc. But really having that and fitting it all together into that ultimate achieving of the goals.
Yeah, I think it actually brings it back to diversification and rebalancing. So firstly, you do the diversification to ensure that you meet your goals, and then the rebalancing, which is an important factor as an investor. So we spoke about it earlier on. A certain stock could get to the end of its life cycle, and you sell that out, you buy the next stock in, and I think this is where investors make battle with the rebalancing of the portfolio. They get emotionally attached. We're human beings. We get emotionally attached to a stock. It has given some poor performance. You didn't stick to a stop loss, and in your rebalancing process, you believe the stock is still going to do well, and you sell something else out and you buy something else. But this stock is actually the one that's detracting from your performance. So, and that's where investment professionals removes that emotional attachment to a stock. And we've had these discussions with many clients over the years, that if you are emotionally attached to a share, I would suggest moving it out of the long-term portfolio, because it's going to detract from the end goal. So if you want the stock because your grandfather still bought it through a share certificate and it got, that's the emotional attachment. It might not be the company itself, but it's your grandfather gave it to you as a present for your 21st, and you have this share certificate framed in your study somewhere, and you still hold the share. Put it somewhere, still keep it, but rebalance your portfolio to meet your objectives. And there's an opportunity for both.
I like that, and don't have it in your core portfolio. I take that. There's something else which you kind of alluded to there, which is FOMO, the fear of missing out. And I'm thinking Thungela Resources, which has been a phenomenal run. But if you look at the volume, most of it happened sort of north of 300, and it's being very cautious of falling into the trap. And the distinction is
it's a hard distinction to make between a great stock that's got great potential or a great stock that's now incredibly expensive and everyone's talking about it because it's done that meteoric rise.
Yeah, so I'll answer the question, I think, in two ways. So I refer to them as chasing the last winners. So you read about it in the newspaper, it shot the lights out, the market is pushing it up to a certain price, which was already expensive when you looked at it the first time. Now you look at it the 10th time and it's like more than it was initially, and then you make a decision to buy the stock. So it could be cyclical at that point, that the smart money has already seen the capital appreciation. They're on the other side now selling to us, the investor, who has now caught on to the stock having rallied extremely far past, exceeding its fair value effectively. Now we buy into it, and the smart money starts selling it downwards, and before you know it, it's trading at fair value again. So you got sucked into this hype of wanting to buy the best performing stock, unit trust, etc. in the market at that point in time, but it's not the smart money thing to do, and it's that where if you want to change your portfolio, but do it in something else. Don't sell a existing winner to buy the stock that's exceeding the market at the moment.
Yeah, that might be the next one. Let's talk quickly around asset allocation. We talked around it a bit up front in terms of you'd have some equity. That might be a unit trust or individual shares or an ETF. You'd have some bonds and the like. Then, of course, there's gold. It's still folks out there who like to have gold in a portfolio. There's your emergency fund. There's offshore. I mean, we haven't even yet got to the offshore part of the component. I mean, are there sort of model percentages that you should say, well, it's quite simple. At this stage, you have X% here and Y% there, or is it a little more fluid? Because certainly you need all the different asset classes, and it is going to be dynamic as you move through those life stages.
I think the rule of thumb generally is like 25% of your investment to be offshore and 75% locally. I think that's historically been the rule of thumb. I think our investment universe in South Africa has shrunk drastically over the last couple of years. The number of shares delisting, the concentration risk around 5 banks, resource stocks, in the top 40, so generally you would only want to have at least 20 of them, but you're still doubling up on some sectors. I think the investment universe offshore is exciting. It has taken a massive beating this last year.
Sure. For the first time in a long time.
Yeah.
Well, outside the pandemic, but
yeah, I think it's returned more than double-digit figures leading up to this year, consistently, even if you do not take into account the currency. So
I think the S&P's 13 or 14% CAGR over the last decade, compound annual growth rate.
Yeah, exactly. And so I think over time, as you get into that preparation phase, you will start allocating more and more of your investment portfolio offshore. I can't give you a figure, but it all depends on what you're trying to achieve. And that you can have a discussion with your stockbroker or your wealth manager or whichever it is, or whichever number you're comfortable with. So if there's your top up that you were going to put into your local portfolio, you think, I think I'm fully invested locally, rather invest that offshore. There are actively managed ETFs across the most of the jurisdictions, or you could have the single share exposure as well. I think the Netflixes and all that have taken the biggest pain, and chip makers and the likes. But there are, I don't know if it depends on how many documents you read. There are more than 19,000 shares across 37,000 exchanges. That doesn't include the ETF market. So the investment universe is massive out there, and that's where the additional research or work that you do around that investment becomes more and more important. It's something that you don't know. It's an industry you might not be comfortable with, or something that's pretty new on the market. And I always tie back that time you spend on buying a stock equal to going and buying a car. you don't just walk into whichever garage it is and pick the first car that you see.
The yellow one.
Yeah, I'd like the big one that's light on juice and doesn't use diesel these days anymore, maybe a hybrid. But you start doing your research.
Yeah.
What price range can you afford? What is the specifications of the car? What is the fuel consumption? What is the security or the NCAP rating in terms of the car? So you do your research around buying a car. Why don't you do the same research about buying a share? You know, it's hard-earned money that you're spending. So take the time, do the investigation, and I think there are multiple platforms out there where you can ask questions around. You know,
yeah, it's a good point.
stuff.
And we've certainly, 20 years ago it was harder, but in this day and age, it's become so much easier to do that research. And again, it comes to the point we made earlier. Even if you don't work in the industry, we've got skills, we've got insight, we can ask questions, and the like, can do that. I want to go back to the offshore component. I think an important point is to take an holistic view, because of course you've probably got some Reg 28 product, which is a pension fund, a provident fund, a retirement annuity, maybe a preservation fund, and that's got some assets as well. So yes, you've got potentially some managed portfolio with a broker. You've got some DIY portfolio you're doing with yourself. Heck, we haven't even touched on the tax-free component yet, and Reg 28. And you actually need to look at them, all of them together, because you might say, well, I want to go X% offshore, but the question is, well, what's your offshore weighting here? What's your maybe cash or near cash weighting in this one? Get an Excel spreadsheet and put it all together, and you can do that even with your Reg 28. They'll send you quarterly statements.
Yeah, I think with most provident fund pension funds these days, they send you what they call a minimum disclosure document. Yeah. In the old days, it used to be called a fund fact sheet, which tells you what assets, what shares, what's bonds, what is the weighting to the shares. And then when you structure your portfolio, don't go and mimic what they've done, because then you're doubly investing in the same thing. And that's where diversification comes back in. So if they've got a certain weighting to this stock, buy something else. You know? So, and that comes back to the ability to do the analysis these days has become a lot better. The ability to have access to information at your fingertips. Technology is evolved, comes onto your mobile device if you put an alert on, or you have access to SENS announcements, the same as an asset manager or a fund manager. You have technology at the tip of your fingers and use it.
Yeah, no, it is. It always is. We live in the future. I mean, I keep on saying it, and then the next day is back to the future. Another question from Sean. He's saying the extent of your stop loss. And this perhaps is the really, really hard question. I mean, so you've bought the share, whatever it might be, whatever the stock is, you plan to hold it for the next 3 to 5 years, but you want to protect, you want that stop loss in it. Is it 5%, is it 50%, or is it have a hard look at the chart and try and make a decision from that? Because I'll be frank with you, that's the part I struggle with still after decades in the market.
I think there is no holy grail in terms of what the stop loss should be. I think it depends on your risk appetite. As you enter the trade, you have to put what are you willing to lose. Now, Sean asks around volatility and the likes. So the South African market has multiple sectors that they're trading. So let's call it the large caps. The Anglos, Billiton, Sassels, top 40 shares kind of thing, have very low volatility. So between 3 and 5% a day kind of thing. Then you have the secondary markets, and let's not call it secondary, the second tier market. Still quality stocks, but they will be slightly more volatile. It could be up to 10% intraday volatility. And then they have the which we used to call the alternative index or alternative exchange stocks. And they can have anything up to 25% volatility intraday. So have a look at the stock, have a look at the historical pricing, because you don't want to buy the Z04 stocks, which I'll refer to, and it has intraday volatility of 25%, and you put a 20% stop loss, you'll be stopped out every day.
It's just someone having...
It's just, the bid and offers are just too wide. The liquidity is low. So the volatility and liquidity determines how volatile or where your stop losses should be, but it's where you're comfortable. So you can't be stopped out every day and re-enter the trade every day. If the market is moving in a certain direction, don't try and force it into a different direction. You'll be wrong 90% of the time. So if the market is moving in a certain direction, if you've been stopped out, stay out. And when it's stabilized again, then try and get back in or buy something else. But the market is telling you something when it's falling drastically.
It is. And then it comes to the issue, we touched on it earlier, which is, as I'm understanding from what you're saying, you're making decisions and you're not worrying about the tax. We said earlier, tax is an outcome of a successful trade. The tax is the byproduct. You don't look at it and say, oh, now there's tax. If it's the right decision to make, the tax will simply look after itself. Otherwise, we start getting into heaps of pain.
Exactly. You should not take tax in consideration when you're rebalancing your portfolio. Tax is a byproduct. The fact that you're paying tax, you're making money, which is tough for us to pay over, but it allows you to take the next unemotional decision around the next investment. And I think that, and I keep on mentioning, and I say it constantly, is where the investment professional takes that unemotional decision around what the portfolio should look like. You agree up front, you might have a personal relationship, but I don't have a personal relationship with your portfolio. There's an outcome and a goal we need to achieve, and emotion doesn't form part of that decision making.
Yeah, I take that. And it is, one of the risks, and certainly when I was starting, there was a lot more of it, but it was the thrill of the winner. I was trading warrants in the late 90s, and you buy it at 40 cents, and it's 44 cents the next day, and you just, not only do you feel like a genius, you like the rush too much, and you start. I was making horrendous decisions just because of the thrill, and it was a horror space. We need to, and it's easy for you to know how to sit here and say it. We need to be clear, analytical, unemotional, right decision for the right reason.
Yeah, and I think the thrill can be substituted with the alternative portfolio. So
I like that.
If you want to trade, if you want to have that thrill, that exciting feeling of being involved, not too exposed, but involved. There are alternative products out there that offer you that thrill daily and the risk daily.
Well, there's a flip side to that thrill, right?
Exactly.
I didn't mention the pain part.
Yeah. So there's a product for most investors out there, and I think it's about choosing the right one at the right time. And sticking to those decisions, which is the hard part.
Yeah, it is. But I like your idea. Have the thrill in that small little part there, so that it might damage your heart, but it won't damage your portfolio.
Correct.
And let's quickly touch on trading. We've got 5.5 minutes left. We've been talking equity here. In trading, you mentioned the derivatives, the CFDs, the futures. We've got listed options, which are the warrants and the like. And I see a lot of folks who come along and they jump straight into the deep end, which is futures. And again, it's learning to walk. It's saying, well, I want to do some trading. Let's just start with equity. You can trade the shares. You don't need that derivative or that gearing. And as you skill up and get the knowledge, you can move into the riskier and more rewarding part of the trading environment.
Yeah, I think you've hit the nail on the head there. It is exactly that. The derivative market is so geared, so it gives you the opportunity to make massive profits, but massive losses at the same time. Intraday, it settles daily. So get familiar with how trading works, how the market works, more importantly, how the shares operate in that market. What are the trading times, of the market? A lot of people get pulled into FX trading.
Yeah.
And I'm sure all of you know it, FX trades 24 hours a day.
Yeah.
Which means at 2 o'clock in the morning when you're having a sleep, you're getting a margin call and you're closed out because the liquidity at that time in the market is so low, someone trades something silly and you're closed out. And 2 seconds later, it prices fairly again. So understand what you're trading, find your feet, get rid of your training wheels like we all did when we started riding a bicycle, and then take a stab at derivatives. So the derivative thrill is the ability to buy 100 rands worth of shares for 10 rand.
Yeah.
The problem we have there generally is they buy 100 rands worth of derivatives instead of just 10 rands worth of derivatives. So the thrill is there if it goes up, it's 100 Rand profit. But if it goes down, it's 100 Rand loss. And that's where that over trading, over gearing comes into play. And if you don't understand the market, it's going to hurt you quickly. And that's why it's important. Find your feet with equity trading. If you think there are certain stocks that have some nice volatility intraday, and there are some stocks, Naspers is one of them, Prosus, Sasol, where you can participate intraday in a 3% move. But know the stocks that have those volatilities and then trade the right product.
And yeah, to the point, learn to walk. We've got a lifetime of doing this. We don't need to rush into it. We need to wrap, and I want to go right back to the beginning, which is, in a sense, it's depending on your life stage as to what you're doing. But it goes to what we said a little while ago. It's knowing what you're trying to achieve, how you're going to achieve it, understanding that there is help and assistance, which might be an ability to find a research report or perhaps have a conversation with a broker or a managed portfolio. It's finding what works for you and what your goals are, which is really important. And each individual on this video this morning, I mean, we can almost make it bespoke for each of them in a sense. They've all got different needs.
Yeah, agreed. And I think that's where, if you understand where you are, what you want to achieve, and if you battle with that goal setting, or battle with the emotional side of trading, or battle with spending enough time on your portfolio, there are investment professionals out there, as we mentioned. And I think I would strongly advise people to speak to an investment advisor. They've spent many, many years in the industry. They qualified. It's like us going to a lawyer or a doctor. They're professionals, so they do it day in, day out. Investment professionals have it maybe slightly harder because the market can have negative returns or zero returns, and it makes a difficult discussion. But speak to an investment professional. Most of them will see you at any time of the day, kind of thing, work with you, and if you don't agree with what they're saying, you can move on. It's around that relationship that you have, or you feel comfortable with the person and you entrust them with your money. We all entrust our pension and provident funds.
No questions asked.
No questions asked. They just take
half the time we don't know who
money
they are.
off my account.
Send it to me when I'm 60.
Yeah, exactly. But there are some of those same professionals that can do the similar thing for you. Do not to replace your pension or provident fund, but to complement it for the retirement age.
Yeah, and I like that. Know where you are. That's so important. And know your skill set. Don't try and get out of your comfort zone. And what you say there in terms of, we're happy to go to professionals when we're sick or when we need, legal advice or something. We can absolutely do it here. We can DIY. We can also do it as a small slice to make it perhaps a little less risky for us. We'll leave that there. That was Grant Bankies. He's head of trading at Nedbank Private Wealth Securities. I'm Simon Brown. We're going in for a short break. We'll be back at 11 o'clock. Ryk van Niekerk will be back for session 3. And of course, we'll be going on for the rest of the day as well. Grant, really appreciate the time today.
Thanks, Simon. Really enjoyed it.
Tune into the SAFM Market Update with me, Fifi Peters, tonight from 6 to 7 p.m. as we unpack the day's business and investment news. You can live stream and download the latest podcasts on moneyweb.coza or via the app.
Moneyweb, your trusted source for business and investment insights.
Moneyweb Frequently Asked Questions, Part 3, the Moneyweb Insider Gold Premium Subscription.
Welcome to Part 3 of the Moneyweb FAQ series. I'm Ryk van Niekerk. We received the question, what are the benefits of an Insider Gold subscription virtually every day? The short answer is that a premium Insider Gold subscription unlocks a myriad of premium data tools to assist any individual to analyze and research the performance of JSE-listed shares, unit trusts, ETFs, ETNs, commodities, exchange rates, and international indices. The historical performance of these instruments is available for up to 5 years, and the tools allow for the ranking of the indicators according to many predefined metrics. I want to highlight 2 unique and pretty cool tools. The comparison tool allows subscribers to compare the performance of multiple instruments over various periods. For example, a subscriber is able to compare the share price of a company such as Sasol with historic performances of the price of Brent crude oil, the rand-dollar exchange rate, and the S&P 500 index, all on one graph. We also offer a dedicated page for each listed company and unit trust. They are the Click a Company and Click a Unit Trust pages. Each page contains detailed information on the historical price and financial performance of the instrument. Sign up today for just 630 Rand per year or 63 Rand per month and equip yourself to make better financial decisions. In the following video, I will highlight a few of the many other benefits of the Premium Insider Gold subscription. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels for more information.
Moneyweb, your trusted source for business and investment insights.
Good morning again and welcome to session 3 of the Better Investor Conference. Now, many people want to manage investment portfolios, but it's difficult. They want to create discretionary portfolios and build wealth, and they see it as a way to put money at work, especially surplus money. And skin in the game as part of a learning journey is always a great idea. But it's not always easy to construct a portfolio that beats the market. In fact, many professional investors also battle to do that. And many investors make critical mistakes, which could have been avoided. And today I'm going to talk to 2 professional investors. We want to hear what their investment philosophies are, how they approach markets, how they formulate their strategies, and what they are thinking about what is happening currently, not only in South Africa, but all around the world. And we would like to hear where they see opportunities, what they regard as challenges. And I think hearing from professional investors can guide many amateur investors to become Better Investors. I've got two guests today. Senzo Langa, he's Head of Portfolio Management, Alexander Forbes, or Alex Forbes these days, and he's been in that position for more than 5 years. He has been in the asset management industry for more than 11 years. He's a CFA charter holder. He has a master's degree in finance from WITS, and he oversees the management of all portfolios, including traditional asset classes like cash, bonds, property and equities, and alternative investments, hedge funds and private markets, and actually a lot more. And my second guest, Rihanna Khan, she's a portfolio manager in the 4-factor team at 91. She's been in this position for 3 years, but she has been in the industry for more than 12 years, and she co-manages the General Equity, SA Balanced and Worldwide Flexible Strategies. She's a chartered accountant. She has a BCom Accounting and a postgraduate diploma in accounting from the University of Cape Town. Thank you so much for joining me, and I think many people look at the markets and all they see is volatility. Short-term focus, normal retail investors are nervous, they are emotional, and I think if we can hear from professional investors, just the way they approach markets, what do they think of current developments, and I think let's start off with, Rihanna, let's start off with you. Just give us an overview of how you currently look at the market, and what you regard as noise, and what you regard as signals of where markets may move to or trend to in the future.
Yeah, it has been a tough environment for sure. Lots of volatility, as you can imagine. We're sitting with a backdrop where we have higher interest rates, declining liquidity in global markets, and then we've been peppered with all these left field events and challenges. So we had the Russia-Ukraine war, we had our own regulations allowing us to go 45% offshore. We've had China stimulating, but then they're locking down. We've had the UK with what they call as trussonomics, essentially. So lots of things to battle through. And I think the reality is if you take a step back and you've got a framework that works in terms of how you make money, what makes a share go up, etc., and you stick to that framework, volatility actually starts to become a friend. Yes, it's a frustrating thing in the short term in terms of what that volatility actually does to your portfolio, but on a medium-term view, it should work out. So if you take a step back in the way we think about the world when managing the SA Equity Fund, for example, is that we think the share price today of that company is telling you what that company is going to earn over the next 12 to 18 months at a reasonable valuation. So if we can get ahead of the curve and know what that company is going to earn ahead of market forecast, for example, so the market forecast comes to earn 5% earnings growth, we think that number's 10, we'll then own that company. So when you hit with this volatility, what tends to happen, volatility is usually sentiment driven. That share price then falls, and then we take advantage of that because as long as our conviction that those earnings numbers are going to be delivered is still intact, that stock actually looks more interesting and will actually start to top up on that position. So what we're trying to do here is actually turn volatility of the market into a friend in terms of using those dislocations. It is frustrating, it does hurt short-term performance, but we do believe that if we continue to do that, we'll make back that money and more.
Senzo, what do you regard as noise and those signals everybody's looking for to maybe give you an insight of what's going to happen in the future?
Yeah, thank you for the opportunity. You've already introduced as a person who works for a multi-manager, so maybe I need to give a bit of background as to what that means, because not everybody understands. So as a manager, we actually buy stocks directly. We actually support other managers, which we rate according to our process. So we usually will do manager research and on those that we think that on the balance of probability they're going to over the long term. So I'm a bit of a advantage position because I see everybody in the market what they're doing. And in this volatile environment, as we already alluded, I mean, the returns even on the JSE year to date are single digits. I think they're around about 5% year to date. So how we actually managing that to ensure that we diversify across managers based on their different skills. Some managers would give you like a high beta, so they are appropriate for a market that is actually going up. This year, when we do our manager research, all managers that we've actually classified as managers that can manage volatility using derivatives, as you'll appreciate, interest rates have been ticking up year to date, which means that is available to buy protection. So the managers in our at our who in a balance of probability are very good at buying protection and making sure that they buy defensive stocks depending on their process and philosophy. In our world, that's where we actually been seeing a lot of what you call value. But again, given that I'm a multi-manager, I also manage hedge funds. If you look at returns year to date, hedge funds are the only asset class amongst the few that have actually performed inflation this year. Inflation, give or take, is giving you about 6.7. We've had hedge funds giving you close to 8-10% as a multi-manager, but there are single strategies within the hedge funds that have delivered higher than that and lower than that. So in my world, it's more making sure that in my portfolio construction within the multi-manager framework, I have enough defense and also I have enough exposure to what you call the managers that can they do pride themselves as people who manage volatility.
Rihanna, you used a very interesting term, make volatility your friend. Now, many people, when they get their statement, you know, some people daily, other people monthly, other people quarterly, and they see there's a reduction in value, sometimes a significant reduction in value, you become really emotional and you become concerned. And that is a difficult thing to manage, I would assume, not only for retail investors, but also for professional investors. We don't want to see red numbers. So just expand a bit on make volatility your friend. How should you look at it in the context of, you know, obviously when things are volatile and share prices go up, you're very happy, but when it goes down, it's not always that easy to be comfortable.
No, for sure, and that's a valid point. But I think what we always have to remember is that there are always cycles at play. You know, you get the bottom of a cycle, you get the peak of a cycle, and those broader cycles happen all the time. And so we've got to take a step back, understand that it is a cycle, this too shall pass, where are we in the cycle, and take advantage of those businesses and companies, or in a balanced fund portfolio, have some dry powder if you need to, in terms of being able to take advantage of the opportunities when they become available. But the starting point here is that there are business cycles and they have to happen. And then you've got market cycles that cycle around that. So it's important to actually take a step back and think about that. Then the second part is it really is about sticking to your knitting and being disciplined, because the reality is if you start to change your mind because it starts to fall, you can get yourself turned inside out, because now you'll end up selling the share, it's down 15%, and then, you know, only to find out that a couple of weeks later, the company reports their numbers, things are going well, and the share takes off again. So you don't want to get yourself into that position. You want to actually get yourself anchors in terms of understanding what do I think is going to be a plausible outcome over the next 12 to 18 months for this business at a reasonable valuation. And so as the share is falling and that conviction on the earnings is still in place, you then want to top up that particular company because you know that it will come through on a 12 to 18 month view. And the same thing on the flip side, you know, it might be red for a reason. So one of the lessons that one learns with investing is sometimes your first loss is your best loss. And so you have a brilliant idea that you put in the portfolio. These are the earnings that you think the company is going to make, and something happens and it derails that investment case. The worst thing to do is to actually, you know, it falls a little bit and now you talk yourself into holding on to that position. The reality is it's not ticking the boxes that you needed to invest in it in the first place. So actually, you know, your first loss is your best loss. Actually just remove that from the portfolio and rather allocate to those names that you have higher conviction in. So it's not easy. I'm saying volatility as a friend. It's been a tough year. I mean, if you just take a step back, I mean, with this backdrop, it's the first time in developed markets, it's 1 of 4 years where bonds and equities are both down, double digits for the year. They're 1 of 4 years in the last 100 years. So we are talking about an environment that's been really tough from a developed market perspective, and South Africa in that context has actually stood out relatively well, because we actually are positive in terms of returns at the moment. So there are opportunities, but one has to be disciplined, stick to your knitting, don't get caught up in the market dynamics.
But how much cognizance or how much of the valuations we are currently seeing are actually attached to fundamental analyses? Because, many companies is worth X and tomorrow it's worth X minus 3%. It seems like there's a nervousness currently where valuations are based on a lot more than core valuations. A lot of emotion in the market, and most of the trading taking place comes from professional investors. So how critical is fundamental analysis currently with, in reference to market valuations?
Yeah, so you can go.
Okay.
Because
Sensor, yeah.
As you appreciate, I see a lot of asset managers, including Rihanna. I actually know him. So if you look at the drivers of asset prices, fundamentals is one of them, valuation is one of them. But what we relate is that most of the managers are cognizant of what is happening in terms of the macros. I mean, the first thing that Rihanna spoke about was the headwinds that we are facing. We cannot just make investment decision in isolation. You need to actually take cognizant of what the macro is happening on the macro front. You also take cognizant of the catalyst that is actually going to make your investment be the drivers, the catalyst that is going to take your investment forward, including the sentiment as well. So it is important that we appreciate that even though market goes through cycles, there are cycles where sentiment or momentum or macros are actually driving the asset prices, like this year. I mean, if Ukraine and Russia were to call it truce, you will see that the market would react very differently as compared to where you don't actually see any end in sight. Example again that I can give you is that at 3 p.m. today, China is going to give us an update on their COVID policy, given the unrest that has been happening over the weekend. That has actually made and propelled the market this morning, because market is looking for guidance. And the narrow leadership that we have been seeing over the past year or so, where you're seeing energy being a proper theme, and a bit of financials and banks being a theme, where if you are not on those two sectors in the balance of probability, we've actually underperformed. Then over to you, Ram.
Rihanna?
Yes, sorry.
Just on the valuations and how much, currently we are seeing that valuations are based on fundamentals. It seems to be a bit just disjointed.
Yeah, no, look, I mean, you've got to separate the two, because, I think at the core of what you do, if we're keeping fundamentals and we know what's going on there, we've got a good steer. But the reality is that volatility that you're experiencing in markets is the valuation moving around, because that's the other part of it. So you make your returns from earnings, dividends, and then the multiple moving around. And I think the key here with the multiple moving around is there are opportunities that come from that, right? So it's not just long-only participants like myself that are involved in markets, and global markets in particular. You've got these guys that are playing there. The hedge fund industry is growing. There's lots of leverage products, that have gained traction, that causes these shares to move in multiple directions in a much more aggressive manner. You've got these guys where passive investing, for example, where guys buy baskets of stocks. So instead of like your retailers, in potentially the one outperforming the other, you get these moments where they're all just moving in sync together. And so there are all these dynamics at play. And for us, we know all those things are going on, but it's to take a step back and say, is there an opportunity here? If all those three retailers have gone up in the same direction, but I only actually think the one's doing well, and I own the other one, but I'm a bit nervous about that one. It gives me an opportunity to actually, sell down that. So for us, it's about understanding the marketplace, knowing that there are all these people that are playing there. Forgot to mention all the systematic traders where, they program things into computers, and what lands up happening is, a news headline comes out and these things automatically trade. So it causes the volatility. So we just sit there silently doing what we do on a daily basis, sticking to our knitting, and we try and take advantage of those dislocations. Because the reality is that multiple is moving around, but we have to also have a steer in terms of what we think is fair for that particular company. So I'll give you an example with the South African banks. If you draw a line, like they've done really well year to date, but in between that, they've been going up and down. And so what we've been doing is, because our forecasts are above market consensus for a lot of the South African banks, every time they've dipped lower, we've topped up our positions in those particular counters. So that's just the discipline in terms of sitting there, having high conviction in terms of the fundamentals and taking advantage of the volatility.
Senzo, interesting question from Sir Cassio, and it is as reference to what you've said earlier. And Sir Cassio, interesting name, asks, what kind of derivative instruments are traded in the hedge funds that you refer to, especially those that beat inflation?
So it's not only just derivative. The nice thing about our South African hedge fund industry is that it's regulated of late. I think there was a regulation, but this is 52 that was introduced around 2017, 2018, where it actually gives you guidance as to what you can do and what you cannot do. When I'm talking about derivative, remember with hedge funds, you can make money with the share that is going higher or up, and you can also make money when the share is going down by shorting. So and in addition to that, they are not only their universe is local and global. So what they've been doing is that in times where the VIX or the volatility has been elevated, you will see them hedging the market, whether it's via zero-cost collars or depending on the style of the manager. Sometimes they use forwards and futures, whether locally and globally. But these guys can what you call make money with what you call both markets going up or down. So hence this year to date, they've actually managed, most of them, to actually give you close to about 8 to 10% on a multi-management fund.
Senzo, staying with you, within these volatile markets we are currently seeing, should hedge funds be in your portfolio? Should you look at that as an alternative to try and mitigate some of the risks?
They are meant for that. If you manage a hedge fund that is trying to achieve a certain objective, most of them have various objectives, but hedge funds do well in a volatile environment given the tools that they have at disposal. As I said, they can make money out of a share going down from 100 to 50. They can profit out of that. They can also make money out of a share if they are long it, moving from 100 to 200. So they have what you call return asymmetry in that case, depending on their stock selection capability. So it's a very good environment for hedge funds, given that what I've already said is the VIX. By the way, for retail investors, VIX is freely available on the internet. You can just go on Google and type in VIX. It gives you the expected volatility of the S&P 500 stocks or the US stocks over the next 30 days. So how you would interpret that is that if it's less than 20, it means that the volatility is the fear is not in the market, so there's a bit of stability. Above 30, it means that there's a lot of uncertainty in the market, and in between 20 and 30, the market is undecided. And you see, if you go on Google right now and type in VIX, you can actually track it over time. When there's a lot of uncertainty, it actually spikes up. So you don't have to guess whether we're in a volatile environment or not. But hedge funds were meant for that. And in South Africa, remember, they are regulated now. So there's a lot of what you call risk parameters that they have to abide by in line with the, what you call the retail investor hedge fund regulation.
Rihanna, you're a long-only investor. Do you agree with that?
It definitely has a role to play. I guess when you have a balanced fund, for example, which is what Sen's is alluding to, we are allowed to actually take positions like that within the hedge fund. So we've got a hedge fund position, a small one, inside our balanced funds from our existing team that sits there. Also, in terms of a balanced fund, if you're unable to actually allocate to hedge funds, I guess the reality is the alternative is to just make sure you've got some dry powder to be able to allocate when the market does turn on you, so that you can take advantage of the opportunity. So one parking place for sure. I think hedge funds is a very neat solution in terms of managing through the volatility, and also having some dry powder available.
But did you change the frequency of trading and the changing of positions within the past few years since we've seen this increase in volatility?
Yeah, it's an interesting question. And I think it's a case-by-case basis, right? Because we are active managers and we react to information, and if that information impacts our earnings, then for sure we're going to change our mind. So, for example, there was for example, Richemont is a company that we own over the course of last year, and we almost exited the position in February this year because we had felt that the stock had moved way beyond what we felt the earnings were going to do for that business. Subsequently, the market got concerned, the stock fell quite heavily over the following 6 months. Earnings started to look a little bit better in terms of risk reward versus our analyst forecasts, and we've actually gone back into Richemont, like a month and a half ago. So, in the space of less than 12 months, we almost exited the stock but have gotten back in. But the reality is the share price movements and the earnings movements that we experienced versus our analyst forecasts actually got us in and out of that position quite nicely. So there are moments where that happens. Also, like with the banks example, every time it tips down, we've been topping those positions up, etc. So we are trying to take advantage of these opportunities at the margin. But I think, as an active manager, you're always doing that. I think probably the time frames are a little bit more condensed lately. Is probably the fair answer.
Senta, I'm going to throw it to you as well. Have you changed your trading frequency over the past few years?
It has improved, given that the asset managers themselves do the heavy lifting for me as a multi-manager. So we monitor them a lot. So if 91 is actually doing buying the dip or buying in parts of market weakness, and I see them picking up what you call banks, and I see them picking up retailers, it works into our advantage. So we are a leg removed from the buying of stocks. So if you're looking at the asset managers that we hold, yes, you can see that given that in 2022, actually, there's a high dispersion in terms of returns. And there's been a lot of what you call part of market weaknesses, and you see them actually actively trading, and also increase the usage of derivatives, especially those protection that I spoke about earlier on, where people are not sure whether the level of markets is actually valued correctly. So they will protect against the downside, so that when it's time for the beta, like we saw in 2021, where there was like 30% return in the market. This year, you're not getting that. So essentially, from asset manager side, you're seeing it that the turnover picks up, but it's for the good reason. It's not like they are buying, picking up a lot of the teams that are actually already played out, like the energy. No, you're seeing them picking up with the fallen angels in terms of most of the SAX stocks that we have seen, whether it's education, whether it's retail, or whether it's banks as well.
I invite viewers to send questions to events@moneyweb.co.za or type questions in a chat box on our YouTube channel. Please keep those questions coming. Interesting question from Sean, and I've heard this question actually a few times. What is the role of speculators and traders and hedge fund managers in the current environment? Do they contribute to the volatility we are seeing at the moment, and does that have an impact on your investment decisions? Rihanna?
No, for sure. I think, and it's more evident, I think, in global markets. Yes, South Africa has a dose of it, but in terms of managing the offshore money inside our global balance funds, you are experiencing that on a much larger scale. And I think, as I mentioned before, the hedge fund industry and the advent of these leverage products do cause things like you'll see a lot of pressure on a particular sector, and there's just no news flow or anything, and then all of a sudden that can all unwind, because what lands up happening, especially in the US market, for example, is that the hedge fund guy, if he's doing really well, then it's fine, he gets to leverage up those positions, but it reaches the point where if he's doing badly, he gets a tap on the shoulder and he actually has to liquidate all his positions. And, these are reasonable amounts of money. So what you land up finding is everything that didn't work, he has to unwind all of that, and all those shorts get lifted and there's relief in those shares. So there's a lot of that going on. It causes a lot of, a lot of noise in the market, which is why I'll go back to the fact that we are very earnings focused, locally and globally, in terms of the way we think about things. And so we have our anchors in terms of what we think the businesses are going to do from an earnings perspective. So we spend a lot more time trying to understand the industry dynamics, the environments these companies are operating in, what's going on, so that we have high conviction around those businesses from a bottom-up perspective, understand where we are in the cycle, and so when these movements actually start to happen, like those become opportunities for us, because in the reality is we know that those things don't last long. There's pressure, there might be pressure for a couple of weeks or whatever the case may be, but then it eludes and the fundamentals do come through. But it's definitely not easy. And I think with the systematic traders, for example, they in the US have become, the bulk of the volume that you actually experience there is through these guys. So they become very, very, I think what lands up happening, and Senzo alluded to it, the 20 versus 30 volatility, these guys, when the volatility is falling, they're starting to add more, right? And when the volatility is rising, they are selling. So what lands up happening is when volatility is rising, markets are falling. And then these guys are exacerbating the fall in the markets because they're selling into that. And then vice versa. When the volatility is going down, markets are rallying and they're adding into that. So they just add this extra impetus. So what it does do is, and you have to acknowledge the fact that they are there, is that they will extend your investments to the upside and the downside, and you've got to be disciplined in terms of actually not patting yourself on the back saying, geez, I call the stock really well, it's doing well. If it's gone ahead of what it's meant to be, you've got to actually be disciplined enough to trim it, and go into those areas that are more unloved from the dynamics that are going on in the markets.
Yeah, I think that's an excellent point. When they are there is extreme volatility, prices tend to go down. But Senzo, I want to add to that question. I recently saw a graph regarding cryptocurrency where the volatility was measured over the time of day. And it was very, very clear that the moment the US and US investors or traders or speculators wake up, the action starts. A lot more of the volatility comes from the US, and then the whole of the rest of the world follows suit. Do you also believe that maybe the US is setting the trend for world markets? And again, I think that plays into the previous discussion about valuations. How big an impact do you think the US has on valuations, and do you think it's justified?
So the US as an economy and as a market, if you look at what we track in terms of global equity, they are somewhere around 69 to 70% of the MSCI world, which already tells you that they are a marginal buyer in the market, in the global market. And that's a very important point to say. They will actually influence what is actually happening from an asset price. In a balance of probability, we also follow the US, unless they are what you call other news that are specific to the South African economy and South African politics and other factors. But the US, even how it has evolved from back in the days, even how the accessibility of it now, even the brokerage fees now, I mean, they've come down significantly on the back of the systematic trading or automatic trading, the robo-advice that they have implemented. The US is a trendsetter in many aspects when it comes to the financial market. So if you see a dislocation in the market, more often than not, the marginal buyer is actually coming from the US. That's why the disciplined approach that has been alluded to a couple of times is important, to make sure that you stick to your knitting, you stick to your guns, and you follow your process in terms of what you are trying to do. And also be cognizant of the risk budgeting, because every portfolio needs to have a risk budget. Some portfolios have no appetite of losing money, some they can lose money. So it's important to balance that, because valuation cannot be the only thing that is driving the market. Sometimes it's just a theme that is driving the market. Demand and supply on oil, currently, even at the beginning of the year, February, March, has been the most important thing. And if you do not participate in that, in anything or any share, especially in the JSE, like your Glencos, your Exaros, your Tungela, I mean, those are the shares that are up more than 50%, some are more than 100% year to date, on the back of the fact that it's not that they are cheap. No, it's not valuation, but it's a theme that is actually driving the market. And the marginal buyer, by far, is coming from the US. I mean, not so long ago, the inflation printout in the US came better than expected. The whole global market went up by some 4 or 5%. Is on one day, because the US has actually given an indication that the headwind that we are facing in higher interest rates could at some point come down, in a sense that they will no longer giving us the jumbo hikes. Probably they are going to give us another jumbo hike in December. We don't know, given that on the 13th of December, there is an inflation print release again. But if that comes out higher than or worse than expected, I can promise you the market is not gonna like it. US falls, the JSE falls. But another angle which we haven't touched on in terms of the drivers is actually China. China on MSCI emerging market, which we actually track as well, depending on how you account for Taiwan, could be between 27 and 40%. And it has the onshore shares and the offshore shares. If China opens up the economy, the COVID-0 policy and better human rights, and maybe have a better property market, because that's what they've been trying to unlock, the whole risk on trade comes through. But in a balance of probability, the ones that have that are cheap, the ones that have a valuation behind them, they stand to make or to give you a lot more upside than those that have actually been that have run their race already. So being on valuation in that sense, when there is a lot of tailwinds that are behind you, actually helps, but it's not the only driver. Just because the share is cheap can not mean that it's going to be a re-rate over the next 6 months. It could stay 3 to 4 years being cheap, and we are waiting there and we are underperforming. So always make sure that you are pragmatic in your approach.
Yeah, classical value trap, and I think many investors struggle to understand it fully, and then emotion always influences decisions to get out of a value trap. Rihanna, interesting question. Index funds are massive, especially in the US as well, and With volatility, those index funds sometimes need to rebalance quite aggressively. Does that have an impact?
Yeah, so there are various versions of this, right? You've got the index fund dynamic and then the 60-40 balance fund dynamic. So what you land up at month end or quarter end, if markets have done poorly or well, they have to buy up equities or sell bonds, etc. So those do have shorter term impacts on markets, but not long lasting. So, a week before end of the month, you'll have a fair idea of what the 60-40 balance fund portfolio in the US needs to do to be able to get back to its benchmark. And sometimes, depending on what the circumstances are, that can have have an impact in terms of the market direction at a point in time. But I think the key here is all of these things are leading to one thing. And I think we've been seduced with this drug of excess liquidity and low interest rates for a very long time. And I think all these small things that we're talking about with the systematic traders and the 60-40 portfolios and the rebalancing, we are looking at the edges now. And the reason for that is, as you withdraw liquidity from markets, it gets tougher. So returns are harder to come by in terms of what's going on because it's so volatile. And now you start trying to understand nitpicking all the small things that probably always existed in the past, but because the markets were doing so well and going up in a straight line, you didn't really take notice of them. So I think the key here is, the volatility is happening because we are seeing this withdrawal of liquidity from markets, and the low interest rate environment, that's kind of now played out because now we've got higher interest rates. And so what that is doing, it's making you have to reassess how you're thinking about the world from all these questions, which is fair, but also in terms of saying, with a higher interest rate environment, the businesses that built their businesses, or you bought your house at a certain interest rate with a certain outcome, those things are going to be vulnerable in the current environment with these higher rates, etc. So all of those things one has to factor in terms of your thinking, because the world has shifted a little bit. And so when you think about these index funds and their rebalancing, it's going to become an active manager's dream going forward, especially because if we are going to stay in this higher interest rate environment for longer, those larger stocks in the index are unlikely to be the ones that are going to outperform from an earnings perspective going forward. It's going to be the smaller stocks beneath the surface, or the sectors that are smaller, that land up taking over from your larger tech names, for example, over the next decade. And then what you're going to find is that these index funds will start to struggle, while your active managers, because of being able to stock pick and not need to own those particular things because they're large in the index and benefited from that liquidity rush, will actually start to come through. So the way we're thinking about the world, that with these interest rates and with the change in liquidity dynamics, is that we are potentially entering a new regime over the next 10 years, and that active managers and stock picking is actually going to be, a really good place to be on the global stage. Versus before, you could have just owned those big tech names and sat back and not have to think much about a lot of things.
So what you're saying is that index funds actually enhances the traditional stock pickers market, and that's where active managers play.
So it's going to, you see, so what's happened is they've actually been feeding themselves, because all the flows have gone to these index funds, and what they do is they buy, like Apple, for example. It just, because Apple is 4.5% of the all country world index, Apple gets, every time money goes into an index fund, 4.5% of that gets given to Apple. So it feeds on itself. The larger stocks get larger, the smaller stocks get left behind. And so what I'm saying is that because all the money is following these passive index investments, if you reach a point where, the underlying fundamentals are actually stronger below the surface, and it's not sitting in those big tech names anymore, which is what we think is going to be the case over the next 5 years, then what's going to happen is those underlying stocks are going to do much better than those index funds. And then you're going to, those index funds will land up chasing those other ones as they start to get bigger, if that makes sense. So it's just, a reversal of what we've experienced in the last 10 years, we think is going to happen in the following 10.
A very interesting
maybe
point.
I can weigh in there, because that plays into my space as a multi-manager. Remember, I believe in both index funds, active managers, smart beta, because they all have an environment where they are adding value to the portfolio. So in any portfolio, I am allowed to actually have a smart beta fund or a systematic fund and also an active manager. Because if Rihanna is wrong about the dispersions going forward, I've got this lever in index funds that can actually outperform. If she's right, I also have this lever on active managers that I can use in the fund in the balance of probability. If I have a bias on the active, then I would actually outperform. So it then plays into the multi-management space, because then consistency, which is our currency, and risk management, then it actually defines itself on the back of that. And I do agree, we've seen a lot of inflows into the index funds over the past 10 years. In actual fact, if you look at them over the past 3 to 5 years, the index fund that has been getting a lot of traction has been the ESG factor, which has grown a lot compared to the other index funds, whether they are value, whether they are quality, and what have you. But the reality is, this argument is what we have in our organization, because we believe index funds and active managers can coexist.
Well, next question is, how on earth do retail investors make decisions in this environment, even if there are because there are so many diverse views from professional investors? This is a very, very complicated market we have at the moment, and I foresee it will remain in this state for many years to come. So, Rihanna, there is disagreement amongst professional investors. Do you think there is space for retail investors to actually take calculated decisions, not purely based on fundamentals, but to try and also build a portfolio and pick more winners than losers?
I think everybody's circumstances are different in terms of what the money is going to be used for. Is it money you need to save for a rainy day? Is it money that you don't need? And with that risk appetite comes the dynamic of how you're going to invest that money. If it's money that you do not want to, that you want to see grow over time, and I think you need to rather seek professional advice in terms of how to do that, which managers to actually allocate to, etc. Because it is getting tougher at the moment. There's no doubt. It doesn't mean that you can't have high conviction on a certain stock and potentially do well as a retail investor if you take a punt, etc. So it doesn't mean that that's not possible. But I think what's becoming more important, given the environment that we're going through, and it has been, I started in the markets in 2008, and it's been a very tricky environment to manage money for, as a professional investor, is that you want a diversified, risk-adjusted portfolio. And to get there, you really need, a lot of backup in terms of support, in terms of research and risk management tools, etc., which are, if you can't lose the money and you're worried about it, I would suggest rather get advice.
Do you think, Rihanna, that the risk profile of investment markets has changed over the past decade or so?
Oh, for sure. So it's that whole addiction to that low interest rates and liquidity environment, right? And what that actually did was, I touched on it a little bit, but with low interest rates, what lands up happening is you plan accordingly. So there are lots of businesses today that have been built on low interest rates. And so now when you get an unwind of that, it's going to cause vulnerability in the system. So excess liquidity, what it does is you get Kathy Wood, I don't know if you know, she's got this ARC Innovation Fund, invests in a lot of unprofitable high growth companies. See what liquidity is done. That particular instrument is down 80% of its peak. With excess liquidity, you've got NFTs. So you had the recent news of Justin Bieber, who just in January bought something for $1.3 million, and now he's lost 95% of his money as the liquidity is getting drained, because those NFTs, a picture of an ape that he bought for $1.3 million, and he's lost 90% of his money. And now we're also seeing, like, as you withdraw this liquidity, what's happening in the crypto markets. It's like dominoes, right? One of these crypto guys are falling after the next. So there's a lot of things in terms of, when the tide goes out, you see you swimming naked, and that's the risk that was put into markets. You have all these mini bubbles that got created in different spheres because of the fact that money was abundant. Tina, there is no alternative. Guys didn't want to put money in bond markets because yields were 0 to 1%, so money was chasing ideas and chasing any growth that was out there. Market dynamics have now shifted, right? Rates have started to go up, the liquidity is getting withdrawal, which is where it comes in terms of our thinking, in terms of the cycle and how things are going to play out on a go-forward basis in terms of where you make money going forward. Because now bond yields are sitting at 4% in developed markets, so it's no longer at 0 to 1, so it becomes an option for investors. So I no longer have to pay 30 times sales for a company that's not generating cash flow because I'm wanting a return. I can actually just put it into a risk-free asset at 4%. And that just changes the dynamic in terms of the way you think about where to put money going forward.
Interesting question from Ben regarding our discussion about index funds. Do you think, or do you suggest that there may be a bubble developing within the index market, or that it may have the effect of a bubble, in the near term? Senzo?
I think bubble is a strong word, given that, remember, also not all index funds are made the same. When you talk passive 100%, where and maybe with time, given that they rebalance, remember they also have rules like what's called active managers have the process. They also have rules. So the thing self-corrects. There's going to be a time where the volatility is actually elevated, as we actually expecting over the next 6 months. But the moment everything and the market gets clarity as to what is happening, and you get a bit of beta, they are back in play again. Because in a beta-driven environment like 2021, the index funds in the balance of ability will outperform. The active managers, on the other hand, some will outperform, some will underperform given their positioning. So it is a matter of where are we in terms of the cycle? Is the dispersions in the market from a cross-sectional volatility, or the best performing share minus the worst performing share, high or low? In a case where it's high like this year, active managers thrive. But in a case where you're getting a bit of clarity on the US Fed interest rate decisions, if they pivot and say they're not longer going to hike interest rate, they're actually cutting interest rate, those index funds could come back and actually outperform. So bubble is a strong word, and I don't think they are made equally as well, because another index fund could be a momentum fund. Guess what the momentum fund is buying of late? It's buying what is running. So it's buying energy stocks, it's buying financial stocks, which have actually done better than others. So if that theme continues, the momentum fund can actually outperform a lot of active managers in that space, because it has the right exposure. So the market will self-correct, and there's going to be cycles, and that plays very well in the hands of the multi-manager like myself.
Yeah, self-correct is also a pretty strong term, but time is not on our side. Interesting question from Sean again. There are many active managers who are benchmark huggers, and they have a low tracking error, Rihanna, and yet they charge active management fees. Is that a fair comment for most asset managers, or is it a focus that you watch the index and adapt your strategy accordingly?
Look, I think we aim to hold 30 to 35 shares in the portfolio at any given time. So when we put high conviction behind names where we have high conviction, and vice versa. And when things are uncertain, there will be points in time where you are closer to the benchmark when there is no high conviction. But whenever there's high conviction, you can guarantee that we've got those positions on in terms of the framework that we've got. I don't know, Senzo's probably in a better position to talk about other managers.
So,
Senzo, over to you.
Yes, you are correct. So when we do our manager research, remember that's our specialty. Alex Forbes, without manager research, will strike. We question and try and understand the manager's portfolio construction and implementation approach. If you come out and say you're a benchmark hugger, we classify you as one. If you come out and say you are a high conviction, unconstrained asset manager, we also classify you as one and also compare you with shares on there. So there are some managers who say that they are high conviction, but given that we have tools to monitor your active share, your tracking error, and also your active position, there is no way that we will not question you. We meet with our managers at least on a quarterly basis, some on a monthly basis. So it is an ongoing monitoring process, and if you are not truthful about your approach, it gets picked up very quickly and decisions get made.
Rihanna, you spoke about you only having around 35 shares in a portfolio, and that brings up the question of portfolio construction. And that's something many retail investors struggle with. You know, how many counters do you need to have in a portfolio? You know, over diversification is also an issue. How do you approach that portfolio construction?
No, that's it's an interesting question, and I think the key here is you can have high conviction on a particular idea, but markets always keep you humble. Left field events can happen and come out of nowhere and completely knock the wind out of your sails. So to make risk-adjusted returns for clients, there has to be an element of diversification. So yes, I can have high conviction on the South African banks, but I'm not going to put 70% of the portfolio in those 4 particular counters. You know, that gets managed through a risk management framework. So before I put on a trade for a particular counter, we've got systems where I can actually see what the impact is on the portfolio. So, you know, if I want to take it up to 4%, 5%, whatever the case may be, I can run a dummy portfolio to understand the risk what risk I've added to the portfolio. So that we can do from a bottom-up perspective, looking at the active share tracking error. And then on the other side of things, we stress test the portfolios from a top-down perspective to try and understand, have we, from our bottom-up conviction, gone and put anything unintended in the portfolio in terms of a macro outcome, you know? Because the reality is yes, you can have high conviction on something, but you can't bet the farm and put 100% into that particular thing. You can lean in the direction, and so all of those things are in place. So a diversified portfolio is key in terms of getting those risk-adjusted returns. Yes, you know, like you can be a superstar and get certain things and put four shares in your portfolio and do really well. But I must say, experiencing what I have for the last 15 years, markets always keep you humble, and you cannot predict everything. Left field events do come. We've had many of them over the last 18 months, and in that type of dynamic, you actually want to have some offsets to some of the positions that you've put in place.
Yeah, as we've spoken earlier, it's not so easy to pick the winners. Only 25% of companies outperform the index over a certain period. Sencho, just lastly and quickly, how do you approach portfolio construction?
So for us, as a multi-manager, we have drivers or factors that we believe are going to be rewarded over the long term. So we believe valuations are important, quality is important, momentum is important, especially in a small market like South Africa. Also, earnings, what you call revision and earnings growth is also important, but more the revision than the growth itself. Then small caps as well over the long term in a balance of probability will also outperform, and a bit of what you call low volatility. You don't want to only have stocks that have high volatility. So after establishing those 5 or 6 factors, we then go out from a manager research point of view and say, how do we then execute based on our what you call belief in the process? So we will go out there, look for value managers and value smart beta providers. We go out there, look for momentum managers and momentum smart beta providers. We don't discriminate. Quality as well. Then we combine the portfolio, put it in a risk system where we say, okay, given that we want exposure to quality, to value, to momentum, in a balance of probability, what are we getting if we combine these managers based on our ratings? Then what we strive for is positive exposure to the factors that we believe are going to be outperforming over the long term. There is a combination of active managers and also a bit of smart beta in an index. Then we have also have a cognizant of the macro environment, where we run scenarios and say which managers will do well in a high volatile environment like we find ourselves. Then you can actually combine them. So it's a combination of the managers.
Senzo, Rihanna, thank you so much for your time today and for sharing your insights. Time has caught up with us, and thank you for sharing your insights. We'll be back after this break, and we were looking at investing offshore for returns and residency benefits.
I'm Kieran Ryan, and I host the Moneyweb Crypto Podcast. The Moneyweb Crypto Podcast gives investors a window into the world of crypto that they did not have before. One of the things we do is we introduce them to the white hats in an industry that has its fair share of opportunists and scamsters. Remember, this is an unregulated area of the market, so one needs to be especially careful. If you're going to get into cryptos, and the stats suggest a high percentage of people are at least looking at it, then you need to enter with eyes wide open. So join me and my expert guests weekly on the Moneyweb Crypto Podcast on moneyweb.coza, the Moneyweb App, Apple Podcasts, and Spotify.
The Moneyweb Crypto Podcast, hosted by Kieran Ryan. Moneyweb, your trusted source for business and investment insights.
We've just recorded the first episode of Fix SA with Standard Bank's Sim Shabalala. Among the many topics discussed, leadership in South Africa and why technology in education is so important. A magnificent conversation.
I love the definition of leadership by Napoleon, which is a leader is a dealer in hope. The second one, I think, is, and again, talking about this podcast, Einstein said, learn from yesterday, live for today, hope for tomorrow. The important thing is not to stop questioning. And that's what you're doing with this podcast. And I keep saying to you that this is just an incredible piece of work. So bravo for that.
Here's an invitation. Join me, Jeremy Maggs, and South Africa's top leaders on the fortnightly Moneyweb Fix SA podcast. Listen on moneyweb.co.za, the Moneyweb app, Apple Podcasts, and Spotify, or follow Moneyweb News on social media for more updates. Moneyweb, your trusted source for business and investment insights.
Moneyweb Frequently Asked Questions, Part 4, the Moneyweb Insider Gold Premium Subscription.
Welcome to Part 4 of the Moneyweb FAQ series. I'm Ryk van Niekerk, and today I'll highlight a few other valuable tools to answer the question, what are the benefits of an Insider Gold subscription? Whether you are a novice investor or a money-savvy professional, a premium subscription offers several tools to keep subscribers informed of all the daily developments and announcements related to listed entities. One of the most popular tools is our live SENS service. With a few clicks, you can access the latest SENS announcements as and when they are released. As you may know, traditional SENS announcements are notoriously challenging to read. However, you can access PDF versions of all SENS announcements, making them easy to read and to save. Subscribers can also elect to receive notifications when companies they follow release new SENS announcements. And exclusive to Insider Gold users, we offer a portfolio tool where subscribers can create their own share and unit trust portfolios to monitor their performances on one screen. Go to moneyweb.co.za and click on Sign Up and choose the monthly or yearly Insider Gold subscription options available.
Moneyweb, your trusted source for business and investment insights.
I'm Simon Brown, and I host the Moneyweb Now daily podcast. If you're an investor, Moneyweb Now gives you sharp insights into what's happening in local and global markets, with expert market commentary, CEO interviews, economic analysis, and expert opinions on everything market and investing related. As a DIY investor, keeping abreast of important market-moving events, updates and results needn't be time-consuming. Join my guests and I as we navigate the investing world for you every weekday morning in 20 minutes. Live at 6:30 a.m. on moneyweb.co.za or the app, with the podcast available just after 7.
Moneyweb Now. Business, finance, and investment news. Moneyweb, your trusted source for business and investment insights. Moneyweb Frequently Asked Questions, Part 5. How to use the Click and Advisor tool.
Welcome to Part 5 of the Moneyweb Frequently Asked Questions series. I'm Bitumelo Nzoko, and in this episode, we'll share how to use our Click and Advisor tool. Moneyweb's Click and Advisor offering provides financial advisors with the unique opportunity to grow their investor-based audience and attract new clients. Advisors can choose between having just a Click and Advisor profile, which starts at only 650 Rand for 3 months, or the more extensive Moneyweb Insider Pro subscription, which further develops your professional persona as you're able to submit your own opinion pieces and answer readers' questions. This option also includes all the benefits of a Moneyweb Insider Gold subscription. Both options include an advisor profile page with your contact details, company logo, geography, areas of expertise, accreditation, and awards, and can link to your website and social media accounts. Your profile is searchable on search engines, promoted on rotation in our highly popular morning newsletter Moneyweb Now, and is listed on the Moneyweb app. Once you sign up, you can log in, view and assess your profile statistics on your dashboard at your own convenience. Here's how you can join today. Start by going to the moneyweb.co.za homepage, click on the menu tab, scroll down to Click and Advisor and select the Sign Up for Click and Advisor option. Choose between a profile only or the Moneyweb Insider Pro option. Alternatively, to speak to a consultant, please email pro@moneyweb.co.za. Here is what some of the advisors from our Click and Advisor community have to say.
Hi, my name is Tulisile Nkomo. I am from NFB Private Wealth Management. I have been part of the Moneyweb Click and Advisor for the past 3 years. This platform has been a powerful tool in helping me build and grow my professional profile, as well as educate the masses of South Africa about financial literacy. I'd encourage other financial advisors to consider joining this platform, as it helps in growing your own book and also helps to empower other people by educating and promoting financial literacy. Thank you.
Good day. I'm Elke Brink from PSG Wealth in Pretoria and Stellenbosch, and I've been working with the Moneyweb Click and Advisor team for probably 3 or 4 years now, and this has definitely been an exceptional opportunity for myself and my practice. Not only is this really a fantastic platform for you to educate readers and of course reach a much bigger scope of clients, but there's definitely a big opportunity for leads as well, coming from the articles and from the opportunities that Moneyweb provides. So yes, I would definitely advise any advisor to get involved. It has meant quite a lot to me and my practice for the last few years, and yeah, go check it out on moneyweb.co.za.
You can go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels for more information.
Moneyweb, your trusted source for business and investment insights.
Hi everyone, welcome back to the Moneyweb Better Investor Conference. My name is Fifi Peters, and I am excited to be joining the conference for the very first time this year. So my session is on investing offshore for returns and residency benefits. And I'm sure many of you will be aware that there has been recent changes in our regulation that does allow you to take a whole lot more money outside the country right now for investment purposes. And it's a great thing, really, except a number of places in the world right now are looking pretty scary. If we start off with what has happened in Europe so far this year, where stock markets over there are lower because of the Russia-Ukraine war that continues to ravage on with no end in sight at this present moment in time. If we skirt over to another continent, over in Asia, where that part of the world has given quite a number of investors a lot of sleepless nights and probably a few extra gray hairs. If we take a look and we take stock at that stock market right now, the Hang Seng Index most notably down 25% so far since January. And then going over to the US, where that economy is popping right now, everything is looking pretty sweet, except the stock market, which also has pulled back quite a bit, with the technology-heavy NASDAQ index by far the biggest loser on that front, down 30% since the start of the year as a result of inflation that is looking a lot more sticky than was initially expected, and the implications for interest rates that could rise more aggressively, just give and take. And so you look at what is happening in the rest of the world and you contrast it with what is happening here in South Africa, where we have had record load shedding in this country, where our inflation has also been pretty rampant, where our interest rates have risen faster than most of us would have liked, and also where our economy has mostly underwhelmed. Despite all of this, the South African stock market hasn't done so badly. In fact, outperforming quite a number of its global peers. And so it's against this context that we're asking, can offshore investments right now give you a lot more bang for your buck? Or, like Dorothy said in The Wizard of Oz, is there no place like home right now? So I'm posing this question to David Lurkey. He is the head of equities at Sanlam Private Wealth, and also soon to be a chief investment officer over there as of January. David, good afternoon, and thanks so much for joining the conference.
Afternoon, Fifi. Thank you for having me.
So let's start off then with what we should be doing right now with our money, just given the fact that the grass is looking pretty green here in Mzansi, in South Africa, our land, from a stock market perspective. Why then should we be thinking about taking money elsewhere? Just give us the bigger picture.
Right. Fifi, so there's multiple things to think about here. Firstly, when you're investing, you've got to try and think quite long term. So, don't just worry about what's happening today. It's about much more the long-term situation, how things are playing out over an extended period of time, because one doesn't just invest for a year, you invest for many years. But right now, markets probably looking a lot more attractive than they did this time last year. This time last year, we said, international markets were looking very expensive. We didn't expect them to be down 20% this year, but certainly we thought they were very expensive this time last year. So we've had relatively little money offshore and relatively more in South Africa. But I think the key point there is it's a relative thing. You always want to have some of your money offshore, and you always want some of your money in South Africa if you're a South African-based investor. And really, it's just a case of how much you have in which geography at which time. And I can show you some pictures if you'd like to help that thought process.
Yeah, and especially in this current environment where the outside world has been looking slightly less appealing than here at home. But as you said, it's not just about what has happened in the past year, what has happened in the past 3 years. It's about the bigger picture. So just give us that bird's eye view of the performance of South African equities versus our global peers.
Right. So hopefully this is up on everybody's screens right now. This is a 50-odd year chart. I think it's 51 years of data we have here of the South African market, which is the black line, relative to global equity index being MSCI World Index. That's the blue line. So if you'd started with just 100 Rand all the way back in 1971, now, and you'd just kept all your money and all your dividends in the markets in South Africa, now you'd have near enough to 400,000 Rand after 50 years. If you'd kept it in global equity markets, in Rand terms, you'd now have about 200,000 Rand. So over that very extended period of time, it's certainly been better to have had your money invested in South Africa. What the chart only shows a little bit just because of how the scales work. I'll show you a better scale a bit later. But what it doesn't show you is that the ride as a South African investor has been a little bit more bumpy. It's been a little bit more volatile in our market relative to global markets, even in Rand terms. But you have been rewarded for taking that risk by investing in an emerging market like South Africa, rather than investing in global equities, which is predominantly sort of around about 70% of global equities are actually American businesses. But yeah, the statistics, certainly looking backwards, say that it was better to have been in South African equities. And I'll maybe show you a picture a little bit later where I show you that if you get the blend correct of having both South African equities and global equities in your portfolio in roughly the right ratio, you can actually outperform either of these lines when looking backwards, and at the same time get a little bit less volatility, so a smoother ride along the way.
So just if we drill into the equity space and which parts of the markets have done pretty well and have given investors these kind of returns over this time period, where has the action been in the local equity market, as well as if you can just paint a picture of which part of the global equity market has been the safest place and more lucrative place to make returns in the recent while?
So I think firstly, the safest place is often a very dangerous thing to think about when you're thinking in terms of equity markets and stocks. Often things that look the very safest have not delivered the kind of great returns you would hope. You know, you look back a year ago, roughly, everybody was saying things like Facebook and Amazon, fantastic businesses, wonderfully safe places to keep your money, except Facebook is down 70-odd% so far this year, and Amazon's down quite a lot as well. So, you know, if you do, however, look over, say, the last 10 years, certainly US tech has been the place to be, call it since the financial crisis. That's been the better place to be. And post-COVID, for sort of 2020 and 2021, US tech, fantastic. 2022, terrible place to be, US tech. You'd much rather have been in something like energy, and also a pile of really boring stocks. Tobacco, for example, which everybody knows is bad for you. Tobacco stocks have actually outperformed quite substantially this year. But really, I suppose the recent action has been in energy, and then obviously, you know, you could have made some good money in defense stocks, something like General Dynamics. I think I saw this morning up around about 30 or 40% year to date. They make, amongst other things, tanks and some aeroplanes. So, you know, multiple different places. But I think rather than thinking about sectors that have done well over any specific time frame, you should rather think about making sure a portfolio is appropriately balanced, because it's very, very difficult. And nobody has shown themselves to be able to achieve it consistently. It's very difficult to know exactly what's going to be the perfect place to be. And the world, of course, changes all the time. I don't think many of us this time last year were banking on a war in Europe for most of 2022.
Yeah, I think very few people, in fact. But David, take us through to your next slide, and also perhaps comment on what a appropriately balanced portfolio looks like in this environment.
Right. So maybe let me take you through a couple of pictures here. I'll get to the second part soon enough. But this chart really just shows you South African equities relative to global equities. So I just based it at 1 back in 1971. And essentially, when the line is trending upwards, that's when South Africa has done better. When the line's trending downwards, that's when global equities have done better. And really what you can see sort of in post-democracy South Africa, what I've highlighted here with the red lines, is there have been sort of 2 periods where South Africa has underperformed and 2 periods where we've quite nicely outperformed relative to global peers. Obviously, the big one there from sort of round about 2000 to round about 2010, that's really when the resources space did particularly well. South Africa, of course, quite a resource-intensive country. And the other side to remember is that in 1999 and 2000, global markets were exceptionally expensive. So, that's the time when you had things like Coca-Cola trading at 60 times its earnings. When you had, it was at the time of the dot-com boom when, you had crazy things listing like pets.com on no information and no business plan. It feels a little bit like crypto in the last 6 to 12 months. And so from that very high point where global markets were doing exceptionally well, then the pendulum swung towards resources. We saw the rise of China importing a lot of commodities from the rest of the world. That obviously did very well for South Africa until a little bit after the global financial crisis. And then sort of in the post-GFC period until COVID, you've really seen the rise of internet stocks doing particularly well, but actually having real cash flows to back them up. And in general, in that very low interest rate environment, the market loved quality. So a sort of a high quality philosophy did particularly well from, call it 2010 to 2020. We're starting to see a little bit of an uptick now, just the last 18 months to 2 years from South Africa on a relative basis. Time will tell whether that is has legs or not. But do remember that a large proportion of our local market anyway makes its money offshore. Our largest resource companies have mines all over the world. Obviously, 2 of the other largest stocks on our market, Richemont and Naspers or Prosus, their business, a lot of that is in China. So, don't think of our local market as purely about the South African economy. And then maybe I'll skip this slide and maybe we can come back there and we can come back to some of those other pictures. But to answer your second question around what a good portfolio looks like, it's really about blending all the different pieces. Remember, one of the key tenets of investing is that you want to get the highest return for the lowest risk. And typically, if you want higher return, you're going to have to stomach a little bit more risk. But what happens is if you manage to effectively blend the different components of your portfolios, and here on this slide I show components of what I'd call a global multi-asset portfolio. And what we're showing here is the correlation of returns between different asset classes. So a correlation of 1 is a perfect correlation, and that's the only things will correlate at 1 to themselves. But if you say look at the first column there, it shows you how different assets correlate to MSCI World Index, which is global equities essentially. And what you want are the other building blocks within your portfolio to be quite uncorrelated, and if possible, even negatively correlated to the main equity building block, because that will typically, for long-term investors, your largest component of a balanced portfolio will be in equities. And then the other pieces, you want to make sure that they are less correlated. So, for example, I've highlighted two blocks there, that red block where I highlight multi-strategy fund B. I on purpose leave everybody's names out here. But that multi-strategy fund, which is supposed to be a less correlated asset to global equities, actually the statistics tell you it is quite correlated. By contrast, the one above it, the multi-strategy fund A, that's the one we use when building our client portfolios. That one has a slightly negative, but basically uncorrelated set of returns to global equities. And you want to populate your portfolio with pieces like that. You would also look within the bond space, this bond fund B, lower down, that's the one you want. You don't want, for example, a credit fund, because then you're kind of just exposed to the same set of risks and drivers as the equity component of your portfolio. So a credit fund, by that I mean corporate credit or corporate debt. You'd much rather have the defensive portion of your portfolio, being the debt or the bonds side of your portfolio. That you'd much rather have in essentially dollar-denominated US government bonds, because that's got the lowest correlation typically to global equities. So that's sort of a little bit of advice on how to piece it together. I can go into more detail if you would like me to.
Yeah, I think I would. Just in terms of... Okay, no, go ahead.
Right. Fifi, maybe this picture can sort of help illustrate a little bit what makes sense in terms of a diversified portfolio. So I showed everyone the two lines earlier of South African equities, which on this chart now is the kind of orange line, and then global equities, which is the black line. And however, if you go back and you test the data, and if you'd simply had a portfolio made up of 65% global equity, 65% South African equities, and 35% global equities, and you rebalanced it to that ratio every 3 months. At the end of each quarter, you rebalanced it to that ratio. Then you get the thicker blue line here. Now, what's important, firstly, is the blue line is less wiggly on the screen, believe it or not. It is less volatile. More importantly, the blue line has given you a higher return than either of the components. So you've kind of won twice here, where firstly, you've gotten more return in total over the 51-year time horizon here. And secondly, you've done it with less volatility. And less volatility is a wonderful thing for individual investors, because it means you're less stressed out about the running of your portfolio, because your returns don't look as dramatic. Let's see if I can illustrate it. Here we go. This slide sort of illustrates it. This is just using some statistics. Don't worry too much about the back end. But essentially, the higher the number here, the higher your volatility. And you want to have lower volatility. And again, you can see the blended portfolio, the standard deviation of returns of 9%, actually got lower volatility than either the South African equities or the global equities. So you've gotten better returns than either of these options, and you've had lower volatility or lower risk than either of the options by blending them. And that's just talking within the equity space, South Africa versus international. But the concept of getting better returns and lower volatility exactly works together with what I was showing you earlier on that sort of multicolored boxes of blending the right kind of assets with each other to get the right outcome.
Okay. So essentially, what you're saying is that the right kind of blend between global and local right now can give you a lot more peaceful nights of sleep. But let's dig further into that blend and the science behind your 65% allocation in South African equities and the remaining percentage in offshore markets. How did you come to that exact split? And especially given the fact that recent regulation now allows you to take even more money offshore, why could that potentially not be the right blend?
Right, so we got to the 65-35 by basically looking back at the data, using history as our guide. And if you've got enough data over a number of years, that should be a pretty good guide, and that can sort of inform your base case scenario. So for us, this is just talking in a pure equity portfolio, just the blend between the South African component and the global component. You'd have around about 35% in global equities. But even if you were to take a multi-asset portfolio with bonds and stocks, maybe a little bit of cash, a little bit of a hedge fund possibly in there, and you combined it together, also pops out the data to tell you that around about 35% has been the right number on average. If you've got to pick one number and stick with it for multiple years, that's the kind of thing you'd like. What I love about the new regulations is they now allow you to go to 45% offshore, should you so wish. So in the past, we couldn't go more than 30% for pension money. So the problem there is we were kind of always at the limit. So you couldn't move a client's portfolio around appropriately to express your views, because you kind of always wanted at least 30% offshore. Now we have the capability to take more money offshore in pension funds, and we can decide when times are appropriate for that, we'll do so. When they are less appropriate for that, we might have more than 65% in SA. And it's lovely to have the wiggle room from the regulator to be able to do that, because it should, with time, facilitate superior returns for the South African investment industry as a whole. So I'm actually quite excited about that. But if I look at markets right now, as I said, beginning of the year, global markets were very expensive. We were distinctly favoring South Africa. At this point in time, I think our market is still probably looking a little bit more attractive on the equities side than global markets, but not dramatically so. So we're not substantially away from this sort of 65-35 split. I think we sort of maybe 66, 67% South Africa, very small deviation from our kind of default level. But what's quite interesting is global bonds, which at the beginning of the year were yielding you, 1% or something pointless, and in an 8% inflation environment. Now those yields have come up quite a bit. So global bonds are starting to look a little bit more interesting, but then South African bonds are kind of interesting as well. And it's because we've got more interesting bond yields as an option that that's part of the reason equity markets haven't done so well this year, because last year there was no alternative. Last year you could just be, there was no point investing in bonds for 0.5% or 1% return from a US government bond. Now you can get a reasonable return there, so you can actually have a better balanced portfolio in a lot of ways. Sorry, a little bit of a mouthful, but hopefully that gave you some context.
Welcomed mouthful, quite a lot of food for thought there. But we've got some questions that are coming through from the audience that are tuned in. But I just have one for you before we do take those questions. Just what do you mean by offshore right now? I mean, you've mentioned in terms of the bond market, your preference for US bonds or US treasuries. But what makes a good offshore investment right now, just given everything that's going on in this world?
Right. I hate to be boring, but it's the same as always. It's paying the right price for the right asset. So that means if you are within the equity space, for example, you want to make sure you are paying the right price and preferably buying businesses that have a lovely long future. So you want to be paying for you want to be paying as the price for a good business and buying a great business. Great businesses can take many forms. Everything from something like Google, which I think is a fantastic business and will stand the test of time. Other things like Johnson & Johnson, I think is a lovely set of global brands. There's some other interesting stuff in the sort of more corporate focused IT space, maybe something like an SAP, quite an interesting business. And there's a lot of interesting stuff in the medical space. But most important is you want to pay the right price. So if you can pay the right price for the asset, then you'll probably do quite nicely. One also has to sort of look through current cycles. So, right now, oil companies look particularly cheap. We do actually think they offer some good value. We are overweight energy in our client portfolios. It's worked very nicely for us so far this year, and hopefully it will continue to do so. We have trimmed a little bit, taken some profits there. But we think energy offers a lot, but don't expect oil to stay at $90 forever. We expect it to come back probably only in 3 years' time, but back down to say $60 or $70 a barrel. But overall, what you want to make sure is that you have an appropriately balanced portfolio with the right different businesses in it. Something like a Taiwan Semiconductor, very, very interesting business. They're the biggest maker of silicon chips in the world. Fantastic, fantastic business, great returns on capital. All looks beautiful, the price looks great, and then you realize it's in Taiwan, and you listen to some of the comments out of the Chinese leadership about where they think Taiwan should be, and you realize that's why it's quite cheap. So, one must keep your eyes wide open and realize that predicting the future is a vague science at best. And if you appropriately diversify your portfolio, you can still get fantastic returns. But you don't want to think that you're too clever. That's how things can get a little bit dangerous.
Okay, so David, I'm going to take some of the questions coming through from the audience members right now, and to the point that you've just left us on about the appropriate diversification of the portfolio, because the question I'm going to take first relates to your slide on the correct blend between South Africa and global, the slide around correlation. And the question is coming from Sean. Hi, Sean. And the question is saying that correlations across assets change and look different over different periods of time. So how then do you use this or not looking forward?
Yeah, I suppose the first thing is, I can't explain an entire investment philosophy in a short session like this. But what we do is we are always assessing whether we think correlations are going to change or not. And the other thing to be careful of is that over short terms, correlations can be quite different, but over longer terms, you get a little bit more of a clearer idea. But yes, we're constantly assessing what may change. 2022, for example, fascinating year. First time you've ever had such a disaster across basically all asset classes. At one point, I think it was around about the end of September this year, global bonds were down 20% and global equities were down 20%. And normally those don't correlate. So you had quite a difficult situation. That was all in dollar terms. And yeah, you do need to make sure that you have the right set of assets. So if I just show this, I'm not sure if the slide is up, but the Multi-Strategy Fund A, that is a global hedge fund that employs a variety of strategies that we utilize for our clients in the global balanced space. And that multi-strategy fund has a long history of basically zero correlation to anything else. And at times it does well, at times it maybe does a bit less well, but it's generally returns that you can trust. They normally try to get about sort of 6% per year in US dollar terms, employing a variety of sort of market neutral strategies. So you can look at that and sort of engage with the provider there and make sure that you understand their process. And, over a multi-year relationship with that external provider, you can make sure you've got exactly the right tool in your toolkit to do what you want it to do. And it's been particularly useful for us over the last few years, maybe before 2022, when global bonds haven't really delivered anything. And of course, this year, global bonds down a lot. That fund has only returned 2% in dollars this year, but compared to global bonds, who's kind of the other defense in your portfolio, that has really worked very well. So, global bonds down, I think now about 16% year to date. That fund up 1 or 2% in dollars year to date. It's really done its job.
Right. David, can you give us a bit of flavor of the constituents that are in this fund you were talking about that's done so well for you? Maybe not individual company names, but just a sectoral picture, perhaps, of where this fund is skewed more to and less away from?
Fifi, I won't tell you about that one because that's some quite complex market neutral strategies, as in long short things, trying to take advantage of weird sort of pools of liquidity in the market. What I'll rather tell you about a little is our primary building block that we use for our clients in the offshore equity space. That building block has a sort of global high quality philosophy. So it invests in global businesses and particularly is focused on high quality. So that's high returns on equity, long life of business, long runway ahead, normally quite a good growth story up ahead, low debt, and just franchises that should be able to continue to grow for an extended period of time. Where they are currently invested, their philosophy means in that component, there's not financials, there's not energy. We compensate for that elsewhere to express our own views. But in that component, we've got a reasonable amount of tech. There's some China in there, which has actually bounced back very nicely over the last 6 weeks or so, mainly Chinese tech. They've got quite a lot of medical stuff. There's a little bit of tobacco in there. But the key thing that sort of pulls all of that together is that it's a high quality philosophy. So typically the businesses they own will be higher margin businesses, higher moats around their businesses. And that building block has certainly outperformed the market so far this year by about 6 or 7 percentage points. So we're quite happy there. And yeah, it's an interesting place to be. There's a lot of individual stocks that one can talk about. And certainly, one of the things they sold recently that had done fantastically well for them, something called Elevance. It used to be called Anthem. It's essentially a health insurance business in the United States that this time last year was looking terribly boring, and the market wasn't interested in boring this time last year. This time this year, the market loves boring because it's been a very difficult year, particularly for tech. So, that sort of boring business has heavily outperformed the rest of the market. But now the price is too high, so they've sold out of that just the other day and recycling that capital into more exciting opportunities.
Okay. David, I'm going to take another question from the audience, this one coming from Vincent Nwambis. And he's asking, is the volatility of illiquidity a problem? And which one of the two can you do with in the medium to long term?
Well, Fifi, could you just repeat that question for me, please?
Yeah, no, it also didn't make 100% sense to me, but I'll give it another go. So essentially, is the volatility of illiquidity a problem? And if you had to choose between either one, which one would it be over the medium to long term?
I wonder if Vincent potentially means all. But so maybe just to talk a little bit about volatility, a little bit about illiquidity. Hopefully I can answer Vincent's question. Volatility in itself is not a problem. And often I get excited by volatility because that creates opportunities. Volatility typically will mean certain assets will trade above their fair values quite materially, and others will trade materially below their fair values. That's when I get excited. I can sell expensive things, recycle the money, buy cheap things, very happy. Illiquidity is a different story. If you're going to invest in illiquid assets, you need to probably be a reasonably sophisticated investor. Also make sure that it is a pretty small component of your portfolio because it is illiquid. So if something goes completely wrong and you suddenly need to access all of your savings, illiquid assets are illiquid, so you often can't access that money in an emergency. So be sure that you have enough money to solve your problems for the next 5 years if you're going to be locked into that investment for the next 5 years. Illiquid investments can make great investments. I think there's a definite scope for something like private equity in a portfolio for a high net worth individual. But illiquidity is a dangerous thing in itself. And if Vincent was asking about global illiquidity in terms of money supply, we're seeing the markets, with higher interest rates and the end of quantitative easing, and you're now getting quantitative tightening coming through, where governments or central banks are withdrawing liquidity from markets. That's part of the reason that markets are down this year. There's still ample liquidity out there. It's just not this absolute flood of liquidity that you had in the post-COVID period, where interest rates were exceptionally low, and there was just, the world was awash with money, and that's why we've had inflation this year, because there was kind of too much money chasing too few assets in the immediate post-COVID period. So I didn't understand the question perfectly. Hopefully that managed to answer some of it.
I think your explanation was crystal clear, and to Vincent, let us know what you think and whether that question was in fact your own and the response is what you were looking for. So for those of you who haven't sent through your questions, please feel free to do so. You can do so by emailing events@moneyweb.coza or on the YouTube channel. And on the YouTube channel, you can send through your questions there via the chat box. And also feel free to share any key takeaways that you have with you right now on social media with us using the hashtag BetterInvestor, so we can see what it is that you are saying. So David, the other part of this conversation is investing for residency benefits. And I'd like to know what you think about that and how that will work.
Right. Fifi, it's an interesting one. If you're going to try to get residency somewhere else and invest for residency, I think it's very important to understand that the key role of that investment is not to make fantastic returns, but the role of that investment is to get you residency somewhere else. Some people may want to have an option to go be resident somewhere else in the world. And if you've got enough money, you can often buy that in different places in the world. Portugal is a classic example. Costs you a few million rand worth of investment to go to Portugal, and you can, with time, get residency and citizenship there. But always understand that money that you invest to get your residency is not a great investment in all likelihood, except that it is the price of what you are buying in terms of residency. So don't try to make any investment do two jobs. An investment should always try to just do a single job, and that is make returns. If it's trying to do something else, don't expect it to make great returns for you. We can certainly help people out with that. We've got some options for our clients to help them to gain residency overseas and sort of at least point them in a direction where we think the investment at least is less likely to deliver terrible returns. But don't think your investing for residency is going to deliver great returns. It probably won't, because normally it's in the property space. And the country that you're going to is essentially has you a little bit over a barrel, so they can pick and choose where you're going to invest. And the other thing, always just something we haven't touched on, but something I would like to touch on, is just whenever you are investing offshore, just speak to your tax advisor before doing so, just to make sure that your tax situation is appropriate. If you have direct investments in the UK or the US, for example, There can be some problems around estate duty and things like that. If you die and your family is now left with that, there can be some quite heavy double taxation. For the details, speak to your tax advisor. We've got tax people that work in our business that can also help you out. But just be aware of the tax consequences before just dashing overseas and taking your money to invest there.
Okay, noted. So Vincent responded, and he did say that you answered the question appropriately, so spot on to you. David, if perhaps you can speak a little bit further about some of the risks, other risks that people may encounter if they are looking to take their money in other parts of the world for the purpose of gaining some form of residency there.
Well, I suppose the biggest risk is that often people who are looking to gain residency somewhere else, it can be quite emotional, and we're all human beings, and when we are a little bit more stressed about something and feeling a little bit more emotional, we can sometimes fall prey to bad actors, should we say. Not everybody out there is an absolute saint who has only your interests at heart. There can be folks out there who are looking to take advantage of people. So, what I would say is make sure that you do it through reputable agents who have been around for a long time, who understand these things, and who have seen the movie before. If you've got a partner to hold your hand for something like that, which can be quite expensive, if you're spending 7-8 million rand to try and get residency somewhere else, for everyone except a very, very small proportion of South Africans, that's a whole lot of money. And so you want to make sure you've got a partner that can help and guide you there, and is going to make sure that A, you don't get ripped off, and B, that the final investment is appropriate, C, that the tax is right, and D, that the fees aren't a nasty hidden cost. And that's why I say for things like that, get someone to hold your hand. And equally for any investing offshore, get someone to hold your hand. There are experts out there. Financial help nowadays is exceptionally cheap relative to most services in the economy. So you can really get a lot of help without it costing you a whole lot of money nowadays, in terms of getting your money offshore in the right amount, in what makes sense for you. Because remember, if you're investing for the next 30 years, or you're investing for the next 5 years, you're going to have a substantially different shape to your portfolio. And therefore, the amount of money that goes offshore for you would be a little bit different. The type of assets that goes into offshore for you would be different. So, that's why we have an advisor industry that can help you out. And, my business can certainly help you out, but there are, of course, others out there that also do a decent job.
Okay. So a few more questions coming through, and this one coming from Lizelle, asking about the opportunity cost of an investment that is purely for residency purposes. What do you think that is?
So this is on average, please take these stats as a very rough guideline, but typically I would expect an investment in, say, global equities over a multi-year period to deliver you somewhere in the region of 8% per year in US dollars over an extended period of time. So that's kind of your baseline. And then if you compare that to what you can probably get on an after-fee basis for an investment where you're trying to gain residency, probably in something illiquid like property. So you would probably get, I would guess 1 to 2% per year in US dollar terms or euro terms out of that type of investment. But remember, you're being locked in. So typically, if you're going to be locked into an investment for 5 or 7 or 8 years, you would want a dollar return per year of north of 10%, probably more like 12%. So your opportunity cost, to answer the question, probably in the ballpark of 10% per year in US dollars would be my guess for your opportunity cost. But these are very, very broad thought processes here.
It sounds like you're saying that investing for residency purposes is a bad investment.
It depends what you want. Don't think of it as an investment. Think of it as that 10% it costs you per year. So let's say it costs you 7 million rand to get your residency. So it's going to cost you 700,000 rand a year for, say, 5 years. So work that out. Call it 3.5 million rand. That's essentially the price of gaining residency. And then you've got to weigh up whether you think that's worth it or not. And it's different for every person. And then, of course, there's lots of people that don't have the money in the first place, so it's a bit of a moot point. And, of course, people like myself who really like being in South Africa and are committed to staying here. So.
Yeah, myself included. David, let's circle back then to the ideal portfolio split and what it does look like between assets locally and assets offshore. You mentioned China, and you did mention that you like some companies there, some parts of that market. But I'd like your overall take on emerging markets and how that fits in your local offshore strategy.
Thank you, Fifi. That's actually something I forgot to mention earlier. Very, very important. Lovely question. Thank you. So when you think about, as a South African, taking some money offshore, and why do you do that? To diversify your portfolio is the key there. Typically, the South African markets, whether it's the debt market in terms of government debt or the equity markets in terms of the JSE, our markets will tend to move in line with other emerging markets. So what happens here will tend to largely be mirrored in places like Brazil or Indonesia or India or Mexico or Turkey. Largely, we'll kind of all move in a similar direction together. So if you're trying to get diversification, and it comes back, I'll just move the slides to this favorite picture of mine. It comes back to getting assets that have a low correlation to one another. So, the Brazilian market will actually have quite a high correlation to what happens in South Africa, and vice versa, because we're both kind of commodity-driven economies. We both have, should we say, imperfect governments, but across emerging markets, that's generally the situation. So really, as a South African, all of our research that we've done crunching the numbers shows that by taking money out of South Africa and simply putting it into an emerging market fund, you're not really getting much in terms of extra return. In fact, you basically get lower returns, and you're not getting much in terms of diversification. So if you, as a South African, want to get the best overall portfolio structure, I encourage you to rather have your global investments concentrated in developed markets, largely the States, Europe, Japan. The UK, I would include in Europe. Yes, the UK has had some wobbles lately, even to the point of being referred to as an emerging market. That's certainly not the case. But I would encourage South Africans looking for international diversification to make sure the vast majority of their non-SA assets are actually in developed markets overseas, because those are the ones where the correlation to our own market is the lowest, and that should give you the best long-term return coupled with the lowest volatility over extended periods of time. And then if I maybe just touch on China,
Sure.
Very, very difficult to understand what's going on there. Obviously, I mean, I've been to China a number of times over the years to look at investments there. I've been to Tencent's offices, that's Naspers' primary investment, and fascinating place, but it functions differently to what we know. And you have to understand that there, the government's set of priorities is often quite different to sort of how we might think about it. So always invest there with your eyes wide open and make sure that you don't allocate an inappropriate amount of your portfolio to Chinese assets. And I say inappropriate because everybody's appropriate allocation will be a little bit different. But don't try to get too bold with China. I think, it's the world's second biggest economy. It's a growing economy. I would expect it over the next decade to grow faster than the rest of the world. And I think that a lot of Chinese companies are fantastic businesses. And if you're a business just looking after China, well, you've got 1.4 million customers, 1.4 billion customers that you can sell products to. So, very interesting place. Just have one's eyes wide open. We have investments there. We think it's interesting. We would like to have more, but we just get a little bit nervous every now and then about our ability to predict the actions of the central government there.
Sure. So for viewers and listeners, including myself, who are interested in what you deem to be an appropriate amount of exposure to China right now, can you give us a bit of a color as to how much of your portfolio has got skin in that part of the world?
Right. So I suppose if I were to look on a look-through basis if I think purely equities, the equities, if we run a global equity solution for clients that has investments both in SA and internationally, in terms of actual Chinese businesses, it's probably around about 5 or 6% businesses that are listed in China. But then on a look-through basis, when you take into account where the companies make their money, it's probably getting sort of closer to 12 to 15%. But then remember, if you've got an iron ore company that's listed in South Africa or Australia, it makes its money from China, but it's not a Chinese business. But it is, in the end, dependent on what happens in that Chinese economy. And then just as a sort of indication, as I say, on a look-through basis, sort of low double digits in China, but then, more like 40 or thereabout percent in US listed businesses, which of course have fingers and pies all over the world. But China relatively small. Mm-hmm. I'd like it to be bigger because the price is beautiful.
Yeah, you just need a bit more predictability in the political office, and I'm not sure you're going to get that anytime soon. Until then, in terms of your asset choices, I mean, the very bulk of this conversation has been around your preference for equities, both here in South Africa as well as other parts of the world, most notably the US, and also bonds, mainly government bonds. But what about other asset classes as you think about offshore, even local right now? Things like cryptocurrency, things like commodities, for instance, maybe even a bit of cash. What's your take in how those asset classes fit into your strategy?
Right. Fifi, I think I'll keep the exciting one on cryptos for last. But firstly, if I just talk about cash, a well-diversified global portfolio should always have some cash. And normally you'd want that, and it'd be sort of 4 or 5%. And normally you'd want that in US dollars as your sort of foundation point. And I think given our view that we probably go into something of a recession next year in the States, in Europe, and possibly in much of the rest of the world as well, it's quite nice to have some dry powder. We might see asset prices get a bit more exciting. So I don't mind having some money in cash right now, not a lot, but having the optionality to deploy cash into a disaster, I think is quite exciting. You talk commodities, I'll just split that into two pieces of gold and then kind of industrial commodities. Gold, I think, given where inflation is, given where interest rates are, given the behavior of central bankers over the past number of years, I think it's useful to have just a little bit of gold, because gold is one of those things, again, so if you had gold on this page that I show with all my pretty colors, it would be green because it has a low correlation to other assets. All right, I don't show gold on this thing, But I think there's value in having just a few percent, probably 2-3% of a global multi-asset portfolio in gold, as a little bit of insurance against a potential recession next year, as well as insurance if all of these rate hikes aren't sustained and we get another bout of inflation, which isn't our base case, but it may yet happen. There gold can do very nicely for you. And then other commodities, I am generally a little bit skeptical of holding direct commodities in the industrial space. So I wouldn't be buying or wouldn't be putting my money into like direct holdings in platinum or iron ore or oil or something like that. I'd much rather own businesses that are involved in those industries. So, a mining company or an oil company, I think there's a lot of value in that right now. As I mentioned earlier, we are overweight energy right now. We think energy looks quite interesting, particularly oil. Coal, I think, is a little bit more of a difficult one. One, I don't really like the ESG side of it. Two, the price of coal is ridiculously high at the moment, and I don't think it's sustainable. And then, mining company is, I think, a much better way to make money out of a commodity. Because if I just hold, 10 tons of iron ore in a warehouse somewhere, it doesn't do anything. If I own shares in a mining company, to use an example that most of the viewers will know, say something like an Anglo-American, every day they go and add value by digging iron ore and various other minerals out of the ground and shipping it off to global markets. So they're creating value, whereas if I hold iron ore, it does nothing for me. Over time, that Anglo-American business, you would expect to make profits, pay dividends, and actually deliver some sort of return. And I think that leads me in then to something like cryptocurrency. Cryptocurrency, just like my pile of iron ore in the imaginary warehouse, the cryptocurrency just sits there. It does nothing. It adds no value. In fact, we could debate for days around value that it attracts through energy usage and things. But really, your Bitcoin, to use that as the primary example, it just sits there. You can lend it out to somebody and maybe they'll pay you some interest on it, but all of that's a little bit artificial. If I own a share of a company, that is a contractual right to a slice of the profits of that business over time. That's what a share is. And it's the profits and the dividends that business pays. That's what you get. And you've got, in any business, a number of human beings and machines trying to actually add value. If you own shares in Toyota, for example, though, you've got a whole business worth of people trying to turn rubber and metal and leather and various other things into motor cars. They're adding value. They're creating value there. By contrast, the Bitcoin just sits there. It does nothing. It may have an investment case, and certainly, if you bought Bitcoin at $1,000 a Bitcoin and it's now worth 15,000, well, you've made great returns. But it's not something that I can justify putting client money into, because I just don't see any cash flows out of a Bitcoin. So for me, crypto is not the answer. I've studied this multiple times over the years, and every time I understand more, I learn more, I sort of get it a bit more, and I still can't see where are the cash flows. If I own a government bond, it's a contractual set of cash flows. So I can say, well, if I get 1,000 Rand at the end of the year, I'm willing to pay 900 Rand for it now. But if I'm going to get one Bitcoin in 10 years and one Bitcoin now, it doesn't make sense in terms of real investments that actually add value. That's my opinion. There are obviously many in the world.
For sure. You're sounding very much orthodox style, and there's nothing wrong with that, especially if it has worked for you from a portfolio management point of view. David, thanks so much for joining us and sharing all your really useful insights and tips on navigating this really important investment topic of investing offshore and here in South Africa, and also the potential benefits or not in terms of residency. We'll leave it there and have a great afternoon further. And that brings my session to an end. Coming up next, Rake is joining you guys once again, and he'll be talking about whether you should invest through a trust, a company, or a derivative structure, and that conversation coming up in just a moment.
Are you an amateur retail investor and want to become a better investor? If so, you should not miss the Moneyweb Be a Better Investor podcast. My name is Ryk van Niekerk, and every week I speak to the best professional investors, research analysts and traders about their personal investment portfolios. We talk about how they make investment decisions and hear what they regard as their best and worst investments ever. The idea is to find some golden nuggets from their perspectives and experiences to assist amateur investors in becoming better investors. Join me and my expert guests weekly on the Moneyweb Be a Better Investor podcast. Listen on moneyweb.co.za or the Moneyweb app.
The Moneyweb Be a Better Investor podcast. Show me the money. Moneyweb, your trusted source for business and investment insights. The Moneyweb Frequently Asked Questions series. Part 1, all about shares.
Hello, I'm Simon Brown. Welcome to part 1 of Moneyweb's FAQ video series. In this series, we're going to give you information and tips on how to use our tools better as you navigate your way through Moneyweb. In this video, I'll take you through all you need to know about shares and more. The most popular question, what are shares? Shares are listed slices of a company. Each share gives you the right to a share in the profit and a vote at the annual general meeting. They trade in an exchange, such as the JSE, whereby investors can buy and sell. Another popular question, why do shares exist and how do they work? In order for a company to raise money rather than a loan, they sell part of the company to new shareholders who essentially give the company a permanent loan. What are the different ways I can buy and sell shares? You buy them through a stockbroker or within a fund, such as a unit trust, an exchange-traded fund, or a pension scheme. Will I be taxed on my shares? If you make a profit, you will indeed be taxed, but only when you sell. Dividends, your slice of those profits every 6 months or year, will be taxed at a flat 20%. In the next video, I will highlight important information to consider before investing. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels to get the latest financial, business, and investment content.
Moneyweb, your trusted source for business and investment insights.
Good afternoon and welcome to session 5 of the Better Investor Conference, and we're going to talk about the company structures and derivative structures you can use to invest not only in South Africa but also offshore. Now, as an investment portfolio grows, it is critical to consider the appropriate investment structure, and most people start out investing in their own names. But once a portfolio grows to be substantial, there may be other more appropriate investment structures. Now, there are several options, and all of them have their pros and cons. And this session will explore the different opportunities, the limitations, the risks, and of course the tax implications of these structures. With me is Tracy Miller. She's Head of Advice and Philanthropy at Nedbank Wealth Management. She has over 32 years of experience in the financial services industry, including 23 years in the wealth management and fiduciary services industry, and she leads a team of advisory specialists who provide specialist wealth management advice. She's a CFP and a registered tax practitioner. Tracy, thank you so much for joining me today. This is a pretty complicated topic, and I don't think many people really appreciate it early on in their careers or in their wealth building journey, that maybe they should consider different structures as opposed to having it in their own name. So let's start there. When do you think someone should start to think, listen, maybe I need a different structure to house my investments?
Yeah. First of all, Rick, thank you. Thank you for having me. So I always like to use the analogy of building a house, Rick. And for me, when you build a house, you've got to start with the foundation. Effectively, that's where you start. And I think what we often find in the wealth management industry is clients come in and look at what investments am I going to invest in without giving proper consideration to how should I structure those investments. So as is the case when you build a house, you've got to start with the foundation. So you need to understand what are the different ownership options that you can select and what are the consequences of those different ownership options. So if I may, just very briefly, I like to highlight to clients that one needs to look at the estate planning considerations in particular. So, you know, the reality is that throughout our life, we are going to go through challenging times. Ultimately, we're all going to die, we know that. But there could also be instances where we become incapacitated. We go through a life-changing event such as divorce or immigration. All these things have an impact on our wealth and our ability to grow our wealth. And that's why, for me, it's so important to understand the different legal ownership options and how they relate to the different estate planning consequences. As an example, you know, on death, will the assets continue? Will you have continuity? Will you have, if you've got vulnerable members of family, will your assets be protected? If you become incapacitated, we often spend so much time planning for death that we forget that there are other life-changing events such as incapacity.
Especially after COVID, we've seen that
absolutely
over and over again.
Absolutely, and the huge impact that has on our loved ones. Another, you know, consideration as well is if you are going to be investing internationally, you know, one of the reasons why one invests internationally is generally to diversify all forms of risk. One of them is sovereign risk. So if you're going to hold your assets in your individual capacity, arguably you're not going to have much protection. So I think it is important for clients to understand, and investors to understand, what are the different consequences that are linked to the different ownership options.
But let's explore that, because you know, we're going to use a lot of terms, you know, owning assets in your own name, co-ownership or joint ownership, trusts, companies, or companies being owned by trusts, and all of them have their own pros and cons. But let's start off with the most simplistic one. An individual holds assets in his or her own name. What are the pros and cons of that structure, and when should that person start to think, listen, I've got a substantial portfolio now, maybe I should structure it differently?
So I think starting with the pros, I think if you hold assets in your individual capacity, arguably the benefit to doing so is that you've got a huge amount of flexibility. You know, if you want to switch from one investment to another, you can effectively do that yourself by giving an instruction through to your wealth advisor. You don't need to go through to trustees or directors of companies to get approval to do that. So I think for me, the benefit of holding assets in your individual name would be flexibility. But that's where it kind of stops. Because the reality is that if one becomes incapacitated or on death, one's got to look at how easily will those assets devolve to your loved ones. And as we know, from a distribution perspective, assets effectively freeze. All your assets that you own in your personal capacity freeze on death. So that means that there is a timely process that one has to go through, or one's estate has to go through, before your beneficiaries effectively can benefit. So that to me is a huge con to actually holding assets in your individual capacity. Another con would be if you are looking to create an element of protection, whether it's sovereign protection, protection against creditors, holding assets in your individual name, you're not going to be able to achieve that. Because, you know, it's kind of like being on the beach midsummer without any sun protection. You've got no protection whatsoever. So I think, you know, for me, I mean, just to sum up, I would say that the kind of pros would be that you've got a huge amount of flexibility, but understanding that if you become incapacitated, that's where the challenges effectively come in. Because the assets are not going to continue. You know, that's the reality.
But life changes. So I think the moment you have dependents, you have a family, or you're a business owner with potential risks, you should start to look at maybe not holding those assets within your own name. So once you've reached that stage, what do you do then?
Absolutely. So, I mean, you're spot on. I mean, you know, we all go through a life journey, and I think when we're starting out, it's fine to hold assets in your individual capacity. The minute you start getting married, you start having children, you have more commitments. As the commitments start building, that's when I think you need to explore alternatives. And, you know, that's where holding assets through a trust, whether it's a trust that's established in one's lifetime or through a will, it's just about making sure that you make provision for those assets for your beneficiaries.
But that's not a question of money. It's not, listen, I've got 10 million rand in the bank or in various investments. Now I need to look at other structures. It's a life type of choice. It's a life stage you reach. And then you need to decide, listen, I need to change. And you mentioned the word trust. I think many South Africans know of trusts, and it is a quite commonly used structure. But give us the pros and cons of trusts and why it is such an attractive vehicle?
So I think if we look at trusts, I think it is important to just take a step back. And I think if I look at the history of trust, and I think, trusts date back to the days of the Crusades, effectively. And, you know, and the whole concept going back to the days of the Crusades was around wanting to make sure that one's assets were protected for one's loved ones, for one's beneficiaries. So in those days, you know, instead of the assets falling into the hands of the king, before you set off on your crusade, you would go to a trusted third party. You would say, these are my assets. If I don't return, this is what I would like you to do with them. I'd like you to make sure my wife is looked after, my children are looked after, etc. And I think fundamentally that's what we've got to bear in mind, is that if you look at trusts today, I think historically trusts have been sold for the wrong reason, in all honesty.
To avoid tax or pay less
Absolutely.
tax, yes.
You know, there was a time where the tax rates for trusts were more favourable than the individual tax rates. So at that stage, you know, everybody effectively had a trust. And I think the reality is, though, today it's become far more complex. From a tax perspective, there are no longer tax benefits to holding assets in a trust. It's become a lot more onerous in terms of making sure that you appoint trustees. Even as a trustee, it's become far more onerous to administer trusts. And for that reason, I think one's got to be clear in terms of why is it that I'm establishing a trust. And if it's for those traditional reasons, i.e., I want to make sure that my assets are looked after for the benefit of my beneficiaries, for my loved ones, then that's a huge tick in terms of a box being ticked. If it's to save tax, trusts are not the right vehicle in which to invest. So I think it is all around going back to the traditional reasons as to why one would consider establishing a trust, as to why one would do it now. I think with all of these structures as well, another important aspect is cost. Because with a lot of these structures comes additional cost, and cost comes in various forms. Tax is a cost. But if you're going to set up a trust and you're going to have a proper trust governance, around the structure of the trust, you also want to make sure you have professional trustees. And professional trustees will come at a cost. So I think, as I said earlier, I think the reason for establishing the trust you have to go back to fundamentals. Tax should not be a reason. And if you're wanting ease of administration, it's not going to be easy, in a trust structure, because you've got to go through trustees, etc.
Yeah, many people who use a trust for the first time put in a holiday home in the trust, and some assets, but still believe they own their assets and they run it like it's their
alter ego.
Exactly,
Absolutely.
and it doesn't work like that. There are other aspects and trustees you need to consult, and there's definitely an administrative burden. But is that the first port of call?
So I think once one starts having children, and in particular when the children are minors, one really has to consider, what will happen to my children if anything happens to me and my spouse? And I think that's the key point. And the reality is if one has someone that they can trust, that they can appoint as a guardian, then great. But so I think trusts play a huge role when it comes to the protection of vulnerable members of the family. So whether it's minor children, it could be elderly parents that one's looking after. And you want to make sure that if anything happens to you or to joint spouses, that those assets are going to continue, that your loved ones are going to have access to those assets. That's when a trust makes sense. But of course, Rake, there are different types of trusts. So a testamentary trust, as an example, for a lot of individuals that have minor children, will make a lot of sense. So what you do is effectively in your will, you bring in provisions to have a trust established on your death in the event of something happening to both spouses, as an example. And the assets will then be transferred to a trust, and the children will be looked after by the trustees. Very important, though, when you consider who you're going to appoint as trustees, because it's, as the word says, it's somebody that you are going to trust. The other alternative is to set up an inter vivos trust, which effectively is a trust that one establishes in one's lifetime. And I think the key consideration with an inter vivos trust is around, does it make sense from a value perspective in terms of assets? And what I mean by that is that if you look at the current regulatory and legislative landscape, and as I mentioned already, even if you look at what's happening from a tax perspective in terms of trusts, it's become a lot more complex. And in particular, if you're looking at international trusts, a lot of the jurisdictions, they are so scared that they're going to be downgraded that they are kind of adopting a belt and braces approach to the way they operate trusts, which arguably is a good thing, because you want to make sure that there are belts and braces in place. But that all comes at an additional cost. So for me, when you're looking at considering establishing a trust in your lifetime, the value of the assets would come into question, as well as what is it that you're actually wanting to do with that trust? Because are you once again wanting to protect individuals? As a business owner, you may want to get some form of creditor protection. And those are things that you can then do during your lifetime with a trust that you're an inter vivos trust effectively.
Yeah, we're going to get to the international scenario in a while,
sure.
because that is also very, very interesting. Another option is a company. Many people want to invest or hold assets within a company. That also comes with pros and cons. What are the major ones?
So I guess the cons with the company is that you do get an element of continuity, in as much as that, you know, the assets, if they are structured and they're held within the company, there would be an element of continuity. But the key consideration with a company is ultimately who owns the shares. So if, as an example, you set up a company, Rake, and you're 100% shareholder in that company, then arguably you don't have any continuity, because now as shareholder on your death, what happens to the shares? They form part of your estate. So all of those things that we were chatting about earlier around ease of administration on death becomes a real issue. So from a company perspective, I guess there are benefits. I mean, obviously, not that I like the tax tail to wag the dog, but obviously company tax rates are lower. I mean, it's 28% currently. So from that perspective, you've got a lower tax rate within a company. But the key consideration would be around the shareholding and who is ultimately going to own those shares.
Then another popular structure is when a company is owned by a trust. So that's a bit of a two-tiered hybrid
the two-tier structure.
How popular is that?
So we do find from an investment perspective, you know, we do find that they are quite popular. But once again, I think, you know, the more complex the structure becomes, and, you know, the more layers you start adding on, in my mind, the more complex it becomes. So from a value perspective, it's got to make sense to have a two-tier structure. But I mean, theoretically, just trying to keep it simple with the two-tier structure, effectively you would have the trust as the shareholder in the company. So from a continuity perspective, all of those things without signing hard, death becomes a non-event, the shares continue. And in those instances, you know, it can make sense, but the value has got to make sense, and definitely from a cost to benefit perspective, because the more structures you bring in, so your costs increase.
Viewers are welcome to send us questions, events at moneyweb.co.za, or on the YouTube channel. Just type in the questions in the text box. I was hoping to keep the questions to the end, but this is a very relevant one. How do you pick the appropriate administrator to manage your trust, and what are the risks involved with choosing an administrator? It comes from Cuban. That must be a very important decision.
Absolutely. So I think, you know, when selecting the right administrator, and I think one must be quite clear, because if we're looking in the local context, it's quite normal that you have the individual that's establishing the trust, excuse me, that would be a trustee. But what is important is, because the kind of regulatory environment has become far more stringent than it used to be, that you do also have an independent trustee appointed. So there's two things. If you're going to appoint an independent trustee, they would act as a trustee, i.e. make decisions over that trust. And generally, if you're going to appoint a corporate trustee, that corporate trustee would then also attend to the trust administration. Generally, from a pricing perspective, they would charge a separate fee for trust administration and a separate fee for trustee services. So what we do often find as well is that sometimes that independent trustee is an accountant, as an example, and that accountant may not be equipped to actually do the trust administration. So we often find that people try and go it alone, but I think I would exercise a word of caution against that. And so really, I mean, to answer the question, I would recommend that one considers appointing a corporate trustee that has the necessary expertise to be able to bring proper governance to the trust structure and to be able to administer it appropriately as well.
But many people will say, listen, that's just an administrative function. This family will still take ownership of the assets. Normally the trustees are the man and the woman in a relationship, or
husband and wife.
Exactly,
yeah.
And maybe the kids are the beneficiaries, and it's still a family thing. Now we've got an insider also being involved in decision making. It can cause friction, but it's an important function to have an active trustee, independent trustee, to also help with decision making.
To bring validity to the trust, absolutely, Rake. I couldn't agree more. So it is important to have that independence that comes in as a trustee. You know, the reality is that for a trust to really be able to provide the benefits for which one would look to establish it, the reality is you've got to be seen to be distancing yourself from those assets. And that means relinquishing control, which a lot of South Africans have a problem with. I mean, we all do. We all want to be in control of things. The reality is we can't. I mean, we can't be in control of everything. But even more so, when you're establishing a trust, for it to be effective, you do need to relinquish control. And the way you can prove that is by appointing an independent trustee. And when you're appointing an independent trustee, it is important to make sure that you're appointing someone that's going to be able to bring the proper kind of expertise that you need to that table.
Let's move on to co-ownership or joint ownership. That's more an offshore structure. And what is that all about?
Okay. So in the South African context, if we're going to open up a bank account, generally we can only open up a bank account in one primary account holder's name. And unless obviously one's married in community of property, in which case you can have a joint bank account opened. In the international context, it's slightly different, because in the international context, and in particular in your English law jurisdictions, so the UK, Channel Islands, Isle of Man, etc., there is a legal concept that's known by the name of a right of survivorship. And effectively what that means is that you can open up an international bank account and add additional account holders as joint account holders to that account. So if we just kind of try and break that down a little bit, it means that if you have a bank account that now has joint account holders added to that bank account, and one of the joint holders passes away, you've got an ease of succession from a probate perspective, because it's as simple as the bank, effectively upon receipt of the death certificate of that one account holder, removing that account holder, and the remaining account holders stay on as account holders on that account. What a lot of people don't realize, though, is that this concept of right of survivorship effectively means that each account holder has 100% entitlement to that account. So during the lifetime of those account holders, they can approach the bank and say, I'd like the full amount. And the bank would be hard-pressed not to allow that withdrawal to take place. So joint account ownership in the international context definitely has a role to play from a succession planning perspective, because you don't have to go through probate and all of those things. But it is important to understand what it actually means. Because as I said, so what we traditionally see is we'd see a husband and a wife and their major children all being added as account holders on this particular international bank account. So the risk to that is that the children, effectively, if they get wind of the fact that they are a joint holder, could approach that institution and, as I said, withdraw the funds from it. So it does have a role to play, but I think it is important to understand that role. From an SA perspective, it becomes slightly complex.
Can I interrupt you
Sure,
there? I'm
sure.
not a fiduciary expert, but that bank account, is it only relevant for cash, or can other assets also be included in that structure?
Absolutely. So, I mean, just as an example, we've got an international investment platform called Focus Platform through Nedbank Private Wealth International. Now, through that platform, you can effectively hold investment instruments. So it's a bank account, and you can hold trusts, you can hold shares, etc. So that account, you can actually add on joint account holders to that account. So it's more than just a traditional bank account.
So it is a structure on its own which needs some consideration, especially, I would assume, for foreign investments.
For foreign investments, absolutely. But I think I think just the words of caution would be to understand what that right of survivorship means and the fact that each account holder effectively has entitlement to those assets. So I think that's the one important aspect to consider. And so yeah, I mean, I think, generally it has a role to play from a probate perspective because you've got that kind of continuity. But also bear in mind that from an SA law perspective, where it can become complex if you don't have a formal written agreement that actually shows the actual ownership of so just as an example, Rake, you externalize your foreign investment allowance, you decide to add on your wife as co-account holder. You may view those assets as being yours, even though she's been added as a joint account holder to that account. Now, in that case, if that is the case, you should have an agreement that stipulates you view that account as being 100% owned from you from a South African law perspective. Now, with spouses, estate duty is a non-event. But the minute you have children added as joint holder, that's where it becomes relevant. And if you don't have an agreement in place that stipulates that percentage ownership, generally the kind of stopgap is that it would be treated as being equally owned. So if there's 4 account holders, 25% each. But there's also other complexity because if you add, as an example, a child as a joint account holder to that account, now we have to look at from an SA tax perspective, did you donate those assets to the child or do you have a loan agreement in place? Because if it was a donation, that triggers donations tax, as you know. But it doesn't stop there because if the child is added as a co-account holder, what does that mean from an ongoing income tax perspective? If those assets, generate interest, which would be taxable here in South Africa, are they paying tax on it? So generally, the kind of stopgap would be that the primary person would effectively declare 100% of the income tax, etc. But these are complexities that one needs to be aware of and kind of get your mind around it as well.
Yeah, and many people would assume that's a perfect structure for a happy family. The moment there's some friction within a family or a divorce, that may also affect the outcomes and maybe put more emphasis on the negatives of that structure as opposed to the positives.
Absolutely, and what we are finding, is that there are more and more blended families, now where in fact it's not first marriages, it's second marriages, it becomes complex where you have children from previous marriages. With this joint account ownership, just as an example, it can also have ramifications when it comes to the accrual calculation in such a situation. I mean, effectively, the value of that account should be brought into the accrual calculation, but there would be no right of entitlement from the spouse against the other co-account holders because this right of survivorship effectively kicks in. So, yeah, but precisely. I mean, I think it all works well when everybody's getting along well, etc. But it can also create further complexities. I mean, I've just used that example now in terms of the accrual calc, where that can have implications.
Does the structure does your assets which you own or a family owns, does that have an impact on the selection of the correct structure? For example, if there's a property-heavy portfolio, do you need to go to the trust route, or if you have an equity portfolio, maybe another structure? Does the assets actually play a role in the selection of the right structure?
So they do. I would say they definitely do. If, for example, you're going to be holding just a primary residence, it wouldn't make sense necessarily to acquire that primary residence through a trust, as an example, because obviously from a CGT perspective, just looking at it from a tax perspective, you get a primary residence exclusion if you hold the asset in your individual capacity, which you wouldn't get if it was held through a trust structure. So generally, I mean, I think the kind of general rule of thumb would be if you are going to acquire assets that have huge growth opportunities, just as an example, you're starting out a business, and that business has a huge growth opportunity, then ideally what you would want to do is to get those shares at startup into a trust. And why? Because the value of the actual funding of that trust is going to be minimal. And what you would ultimately see is the growth would then take place through the trust, which is ideally what you want, because it's then outside of your estate. And if you have the proper trust structure to support that, then the assets would fall outside of your estate, which then becomes beneficial. So the types of assets definitely play a role. And, even more so when we start looking internationally.
Let's talk about tax, because death and taxes is the saying, and it plays a significant role in investment decisions and in strategies, and obviously within the selection of the appropriate structures. But let's start with the offshore example, because I think most people understand exactly not exactly, but broadly how the tax regime works in South Africa. But the moment you cross the Limpopo, things change, and in some cases change significantly. Does these structures protect you, for example, from the state duties and CITES tax offshore?
So I think the first starting point is just to bear in mind that as South Africans, we have a residence-based system of taxation. So I think that's step number one. So in fact, it doesn't matter where our assets are located, those assets would be subject to tax here. What we do have is we have double taxation agreements, etc., that come to the fore, which may be beneficial. When we start looking at CITES taxes, so not only do we have a residence-based system of taxation, but the minute we start acquiring assets in certain foreign jurisdictions, there could be taxes that apply in that jurisdiction or the jurisdiction where the assets effectively are situated, hence CITES taxes. So let's just take an example. If you are going to invest in UK immovable property, as an example, that property is situated in the UK, so effectively in terms of the double taxation agreements, the UK would have taxing rights, that property would be subject to UK CITES taxes. And I think if we unpack CITES taxes, I think there's this perception that CITES taxes only apply insofar as death taxes are concerned, but the reality is it doesn't. CITES taxes that apply to where an asset is situated, it's the full ambit of taxes. So it's income tax, capital gains tax, it's inheritance tax or death taxes, etc. So if one, in that example of acquiring a property in the UK, if we just kind of stick with that for now, so yes, you're going to fall into the UK CITES regime. There would, from an SA perspective, there would be relief provided in terms of any taxes that would be due here, because effectively the UK has taxing rights on those property, on that particular property. But if one were to consider now, do I hold that UK property as an example through an offshore trust? Then one has to be aware of the fact that from a UK perspective, there have been various changes in legislation, anti-avoidance changes that effectively have come into to the equation. And what that effectively seeks to do is it seeks to bring any taxes that would be due on that property in the UK if it's held through an offshore trust back into the UK inheritance tax net. So it may make sense if one is going to acquire a property in the UK to acquire it in your individual name or to acquire it in joint name as opposed to holding it through a trust. I'm just using that as an example now, so it does become a lot more complex. I think the important point to take away is one needs to understand what are the tax consequences in the jurisdiction in which you're going to invest. And what are those tax consequences there in relation to the ownership option that you've effectively selected?
Now, it's definitely a lot more complex. What role does tax havens play? Is there a way you can maybe invest or set up structures in Guernsey and the like to try and also mitigate some of the risks?
So because we have a residence-based system of taxation, the reality is, Ray, no. Going through an offshore, what the offshore jurisdictions, your traditional tax havens, I haven't heard that term for quite a while. I think these days it's an international, but I think they prefer to be known as International Financial Center or something, but be that as it may. Historically, yes, and I guess that was when we were still on a source-based system of taxation. But the benefits of investing through an international financial center, such as the ones you've just mentioned now, is that generally if you're non-resident, there are no citus taxes that apply in those jurisdictions. And that's why, a lot of these jurisdictions offer, trusteeships, they offer the trust services where they establish international trusts for clients, because effectively the trust itself will not be taxed in that particular jurisdiction. Obviously, from an SA tax perspective, we look to tax wherever there's an SA resident involved with that trust. And, the minute the trustees are now going to go and acquire a UK property, that brings that trust into the UK tax net. So I think the short answer is investing in an international financial centre really gives one the benefit in establishing structures in those jurisdictions, generally gives you the benefit that there is no tax payable in that jurisdiction. But understanding we have the residence-based system of taxation, and the minute that structure is going to invest in other jurisdictions, there could be a tax charge triggered as a result of that asset being situated in that jurisdiction.
So there's no place to hide. But
Indeed.
It seems very, very complex. So does your decision, how much is it influenced by the amount of money you have? Of course, these structures would be expensive from an administrative perspective, not leaving tax out of it for the moment. So how much do you think would trigger changes within your structure, especially if you want to move assets from South Africa offshore?
So I think the reality is, and in particular if we start looking at a lot of these international financial centres, I mentioned it earlier, but generally the regulation, legislation in these financial centres, in order for them to maintain their good standing, has become far more complex. And that comes at a cost. If we just look at, generally the kind of the way your money laundering legislation has opened up, internationally. So I think all of this comes at an additional cost. So the reality is it's become a lot more expensive to set up international structures through a lot of these jurisdictions. So the reality is that one's got to kind of do that cost to benefit analysis. One's got to look at each individual circumstances and say, based on this amount, does it make sense for me to pay these additional costs? And as I say, just over the past couple of years, we've just seen an exponential increase in fees, which is largely driven by the need for these trustees to comply with the legislation and regulation in these jurisdictions. So, I think a general rule of thumb, just if I were to quote something, if it's less than £1 million, I would not set up an international trust, because I don't think it's going to make sense, just in terms of the way the landscape is evolving and changing. So generally, I think one has to have substantial assets these days for it to make sense to have an international trust established.
It is also expensive to move assets from one structure to another. If you move a property owned by an individual into a trust, you will pay transfer duties, and there may be other costs as well. So if you procrastinate or you're not proactive enough, a change in structure could be really, really expensive. In your experience, do high net worth individuals appreciate that they need to be proactive to ensure that they move assets at an optimal time and into the correct structures?
Absolutely. I think, and I think one would always like to get the timing right, and hindsight is always the best, the best route to follow. But as I said earlier, I think, the sooner one starts considering what are the different asset ownership structures, what are those consequences, I think the sooner one starts going through that process of identifying what is going to be the best option for each individual, the sooner one starts putting those structures in place, the better. But you're spot on. I mean, as circumstances change, one, just as an example, could go the route of a trust, and in time one finds that the benefits of that trust now no longer outweigh the cost, and the cost has become more prohibitive. So the key thing there is to ensure that one has an element of flexibility. And I think that's important when it comes to all of the different ownership options, is to ensure that there is an element of flexibility. That if you want to unwind it, effectively you can unwind it. It's not to say that's not going to come at another tax cost, because there may be a tax cost. So I guess it's around going in with one's eyes open. The sooner you start it, though, I think the better.
It seems to me it's a question of protecting assets and continuity within a family, and the trade-off may be flexibility, which is also critical. Are those the main factors you need to consider, especially when you set up such a structure?
So I think the first one would be around continuity. And I think when one looks at continuity, one's got to look at incapacity like we mentioned earlier. It's not just around planning for death. It's around, if I became incapacitated today, what would that mean for my loved ones? Would I get continuity? Would they have access? If I'm the one that's doing all the monthly budget and suddenly I'm incapacitated for a couple of months, what does that mean for our loved ones? So I think the continuity aspect is an important one, not just around death, but also around, as you mentioned earlier with COVID, etc., the lessons we've learned through that is that life happens. So continuity is one. The other one is around how easily will those assets transfer, in particular on death. So especially when you're holding international assets, will there be an ease of transfer, an ease of distribution of those assets? Or will there be a prolonged period of time before my beneficiaries get access to those assets? So continuity, distribution of assets. If we look at protection, I think there's two things we want to protect. The one is around protecting vulnerable members of family. So if we have minor children, if we have elderly parents that we're busy looking, that we are caring for. The other protection would be around, if you are a business owner, do you need credit protection? If you are investing internationally, do you want to build in some element of sovereign protection? So those would be the two protection. Protection of vulnerable members of the family and protection against potential attack on assets. The next thing would be around flexibility, and I think one needs to make sure that whichever option you go, there is a backdoor, that effectively you can unwind it if you need to, fully understanding what those costs are going to be. And the last one, and I'm purposefully putting it at the end, tax. One needs to understand what are the tax consequences. I mean, just as an example, we've seen huge amount of changes from an income tax perspective in terms of trusts and the taxation of trusts. We saw legislation introduced locally a good few years ago around seeking to bring interest-free loans into the tax net. In the international context, it's far more complex because we've got transfer pricing provisions and all sorts of things. So one does need to understand what are the tax consequences, but it's no longer tax at tops, and that's what drives it. It's looking at those traditional reasons. And that's why I've kind of put it in that order.
You said earlier, life-changing events, you can't plan for it. And it can have a massive impact on the financial status of any family. And that should be actually one of the core issues or core factors to consider. What if scenario, what if you're being incapacitated, what if there's a death in a family, what if there's a divorce? That should be really, really critical, and a lot of people don't really factor that into their decisions.
Well, I think, Rake, I think the reality is that we all think it's not going to happen to us. I think that's the challenge with all of us. But the reality is that it does. I mean, just to give you a practical example, I mean, my brother-in-law at one stage became very ill suddenly, and was, in ICU for, I think, almost 2 months. And the reality is, he was the one that actually managed the finances in the relationship with my sister, his wife. And so in addition to this emotional trauma now of having a loved one that's in ICU, you've now also got to worry about, well, are the rates going to be paid? Are all of these things going to happen? So I think the reality is these things do happen, and life has a way of happening, whether we like it or whether we don't. And it's all around trying to plan for as many of these. We're never going to be able to plan for all of them, but it's trying to plan for as many of these life events as possible. So a simple thing, just in that example now, one doesn't have to go to the cost of setting up a structure, but if you are married and you spouses in a marriage, it's about talking about finances, making sure that both spouses know where important documents are kept and stored. And so that they have access to that information. So if that person can no longer talk, and I guess that's what we've got to look at it from. If my husband or my wife could no longer talk, and they were the ones that were managing our finances, what would that situation look like? Would I know how to pick up those pieces? And I think that's the important aspect. It's around having the conversation with your spouse. This is how I manage our monthly finances.
But that doesn't happen too often enough.
It doesn't, no.
And that creates a lot of problems post such a life-changing event. And I think that's a message we really try and convey, is listen, be open about your finances and make sure that there is continuity, because if there's a death, the stress involved with access to cash can be really significant in a grievous time in your life. But let's get a bit practical. What are the most popular structures used in South Africa? Is it normally just a trust structure, a trust owning companies? In your experience, if a family accumulates significant wealth, they really want to plan for the things we've just discussed. What are the most popular structures?
So I think trusts are still one of the most popular structures that we are seeing from a South African perspective. And I think what we are seeing is, as I mentioned earlier, so it's a bit of a combination. I think, with trusts, and as I say, we're seeing a lot of blended families these days. So you've got children from previous spouses, etc., or marriages. And so I think trusts definitely have a role to play. But because of the complexity surrounding trusts, I think what we have seen is that we've seen the establishment of new IV trusts only happening where it actually makes sense in terms of the value of assets that are going to be held in the trust structure. So I think from a South African perspective, we are still seeing that trusts play a major role. We're seeing that, trusts play a major role from a testamentary trust perspective, let alone from an IV trust perspective. Another area that we are seeing in particular in the high net worth space and ultra high net worth space is where clients are wanting to make sure that they start giving back, and they want to start realizing those giving aspirations, that the types of structures that generally we would look to establish there would also be your trust type structure. And I think it's just interesting because in a lot of instances, we've walked the journey as a business with a lot of our clients in terms of making sure that they have the right structure in place. They're no longer here from a charitable trust perspective, as an example, but we're actually giving effect to their legacy because we're making sure that the causes that they were passionate about, that we're actually making sure that those causes benefit. So, just generally, I think trusts do play a large role still in the planning environment for ultra high net worth clients. I think what we're also finding, though, is that, certain investment vehicles, so as an example, endowment type structures, your wrappers, your endowments, where effectively you got your beneficiary nomination. We're also seeing that those are playing more of a role. And I think in particular when we look at the international context once again, when it comes to your two-tier structures that we spoke about earlier, I think in some instances it does make sense, we are seeing it, but that would really be for the larger value type assets from an investment portfolio, that we would see that those types of structures are being established. And in the international context, the two-tier structures do have a role to play as well. But just with the tightening of the legislation and the tax legislation in particular, we are finding that there are not as many two-tier structures being established as there were in the past.
Interesting question from Pitso Moremi. He says he has 10 properties, and would it be wise to move them to a company or a trust? And I think the transfer duties would be the main consideration there.
So when we're looking at transferring property, I mean, there are certain, so obviously generally the consideration would be capital gains tax, because effectively you're going to be disposing of those assets, and then there would be transfer costs that are payable as well. But there is a provision within the Income Tax Act where effectively you can defer those payments, and that's what's known as a Section 42 asset for share transaction. So effectively, if you were going to set up a company, you could effectively transfer those properties and defer the CGT to a later event by transferring it into that company. So, I mean, that may be an option in that particular case for that individual to consider, but it requires a bit of a broader discussion, because once again, it shouldn't just be around tax. Yeah. It should be looking at the broader picture. But there are opportunities where one can potentially defer costs in such a situation where it makes sense to then have those properties held through a company.
Another interesting question from Eleanor. What are the estate planning implications of investing via trust for beneficiaries? Many parents want to start portfolios for their children. Grandparents also want to contribute. Is a trust the correct structure for building such a portfolio for children?
Absolutely. So, I mean, I think, the benefit behind the trust is the sooner the trust owns the assets outright, the more advantages there are for beneficiaries. So just as an example, I mean, I think one of the considerations when one is going to set up a trust is one's got to look at how you're going to fund that trust. And generally there's two ways. You either do it via a donation or you do it on loan account. And I touched on the changes that have come from an interest-free loan perspective. So in the lifetime of the funder, there would be tax consequences. And if there is a loan, the value of that loan will be an asset in that lender's estate, effectively. So when that lender passes away, and let's just assume that they've bequeathed that outstanding loan balance to the trust then owns those assets outright. So if the beneficiary doesn't need the funds, those assets are not in their estate. So from an estate planning perspective, there are huge advantages to that. And what we often find is that in that scenario where there are multiple children that are beneficiaries, and if the trust is large enough, that there are ways that trustees can now start almost earmarking or ring fencing the assets for each one of those children. So you may find one child needs all the money and withdraws it out, but the others can effectively preserve the assets in the trust. So definitely huge estate planning, because it would not form part of the estate effectively.
Last question from Kaylin. What are the tax implications of investing through a trust for a married couple looking to start a family? But I think the core of that question is, do you live within your trust? Because many families would transfer assets into a trust, but they still use them. And there must be some boundaries. So in this scenario, is it a big issue?
So I think, if I look at that question in particular for a married couple looking to start a family, I think I've touched on some of the tax implications, but maybe just for the purposes of that view, just to reconfirm. So I think, number one, when you set up a trust, you've got to transfer ownership of those assets. Generally do that in one of two ways. You either sell the assets effectively on loan account, or you're going to give the assets away. You're going to donate them to the trustees. So there will be tax consequences on transferring those assets to the trust. I think one then, so that's kind of upfront. If you're going to donate, there will be donations tax, but it doesn't stop there, because then there's attribution provisions. So there will be ongoing taxes that are involved. So I think for me, the key consideration then would be, what are the assets you would be considering transferring to that trust when you start out your marriage? Because if you've got minor children, it may not make sense at that particular juncture to set up an inter vivos trust, set up a trust now and fund it now in your lifetime. But it may make sense to make sure that you have a testamentary trust established in terms of a will, in case anything happens to the husband and wife.
Just lastly, this is complicated. You need professional advice. You need a professional consultant and assistance to set this up. How important is it to choose the right consultant or wealth management house to do that?
So Rake, I mean, that's a really good question, because, you know, the minute you start investing internationally, you've got to ask yourself, is the person that I'm going to be speaking to, do they understand what these implications are? I mean, we spoke about CITES tax. I mean, that's a topic all on its own in terms of CITES tax and the implications around CITES tax. So I think the important thing is to make sure that you speak to a reputable company, a company that has proper understanding of a lot of these nuances, and that a company that, in particular, if we're looking in the international context, that has a presence in those in foreign jurisdictions as well. And so, you know, I think it is important that you do seek to approach a professional advisor, one that has solid background, that's, you know, one can operate very effectively as an independent advisor. But I think the word of caution would be, if you are operating as a sole individual advisor, my question to that advisor would be, how are you keeping up to date with all of these changes? Because, I mean, we have a team, effectively, that look at these kind of things that we're discussing now. And, you know, as a business, we come up with house views from an advice perspective. Because effectively, for us, it's really trying to make sure that we can help our clients make better financial decisions, help them avoid financial disasters, and also help them realize their giving aspirations. So it's a broader than investment advice product suitability, which we spoke about earlier, because it's looking at that wealth advice, financial planning holistically.
But that doesn't necessarily need to be two institutions. It's probably ideally one institution where the financial advice is married with your structure.
Absolutely, absolutely. So, and that's what I mean. I mean, if we look at the size of our institution as an example, as a wealth management business, I mean, this is what we do. This is why we get up in the morning. It's to make sure that clients are given appropriate advice when it comes not only to investment advice and product suitability, but also around these complex matters that we've discussed now, around what is the legal ownership option that you should be selecting. And, you know, I mean, for me, as I said earlier, I think it's all around trying to ensure clients make better financial decisions. Because, I mean, the reality is every single financial decision we make affects our ability to protect what's important to us and to achieve our life goals and aspirations. That's the reality. So it's around partnering with someone that's going to be able to connect those financial decisions that you make to your life goals and aspirations, to make sure that you are able to actually realize those.
You've referred a few times to giving back, philanthropy, and you know, obviously the ultra wealthy really see that as giving back to society. Does that affect the structure?
So it's an interesting one, because you automatically linked philanthropy to ultra high net worth, and our view is that we really want to be able to realize all our clients, irrespective of which segment they are in, to be able to realize their giving aspirations. Because I think it's key to who we are as humans that we really want to give back. And, you know, we've just launched the Giving Report very successfully recently, and that report effectively looked at the giving habits of high net worth individuals. But the reality is there are a lot of individuals that don't necessarily have the financial backing to be able to give financially, but they give up their time. And that, to me, is as important as giving financially. But effectively, what we want to be able to do is to make sure that across segments, we are able to enable our clients, even if it's just through donating their green bank backs points that they earn from on their Nedbank bank accounts back to a good cause. We want to be able to enable our clients to realize those giving aspirations and really give back. And I think as a society, if anything, the Giving Report showed us is that as South Africans, we are a giving society, which is hugely encouraging and uplifting.
Yeah, we've covered that report quite in depth on Moneyweb, so more information is available there. Tracy, thank you so much for sharing your insights. I think it's a very, very important topic. I think many people wait too long before they pay attention to it, and I think in many other families, not everyone is really informed as they should be about the structures they use. But thank you so much for sharing your insights, and hopefully a few people will approach an advisor and get this ball rolling.
Only a pleasure. Thank you, Rick.
That's Tracy Miller. She's from Nedbank Wealth Management. And unfortunately, it's the end of this session. The next session looks at cryptocurrency. It is a new landscape. It's a new asset class. Many people don't call it an asset class, but it's a reality. Many people look at it. And tune in 5 minutes, and then we will talk about cryptocurrency.
I'm Kieran Ryan, and I host the Moneyweb Crypto Podcast. The Moneyweb Crypto Podcast gives investors a window into the world of crypto that they did not have before. One of the things we do is we introduce them to the white hats in an industry that has its fair share of opportunists and scamsters. Remember, this is an unregulated area of the market, so one needs to be especially careful. If you're going to get into cryptos, and the stats suggest a high percentage of people are at least looking at it, then you need to enter with eyes wide open. So join me and my expert guests weekly on the Moneyweb Crypto Podcast on moneyweb.co.za, the Moneyweb App, Apple Podcasts, and Spotify.
The Moneyweb Crypto Podcast, hosted by Kieran Ryan. Moneyweb, your trusted source for business and investment insights.
Moneyweb Frequently Asked Questions, Part 3. The Moneyweb Insider Gold Premium Subscription.
Welcome to part 3 of the Moneyweb FAQ series. I'm Ryk van Niekerk. We received the question, what are the benefits of an Insider Gold subscription virtually every day? The short answer is that a premium Insider Gold subscription unlocks a myriad of premium data tools to assist any individual to analyze and research the performance of JSE-listed shares, unit trusts, ETFs, ETNs, commodities, exchange rates, and international indices. The historical performance of these instruments is available for up to 5 years, and the tools allow for the ranking of the indicators according to many predefined metrics. I want to highlight 2 unique and pretty cool tools. The comparison tool allows subscribers to compare the performance of multiple instruments over various periods. For example, a subscriber is able to compare the share price of a company such as Sasol with historic performances of the price of Brent crude oil, the Rand-dollar exchange rate, and the S&P 500 index, all on one graph. We also offer a dedicated page for each listed company and unit trust. They are the Click a Company and Click a Unit Trust pages. Each page contains detailed information on the historical price and financial performance of the instrument. Sign up today for just 630 Rand per year or 63 Rand per month and equip yourself to make better financial decisions. In the following video, I will highlight a few of the many other benefits of the Premium Insider Gold subscription. Go to moneyweb.co.za, the Moneyweb app, or follow Moneyweb's social media channels for more information.
Moneyweb, your trusted source for business and investment insights.
We're in the middle of a crypto winter, and it's a brutal one. Think back to November of 2021 when Bitcoin traded at $67,000 and Ethereum was close to $5,000. Those were happy days when millionaires were being minted virtually by the hour. But sadly, those days are gone. This morning, Bitcoin traded at a little over 16,500 and Ethereum at just over 1,200. And we've been some of these altcoins are down nearly 90% compared to what they were a year ago. And think back to what happened just a few weeks ago when the FTX exchange collapsed and its sister company, Alameda Research, went with it, probably the most significant crypto failure of the year. We started out with the collapse, we started out the year with the collapse of the Terra Luna stable currency, and that bled into crypto lenders like Voyager and Celsius and Three Arrows Capital. Now, for crypto enthusiasts, you may feel a little shell-shocked at all of this and wonder, where is it going to all end? Well, joining us to explore this is Paul Casserin and Brandon Topham. Paul Casserin is co-founder and CEO of Petrock Investments, which offers a range of crypto-focused investments, including a Bitcoin fund, an Ethereum fund, and a US dollar stablecoin fund. He's got a background in fintech and digital digital transformation, having previously worked with companies like Woolworths, Naspers, eBay, ShopRite, and TFG. And also joining me on my left is Brandon Topham, who's no stranger to the Moneyweb audience. He's perhaps best known as was head of enforcement at the Financial Sector Conduct Authority. He served as a member of South Africa's Parliament, as well as on the Trade and Industry, Finance, Auditor General, and Appropriations Committees. He's a qualified CA, and he's also got a background as a forensic accountant. And he's an admitted attorney, and I believe quite recently an advocate of the South African Bar. He's also a non-practicing member on the role of the Solicitors Regulation Authority of England and Wales. Most recently, he's taken up a position as CEO of Creston Forensic, focusing on crypto and regulation. Welcome to you both, Paul and Brandon.
Good to be here. Thank you, Kieran.
Okay, so let's start off with you, Paul. Are you shell-shocked by what's happened in the crypto market in the last few weeks? Is this the worst we've ever seen or we're likely to see?
Yeah. Firstly, thanks, Kieran. Thanks for having me on the show, and thanks to the audience who actually are busy watching. I think I'm more disappointed than shocked. At the beginning of the year, my colleagues just warned me about the bear market, but no one could actually predict over the last couple of months what happened to all these major crypto companies. If you think of it, FTX was one of the largest exchanges in the world. So no one could have predicted that. So it's a little bit disappointing to see. And if you look back a year ago, a number of people were, because prices were going up, a number of people were buying crypto. They believed that the prices were going to skyrocket. But now, looking back, there are worried people out there. They're worried about their funds, what's left of them. They're worried about their funds and exchanges, and they're worried about crypto market as a whole. And there are a couple of people out there just looking at the opportunity, looking at the great opportunity, and they think that the bottom is in and it's a great opportunity to buy. So people are at different places, but generally it's a worrying time.
Brandon, let's turn to you. You've been on the Moneyweb Crypto podcast a few times, and I think people will remember, those who've listened to you before, that you were quite skeptical about cryptos. And I think maybe that was shaped a little bit by your experience in cracking down on Mirror Trading International and a few other crypto scams that came out. Cryptocurrency being used as the currency for a lot of scams that came out of the woodwork. You did warn us of the risks of this. Do you feel vindicated?
Well, I think too many people have lost money, serious amounts of money, to have any self-satisfaction. But the problems that have happened recently aren't so much crypto failure, but I think regulatory failure. And I think we'll discuss that a little bit more going forward, because I mean, FTX was really a bank that wasn't licensed, and the crypto was just, for instance, the cover. And many of the scams that exist out there aren't the crypto that's the scam, it's the scam. They're just the payment mechanism is the crypto. And that's why we have to regulate the crypto environment to allow some certainty for the players.
and for the public in general.
I think that's an interesting point that you raised, because one of the arguments that has been made is exactly that FTX was operating like a bank. So you had this fractional reserve lending system where they had deposits that belonged to clients. They were on lending that and then leveraging it in exactly the same way that banks do it. And of course, that's a recipe for, if you don't have the oversight of a central bank or a bank of international settlements, you're going to get that kind of collapse eventually.
That's correct, yes. And the difference, is that to have a bank, you need three things generally in place. You need expertise of management, track record. You need to have reserves, as in your own money or shareholders' money, not depositors' money, and you need proper systems, proper banking systems. And if you look at what's going around at the moment, it looks like FTX had none of those three, and that explains why the collapse happened to an extent.
All right, Brandon, let's stay with you. So you were crucial to the recent rollout of, no doubt, what is the beginning of crypto regulations, or certainly not the end of crypto regulations. And so in future, we're going to see financial products and crypto companies, they must be licensed as financial services providers, and they've got until November of next year to do that. This comes at a time when South Africa is seen as a bit of a nursery for crypto scams like Mirror Trading International, which you were personally involved in shutting down. But it looks like, despite this, hardly a week goes by that we aren't coming across some other crypto scam coming out of the woodwork. Will these regulations help drive the scamsters out of business?
I think this is simplify crypto quickly, though. Put it in two parts. You get the crypto or the product provider, the crypto itself, the Bitcoin, the Ethereum, all the various stablecoins, the thousands of other currencies or assets out there. All right. That's a completely other problem that's not going to be solved overnight. But the second part, the middleman, the intermediary, the advisor, that's where regulation right now is focused on, and that's the starting point to crack down on the problems. If you want to invest in anything, you want to make sure that the person you're giving the money to, the person giving you the advice, knows what he's talking about, is not going to run off with your money. The fact that the products you're going to be advised onto are not regulated, that's a completely different story for now. But yes, in the long run, regulation will make the crypto environment much safer for everybody in it. It will still be a volatile market. You'll still have to be extremely brave to venture into that, and that's why you need to use experts. Most of crypto trading now is derivatives. I don't understand the first thing about derivatives. Okay, I understand the first thing about derivatives, but not the second thing. And very few people do, and that's why you need experts that have the experience that can help you make sure that when you put in your hard-earned money at risk, at least there's some intelligence besides your feeling that the market's going to go up or down.
All right, and I think before we came onto the show, you were telling me that you do actually invest in cryptos now. Last time we spoke, you were not an investor.
Well, no, I as publicly said I wouldn't buy a crypto, but I believe there are a couple of billion people in the world, and they are rather gullible, and they're going to keep buying, so I may as well gamble with the rest of the world to a very, very small percentage. If I was a serious investor, I would have to give it to a proper management firm. There's one sitting on your right, for instance, that could assist you. Rather than me. I'm just long-term speculating.
So just a following question from that. If you've been buying crypto, have you been dollar cost averaging down as the price has been going down?
Yeah, I'm an accountant. When the price falls, I'm looking at it with a little bit more interest, yes.
Okay. All right, Paul. I don't know if you saw this week that emerging market expert Mark Mobius reckoned that, was warning actually, that Bitcoin could go down to $10,000. This morning it's at $16,500. That's a long way from the $67,000 it was in November of last year. Are you a bit worried that there's more bad news to come out of the woodwork and the flight from risk has still got some distance to go?
Yeah, Kieran. I think, first of all, the one thing is for certain, no one can predict the top and the bottom of the crypto markets. Absolutely. That's one thing. I think my son, my 15-year-old son, predicted the top of the market last year. But I think in general, you can't predict the market, especially in crypto. Mark actually is also famous for saying that what goes down will generally come up. And you just have to show a little patience and not hit the panic button. So I think over the last week, we've watched Bitcoin miners specifically start dumping some of their stocks, some of their Bitcoin, just to stay afloat. So that is one of the indications that the market is kind of looking at, like a bottom, but no one can predict anything. So absolutely, I'm not there to do that. I think as crypto as a whole, as a market, I think people are really nervous, and we've taken a long-term view. So if you look at crypto, it's actually part of blockchain technologies. And we fundamentally, our investment thesis is based on the blockchain technologies and what they can do for the world, for people, for different industries, including financial services. So if you take that long-term view, the investment thesis in the technology is pretty solid. So we don't look at the price of Bitcoin, but we take that longer-term view. And what is really concerning, though, for us is to look at our customers of exchanges right now, because internationally, many people took their money off exchanges because of FTX, and now people are worried. So we've actually been in discussion with two very, very large exchanges in South Africa, and the one exchange would like to keep their customers' coins on the exchange, and they're showing the proof of reserves on their home screen and just trying to settle the market down, which makes a hell of a lot of sense. The other exchange that we're talking to, they have come out and recommended that their customers don't leave their coins on the exchange. So they're two different views, and if you're out there and you would like to actually take hold of your coins, if you'd like to take self-custody of your coins, the same thing that a lot of people overseas are doing, you have to learn how to do self-custody. So what that means is you have to set up your own wallet and you have to transfer your coins off an exchange into your wallet. So I brought a couple of gadgets I'd like to show you. I hope you don't mind. Sure. But they're super interesting and they're quite unique. So they're great for Christmas presents, if you are keen.
And do you sell them, or these are just... Did you buy these from somewhere else?
I don't sell them. I actually bought them online. You can't buy them from an exchange either, definitely not. And what you can do is, I've got three here, and they're three hardware wallets. I don't know if you can see a picture of it at the back of us, but I'd like to show you the first one. So this is called a Ledger. It's a hardware wallet. It's a super useful thing. It looks like a memory stick. Now, what it does, it stores your private keys. So when you want to remove your coins from an exchange, you open up a wallet, and you will get a seed phrase. Now, your wallet is protected by private keys, and what you can do is you can actually store your private keys on one of these hardware devices. So it's an extra level of security. So every time you want to transact with your coins, you actually need this device, and it's got a little pin on it. So you can lose your pin. It's kind of like a cell phone. You try it too many times, it goes dead. And they're quite expensive. It's about 3,000 Rand, 1,000 to 3,000 Rand. Good Christmas present, the 1,000 Rand one, I think, for Christmas.
What's the brand?
This one is called a Ledger, and there's a couple of brands out there. There's a Trezor and a Ledger. We don't recommend either, but I personally own a Ledger. And then there's two other examples. Now, just as I said, as a client and you would like to actually own your own crypto, you have a wallet. When you open a wallet, they'll give you a seed phrase. Now, the seed phrase is 12 words or 24 words. It depends on the wallet. And then you have to store that seed phrase somewhere. So it can't be under your pillow. You have two products. Hardware.
It can't be digital. Don't put it on your computer.
Well, yeah, not digital, and don't text it to someone. You have to be super careful. Once someone has your seed phrase, they've actually stolen your coins. So it's quite risky.
I think we've got a couple of pictures of that. Can we call up those
here's
pictures?
Here's an example of a hardware wallet that stores seed phrases. If you have little kids in the house, it's just keep it away from them because it's actually fun to play with. And if the letters fall out, you also lose your phrase. There we go. And this one is a cylinder. It's a crypto steel wallet. So you can open it, and inside is your seed phrase. So here's some examples of how to store a seed phrase in case your house burns
Just
down.
explain on that cylinder there, because that looks like a cigar case.
Yeah.
How would you enter the seed phrase on that?
So what happens is you have to open it, and there are a number of little discs that you put on. words, and then you use a pencil to identify what the seed phrase is. So it's quite difficult, it's quite tricky, but it's kind of fun and it's quite cool. Then you have to store these and you have to make backups of these, because once you lose this, you lose all your money. And because we're all South Africans, there are other risks associated with this. And so you just have to be super safe, super careful. And why am I showing
you mean the risk
this?
of somebody pointing a gun at you and saying, "What's your seed phrase?" to go try and get their hands on the crypto?
Exact. Well, ironically, you are the worst person, not you, Kieran, but the investor is probably the worst risk out there, because you send your coins to the wrong address, you lose one of these things, you forget where you wrote it and you put it, or you store it somewhere, you give it to someone, or someone steals it from your house. So the investor is ironically one of the big risks. So this is one of the reasons why we started Petrock, just to mitigate all these things, all these devices and all these issues and the pressures and the risks and the counterparty risks that come with exchanges. And we want people to actually start considering, including yourself, Brandon, crypto as more of a longer term investment. And when you start looking at crypto as an investment, then you have to start worrying about things, because it's a lot of money and you don't want to lose it.
Just before we go into Brandon, if you want to send any questions to either Paul or Brandon, send them to events@moneyweb.coza, or just go onto the YouTube channel and in the chat box there, send your questions and they'll come through to us here in the studio. Okay, Brandon, let's turn to you for a minute. Okay, in the intro I said that you were formerly with the FSCA, the Financial Sector Conduct Authority. So you're no longer there. Your new venture is CEO of Creston Forensics. Never heard of that before, but your focus is on cryptos and on regulation. I'm a bit surprised because I remember you as a crypto skeptic. So tell me about Creston and what services it provides.
Well, Creston is just an accounting firm like Deloitte or PwC, except they're number 1 and 2, and Creston's number 13 in the world. So this is a much smaller player, but it's a niche market, which allows me to advise my clients who effectively are in the crypto space, how to comply with the coming regulation, how to make their businesses a lot safer, etc. And I personally believe that self-regulation is a starting point in this industry. Unfortunately, many of the players right now in South Africa want to wait for regulations to come out, and I believe that that's just going to hurt them in the long run, because all that's going to happen is that you're going to have regulations that are so strict that you probably have to be a bank to almost play in this market. And somewhere between no regulations and too much regulation, we have to find a balance. So that's one of the jobs that I've got at the moment. And also, all the frauds that are taking place very often do involve crypto, and it's a very specialist area that I know nothing about, effectively. I pretend to know a lot, most people do, but it's an area that is so diverse that no person can really understand, and you have to have a very wide range of team, people that know cybersecurity and that understand the crypto world very, very well to be able to unravel a fraud properly, and that's what we are going to do at this company.
I was contacted just this week by somebody who was saying that did you know, he said, that financial advisors can right now give advice to their clients on cryptos. And I was a bit surprised by that too. Is that true?
Well, because the regulations only kick in next year, therefore it's still in no man's land. So I can give you advice on crypto. Anybody can give you advice on crypto.
Okay.
Whether it's good advice is another thing. And that's part of the process which is coming out with the regulations that we publish or for discussion, etc., is what level of experience must an advisor have to be licensed to give you advice. And that's where the inputs of the sector need to come in. I mean, the regulators understand traditional financial advice. But what really excites me about the crypto space is not the crypto assets, as we see them primarily now, but what's going to come from this, the decentralized finance, the smart contracts. That's the future, I believe, of the financial sector to a very large extent. You know, if you look at the banks and insurance companies today, they all have multiple accounting systems or information systems that are written in different periods of time, sort of talk to each other, etc. I believe that in the long run they will be replaced with blockchain type of record keeping, etc. So that's why people need to have an input at this early phase into what level of experience is required to give advice on some of the really complicated financial instruments which are still going to be developed and which I don't believe people even dreamed about yet.
Right. There was a question I wanted to ask you about the regulations. I take it this is the start and that there is going to be more comprehensive regulation. I mean, people maybe not understand that in terms of the Reserve Bank Act, that does cover crypto, because any transfer of an asset outside the country is governed by the act or the regulations that underpin it. So I presume there's going to be more regulations around crypto.
There definitely will be, and there's a bill in Parliament at the moment, I believe it's about to be signed, that's going to make it compulsory for crypto asset service providers to actually comply with anti-money laundering requirements with the Financial Intelligence Center, etc. Many of them are doing it voluntarily at the moment, but it's about to become law. Definitely a lot more, I believe a lot more Reserve Bank rules are going to come out or more directly with these crypto asset providers as to how to allow or to facilitate the transfer of wealth out of the country. At the moment, it's covered, but not everybody is complying with the law, I don't believe, and we're going to have to do that. One of the unique things in South Africa is we have control of our foreign reserves as such, restrictions, which is unlike other countries. The other area, also is the payment side. At the moment, people will argue that crypto is a payments mechanism, all right? And some will say it's ineffective, and others will say it's just not fast enough and efficient enough. But going forward, you're going to have crypto stable coins that are going to be super fast and super efficient. They will be able to create gateways into unbanked markets of the world. And that's also going to hit squarely with the regulatory environment of the PA and the Reserve Bank.
Right, okay. I think one of the stable coins, just for people who may not know what that is an asset which is backed usually by a fiat currency like the US dollar or the rand, but it's a facsimile of the dollar. It isn't a real dollar or it isn't a real rand. But it can be, you can use it for payments. It's recognized pretty much all over the world, and you can complete that transaction in seconds rather than doing an international transfer through the SWIFT system, which could take days. Which is a very interesting use of blockchain technology, is it not?
Yeah, but I still prefer Visa and MasterCard personally, but I think as we go forward in time and as the banks, and I believe banks are going to become far more involved in the crypto space, that you'll be swiping, you can pay with a crypto asset or a stable coin or not. It's really going to be about the mechanism to deploy and whether the vendor is able to accept it or not. But yes, stable coins are very interesting and I believe the most important part of the future of the crypto world.
Okay, Paul, let's turn back to you. One of the trends that we are seeing in the last few weeks, particularly since the collapse of the FTX exchange, is that people are removing their coins from exchanges. Now, they're doing that because they're afraid, because what they discovered to their shock and horror was that FTX was on-lending their crypto without their permission to a sister company, and that sister company was taking massive and risky bets with their coins. All of this raises the question is, where does decentralized finance and decentralized exchanges fit into that? Because the interesting thing, and this maybe needs a little bit of explanation if you can for a minute, what is a decentralized exchange? What is decentralized finance as opposed to a centralized exchange, FTX being a centralized exchange?
Yeah, that's a great question, because what we saw over the last couple of months is the failure of centralized exchanges, centralized finance, at least in the crypto sphere. One of the examples was FTX. Now, decentralized finance is actually something that is not centralized through its definition, and it's actually programmatically done on the blockchain. So, for example, there are decentralized exchanges, and what we do, for example, is we can put our coins on a decentralized exchange, and you can swap coins, you can provide liquidity on the exchanges, and you can actually trade on those exchanges. And there's no one there to actually do to facilitate any of those trades. It's pure code that's written on the blockchain. So that code is written in smart contracts, and the underlying one of the dominant underlying operating systems of the decentralized exchange is Ethereum. And the Ethereum was actually born because of the ability to actually programmatically write specific code that actually you could transact with, and there are a whole lot of rules around it. So decentralized finance, they don't use centralized actors, they don't use any centralized companies, and it's pure code. Now, that might sound frightening, but if you look over the last 12 months, specifically over the bear market and the collapse of centralized finances, there was very little to no collapse of the decentralized finance applications running on the blockchain. So,
and the reason for that is because nobody has the power to be able to misuse your tokens. There's no counterparty risk on a decentralized exchange.
Yeah, there still is counterparty risk, but there's no one in the back behind the curtain taking your money and putting it in a pocket and doing something else with it. The code is the code, and you can actually see it. So you can actually go use a browser. You can go and inspect the code. So if you are code literate, if you're an engineer, you can actually go look into a decentralized exchange, for example. You can go into a smart contract, and you can go and inspect the code. That code is also audited by third-party providers. So that's audited code. It sits there. It's available to engineers to look at. It's available to people to inspect. And it operates as expected. So there's no one behind the curtain, takes your money, goes off on holiday or to the Bahamas, and it's actually pure code. That's why decentralized finance actually works extremely well. However, what we've seen is we think that's the combination between the good things in the centralized finance, because we still need KYC, we still need AML that Brendan was talking about, we still need strong regulations. We've seen now the benefits and the necessity of regulations, but if we can marry the benefits of decentralized finance with the benefits of centralized finance, we got to get a deal. And that's where I think the world is shifting towards. So it's not one or the other, it's going to be a combination of both, just using blockchain technologies.
Okay, just a reminder, if you want to send questions, send it to events@moneyweb.coza, or if you're on YouTube, go to the chat box, put in your question there, and it'll get sent through to us. Okay, so we've got a question here for Paul. How would investing in Petrock Investments be less risky than FTX and Celsius? In other words, what are your chances of failure?
Yeah, a great question. I don't know who it's from. I would love, oh, there.
It says Heloise.
Heloise. Thanks, Heloise. That's a really good question, because if you think about it, there are a number of South Africans that were caught out with FTX. Absolutely, I know one or two of folk who actually had money in FTX and it went into bankruptcy. They actually lost their money. And same with Celsius. So a lot of South Africans.
We're not certain yet that they've lost their money, right, with FTX?
No, they've gone into bankruptcy. So both Celsius and FTX have filed for Chapter 11, and they go into bankruptcy, and you're going to get a portion of your dollar back. Right. So you're going to get maybe all your money back, or some of your money back. Thanks, Brandon. But hopefully you get a good portion back. Now, Celsius and FTX are two different business models. So one is a lending business model, which is Celsius. Now, Celsius was actually an unsecured loan that you were making. You were giving your coins over to Celsius. It was an unsecured loan that you were giving to Celsius. Celsius were taking your coins, and they could do what they liked with it. Actually, if you look at the proceedings in the bankruptcy case, they've actually taken ownership of it, and they've told the judge that they actually own the coins. They are just unsecured loans back to customers. So this isn't banking and regulation talk. This is just a pure unsecured loan to a company, which is fundamentally an issue with Celsius. If you look at FTX, now there were a number of bad actors behind the curtain, and because of the lack of regulations, like Brandon was saying, FTX got away with a lot of things that we are still uncovering, and there's going to be a ripple effect across the market. But a lack of regulation, bad actors, and the company was using customers' funds, customers' money, to actually go do other things with it. So fundamentally wrong. At Petroc Investments, we have actually seen this, and we spent about a year or so looking at what the best way to do it is. And actually what we did is we just copied fund structures, what customers would expect out of funds. So what we're really sure about is that if you are a long-term investor, and if you don't want to trade and speculate and worry about coins and wallets and things like that, you need to actually place your money in a fund. Now, the way we set up funds are just the way folk normally are used to funds in South Africa. So funds are totally separate, separate legal structures, legal entities. And as a fund manager, we make sure that the funds themselves come through the bank into the fund structure, and they are the coins are purchased and kept in safe custody. And if we do mine for yield, all the benefits go back to the fund. So no one touches that fund, and the fund is open and available to customers. And a third party and a fund administrator every month comes and makes sure that all the coins and the net asset value of the fund is intact, and they report independently back to customers. So you can just see all the checks and balances are there. It's nothing new. So Petroc Investments, we didn't invent this stuff. We just took and borrowed all the best practices from the great funds that we already have in the country, and we followed that practice. So you can see that's fundamentally different to an exchange that went bad, which is FTX, the example, and also the lending practices of the other companies that take your crypto as unsecured loans. Great yield that you can get with unsecured loans to companies. So if you do see the opportunity in the markets that someone offers you fantastic yield for your coins, you must ask twice, you must read the T's and C's and start worrying, when I give you the coins, is it an actual loan that I'm giving you? What are you doing with those coins? What are you doing with the money? Are you actually doing something behind the scenes with it? Am I going to get my money back? And these are the issues. So if it's too good to be true, it's probably stay away from it.
Let me just add, you are a registered financial service provider as well, are you not?
Yes, thank you.
Thank you. So there you
I'm
go.
so sorry.
Part of the answer.
That was the other very, very big important thing. It took us a while to actually establish ourselves as a regulated service provider, and we take it extremely serious. So we have a key individual in our team who's absolutely, he comes from a bank, he's highly regulated after 20 years being in a bank, and he helps us through our processes. So we have that robustness built into our operating system, if I can say that, and our fund flow. And we really care about this independence. So that's what's different between maybe a fund and a company that takes crypto loans, and unregulated exchange with some bad actors behind it.
I think one of the points I just want to emphasize that you're making there is that, so you've brought in, proof of reserves is part of the baseline reporting, which is going to be expected for crypto companies going forward, right? So you're going to have to be able to show, we say that we've got this amount of crypto, and the auditor independently verifies that that is what we've got. What you've done is you've taken something which is commonplace in the traditional financial sector, where an independent administrator would go through and he would communicate directly, or she would communicate directly with the clients and say, yes, the fund has these stocks or bonds on your behalf. And it's not the fund manager saying it, it's the independent administrator doing it.
Yes.
You're applying that same best practice to the crypto space, correct?
Same principle. And the proof of reserves is just the beginning of starting to count the assets behind the curtain, if I can put it that way again. But that doesn't make an exchange a bank. I mean, Brandon alluded to it. He called an exchange a bank, but then he also said, wait a minute, they don't operate like a bank, and they don't have the same regulations as a bank. So just looking at proof of reserves is just a one-dimensional factor of looking at the governance that an exchange needs to actually operate like a bank. So even a proof of reserves is just like a single dimension, it's just like counting all the assets, but it doesn't count the liabilities. So you don't know if you borrowed against the assets, you don't know what's going on in there. And that's where the complication lies.
Okay. Brandon, you got a question here. Did you want to say something?
I want to clarify something there. An exchange may not look like a bank if it just creates the market, the opportunity for buyers and sellers to come together. But when that exchange starts to hold the money, the crypto, and when the exchanges start to on-lend it, and FTX is not the only one doing that. There are people in South Africa on-lending the money. And when they start to do derivative trading on that, that's when you start to cross the lines, and that's why the need is for regulations to make sure people stay in their lanes and they have the correct security. Cyber security is the next fundamental step. If you don't have the right systems in place, and you're going to have a problem.
Okay, a question for you, Brandon, from Tapi. What are the main concerns from a South African regulatory perspective around crypto assets?
Firstly, they're not even looking, the regulators aren't even looking at regulating crypto assets, because that's something that may not be able to be regulated. Then the first problem links to the first one in the fact that there are let's call it two main crypto assets in the world today, which has very fundamental issues what's underneath it. So that's part of the problem, that you've got a dominance. But the reality is that crypto assets is far greater than those two predominant assets. And that's where the future is. And these two predominant assets is taking up everybody's attention, but we're not thinking about where the raising of funds for your company in the future is going to come in. So that would be in South Africa. The CIPC would regulate that in terms of a prospectus, which I don't even know whether they're even considering at this point in time. I'm sure they are, but how do you raise funds using a coin, a token, linked to a profit share in your company? So that leads me to effectively the second problem, is that it crosses so many regulatory departments. It affects, for instance, the Department of Trade and Industry, it affects the Finance Ministry, and as you start to get clever with a stable coin that has barrels of oil linked to it. One coin represents a barrel of crude oil, etc. There's so many other complications.
It's a derivative then?
Well, no, that would still be a stable coin, because linked to the coin would be a fundamental asset, in my opinion. Okay, but when you start to link a coin to a potential barrel of coin, or the price of the barrel of oil, that's when you start to play the derivative markets. It's my first step knowledge of derivatives. Okay. So because it crosses multiple, even just in the financial side, you've got the Financial Intelligence Center, you've got the Reserve Bank, you've got the Prudential Authority, you have SARS, has got an interest, and of course you have the FSCA. They would be your predominant players at the moment. So getting them all to talk together and work together takes time. So that's the issue. Time is your
and I think we mentioned this point earlier, that there are already laws under which cryptos fall. For example, if you're making profits from cryptos, in terms of the Income Tax Act, you're going to have to pay your share to the taxman. If you're transferring money out of the country, in terms of the Reserve Bank Act, that's also covered there.
But that's where you've got a more principle base. But effectively, FTX, for instance, in South Africa, we would have gotten away with it, because they took deposits from the public, but the definition in the bank state of a deposit involves money, so they weren't a bank. So if they were operating in South Africa, they wouldn't have been covered. So where you've got a principle, regulating something is much easier, but when you've got fundamental definitions, it's a little bit more difficult.
Paul, can we come back to you? I want to talk about some research that you did, which is very interesting research into financial advisors in South Africa, and they can now include crypto in their portfolio of investment products. So that's quite a breakthrough, because regulations are coming. So you are working with advisors to assist their clients. Tell us about this research. What were the key discoveries, and what's the reaction generally been of financial advisors to cryptos?
What we found, Kieran, is that First of all, we did the research before the regulations hit. So before the 19th of October, we actually conducted our research. I think it was around the month of August. It was around 2 months. And we asked an independent research body in Johannesburg to actually conduct the research for us. They reached out to about 5,000 folk, and we had a super response rate. And what surprised us is that a huge portion of financial advisors were actually buying crypto. I think it was around 66%. It was in the 60s. And also their clients, they actually said that their clients also buying cryptos, but they weren't speaking to each other. So that was the number one thing. It kind of made sense because that makes logical sense. What is really intriguing for us is that the financial advisors also said that over the next 12 months, 72% of financial advisors said they are planning to allocate crypto into client investment portfolios, which made us super excited because if the advisor and the client actually get together and start looking at cryptos as an allocation into their investment portfolio, then it's a different story. Then it's not just a DIY buying it yourself on an exchange on your phone. It's talking about crypto in a sensible way, talking about the risks, talking about the potential upside and downside of cryptos and how it should fit into an investment portfolio. Because we in our team, we think that it should be part of an investment, but it should be a small allocation into cryptos because of the volatility and the nature of crypto assets. They are volatile. We understand the nature of the category, and we recommend a small allocation. But you can only do that when you are actually having this discussion with financial advisors. So that was really comforting for us to see that there was a very positive view on crypto in terms of financial advisors and their attitudes towards crypto.
And were they educated in cryptos? Did they know what they were talking about?
There were diverse views again. What was so interesting because their source of education was from YouTube. So this is a good thing and a bad thing. I mean, YouTube is phenomenal, but it also comes with some of its entertainment, some of it's not financial advice, other is just pure nonsense. So it's a little bit dangerous. And what we also found, though, through deep discussions with some advisors, is they know a lot about crypto. They've been in it for a while. They've been trading with crypto. They fundamentally understand it in their own personal capacity without the advice. So there are generally different folk in the market, and some folk just won't touch it, which is also understandable, totally understandable. So we saw this diverse view coming out of the research.
So as low as cryptos have gone this year, the good news is that financial advisors are really about to kick this into a whole higher gear, right?
Yeah, we hope so. The thing about, so what we saw a year ago is a lot of people actually speculated, and super simple to buy crypto. You just need a phone and some cash, and off you go. You can start buying crypto. But now, what we are going for in our investment thesis is that if you'd like to invest in blockchain technologies, if you'd like to invest in cryptocurrencies, then take a longer term view. Have a discussion with your financial advisor, and do something that actually makes sense. So it doesn't break the bank, and do something that makes sense for your overall portfolio and what it can do for that. So that is a long-term view into investments in blockchain technologies. Now, also our view on blockchain technologies is super interesting because it means a lot to a lot of people. So we've taken 3 different sort of themes to blockchain technology.
Before you go there, just explain, break it down. Why is blockchain such a breakthrough?
I was going to break it up into areas because there's so many things to talk about. It's not, again, it's not one-dimensional. And it's phenomenal for us. And it seems so simple because it's just a decentralized database, right? But actually, when you start unpacking that and seeing the benefits thereof, it's actually phenomenal. So let me just go through three examples. And they actually relate to our funds in a way. The first one is the future of money, which is actually a lot to do with Bitcoin. So Bitcoin was the original cryptocurrency, and it's quite unique and it's dominant in the market. I think Brandon was alluding to that now. So it takes up 40% of the total market value. It's just one cryptocurrency. Now, there are over 20,000 cryptocurrencies, as Brandon was starting to talk about. And so Bitcoin as a whole is quite phenomenal. It's the original way to transfer money, and it's the original methodology of digital payments. So Bitcoin is going to be the front runner for digital money. It's absolutely phenomenal. So hence our Bitcoin fund. So that's the future of money. Then there's the future of finance. I think you're starting to talk about that with DeFi and decentralized finance. That's what we are super excited about, because all the aspects of blockchain technology make the entire financial services market rethink all their processes, because the things that come with blockchain technologies is actually quite revolutionary. For example, decentralized finance. And the ability to actually do a lot of the financial transactions without central players. So underlying to that is Ethereum, which is the actual operating system that allows people to program on it, write applications on top of the blockchain, smart contracts, which actually have all the rules in place for the future of finance. So there's a huge part for Ethereum to actually play and to revolutionize the world of financing, and blockchain will actually disband right across a whole lot of industries. So the future is phenomenal. A simple example is provenance, which because every transaction is recorded on the blockchain, you can actually follow a transaction right to its beginning. So can you imagine just picking out something in a grocery store? You know, you can follow that. If that was recorded on the blockchain and where it came from, you could follow it right back to the farm. So the blockchain can work in financial services, but in a whole lot of different other areas. And the third part that really excites us is the future of the internet and the web that we know it. So that might sound a bit theoretical, and it's still early days, but if you look at the web now, what's scary is that one person in Silicon Valley can actually turn off Google for you. So can you imagine a day without Google? You know, no searches, probably no email from you, Kieran. And but if you had an Android phone like you do, your phone would be a brick. So there are centralized companies right now that control a huge portion of the internet. So it's the same with social, you know. One person...
Well, there's just an example of that. Pre-search, for example, is a blockchain-based search engine where you cannot fiddle with the results, and it's very good. So we've just been talking about, you know, the problem that you have with centralized exchanges and centralized control of anything, including your search engine like Google does, and you have now and possibly the future of search engines. It's going to be fantastic what's coming.
Yeah, it's crazy because, as Brandon said, we don't know what's going to happen next. But from an investment thesis, we have a long-term thesis on the future of blockchain technology, and we believe in that. And hence our funds and hence our long-term view. So it's not speculation anymore. We think the future is bright. We don't know what it's going to look like, but it is phenomenal.
All right, just a reminder, if you've got any questions, send them into events@moneyweb.co.za, or if you're watching on YouTube, go into the chat box there, send the question through, and we'll direct them either at Paul or Brandon. Brandon, I want to turn to you. Do you see a serious role for cryptos in the financial sector, or is it going to remain peripheral for those who are looking for a bit of an adrenaline dump?
The accountants, the economists, the businessmen hate to come to this conclusion, but effectively the crypto technology is yet to stay. I'm not certain about some of the crypto assets. Some of them may not be around, But the technology behind them is definitely going to be in the future, and the decentralized finance, the smart contracts, and what you do with it in the future is going to play a major role in the financial sector as a whole. And then also is going to make access to the market, once we find the rules. I said earlier that it's very difficult to regulate the crypto itself, but for instance, certain stablecoins will be easily regulatable in the long run. Decentralized exchanges and things like that may not be easy to regulate, because who are you going to regulate? So you'll end up with regulations that will apply more to the centralized people, and then decentralized will probably be outside there. But they'll have a role to play, and maybe a very important role to play. But yes, the answer to your question is I think it's here to stay. The fact that some of the biggest funds in the world are invested in it, either because we don't want to be left out and the fear of losing out, and until this year, nobody was ever wrong for investing in the major crypto assets. But now people are starting to reconsider, and hopefully a more conservative approach and a rational approach will take place in the investment world in the future.
Well, I think more than 50% of Bitcoin holders are now underwater. So you were right. Up until a few months ago, it was the case that it doesn't matter where you bought, you were pretty much guaranteed to be in profits. Okay, Paul, we are getting a little bit short of time here, so I've got a few questions to rattle through. Why would one invest in your Bitcoin fund or your Ethereum fund? I mean, can I not go to Luna or Altcoin Trader or Vala and buy Bitcoin myself and self-custody it? Well, what's the value that you're adding in your Bitcoin fund and your Ethereum fund?
Yeah, absolutely, Kieran. I mean, someone can go and they can definitely go onto an exchange and they can purchase crypto themselves. As I said, they just need a phone and some money, and off they go. But if someone wants to invest in blockchain technologies, they want to take a long-term view, and it's actually quite a significant investment on their side. So it's something that they can afford to lose. And what our clients come to us, they don't want to worry about wallets. They don't want to worry about the counterparty risks and all the other things that come with storing seed phrases and things like that. They want an investment that's very similar to what they already have in terms of their investment portfolio. And they're looking to invest in crypto just like their other investments. So they come to us for that, and that's what we offer. That we also, our funds are, as I said before, they are set up in terms of a traditional fund structure. So we have a fund administrator that reports back to clients to let them know where their assets are and what their yield is that they're making on the assets, and what their balances are. So it runs like a fund. It's for long-term investors who are interested in blockchain technology investments and see a long-term view for it, and see a major upside. So that's what our funds are set up for. We've actually lately we've been really helping customers actually get off exchanges and move their cryptos into our funds. So that's been a very recent thing for us to actually just comprehend, just to help existing crypto exchange customers just to move their cryptos out of exchanges and into funds. So that's quite a new thing for us. But you can see that fundamentally there are two different things here. The one is long-term investment opportunity, which is in blockchain technologies, and the other one is definitely has its place as well.
Okay. Can I come in there? Sorry.
Yes.
Do you own shares directly in the stock exchange yourself, Kieran?
No.
Do you own shares directly in the stock exchange yourself?
No.
Do you have CIS, Collective Investment Scheme?
Yes.
Do you? All right. That's a fundamental principle. You don't invest in something you don't understand. Because what people don't understand is that there's not one Bitcoin market in the world. There's not one exchange. There's not one price. There's prices all over the world. They don't understand what the miners are doing in that country or that country. They don't understand the sentiment around various things. So you'd be a fool. You can play around a little bit for the fun of it, a little bit of money, to put your money directly in the stock exchange. You go through fund managers that understand the industry, that understand the sector. Same with any form of investment. This is why it's got to be regulated, is that if you want to be a longer-term player, not a gambler, not a speculator, then you should allow people that sort of understand the whole industry. They'll get it wrong from time to time, probably more often than not, but they can get it right more often than you as the man in the street that doesn't know anything really. You think you know about Bitcoin. And all the youngsters that come to me and tell me they're forex traders or they're crypto traders, etc., they know more than gamblers because they really don't understand the market, and you don't understand the market no matter how clever you think you are when it comes to Bitcoin. There's probably very few people that know it, and even then you need a team of people with different knowledges of any market, be it crypto, be it commodities, be it shares, whatever form of asset class. And this is just one asset class. A highly speculative, risky asset class, but it's still an asset class.
What about stable coins? Okay, talk about that, because that has been the big surprise in the big growth market within crypto, where you've got Tether, you've got USDC, you've got, not Binance Coin, Binance USD. These are stable coins backed by the US dollars, and I think of the, you've got 3 US dollar backed stable coins in the top 10 in terms of market cap. Do these have a future?
For certain, provided they have the actual dollar behind them. Okay, that's where it comes to proof of reserves. They must be audited. There should be an audit certificate published monthly by the audit firms. There should be proper rules in place that the regulators put into place that say this is what we expect from the fund to publish, etc. So that is the thing about crypto is it makes it easy to get into the market, effectively. It's much easier to go and buy a crypto which has a backing of Standard Bank shares, for instance. All right, maybe that's a bad example because it's easy to buy shares in South Africa. But let's say a barrel of oil. I don't know when last you bought a barrel of oil, but it's not easy to buy a barrel of oil or something else, effectively. And that's where the stable coin. And also linked to stable coins in the future is going to be things like, well, it's already happening, a timeshare. You buy a right to use an asset or part of an asset. And we're not even in the non-fungible tokens section yet. So yes, stable coins in my mind is what gives crypto credibility. What gives it a lack of credibility are those other coins that we're not going to mention now.
Okay, so we just got a couple of minutes left, and we haven't even touched on non-fungible tokens, which is really a way to make digital assets scarce and to make them tradable. We'll leave that for another day. I want to get to a final question for you, Paul. Somebody who's just getting into crypto for the first time, what should they do? Should they go to Petrock Investments, or should they go somewhere and just buy some Bitcoin, or should they avoid it altogether?
Wow, Kieran, I think it depends. We actually encourage people to go and purchase some crypto on an exchange, on a local exchange, using their phone, and see how easy it is, because then they actually feel they get a feeling for the actual coins that they're purchasing. If someone wants to take a long-term investment, then it's a different story. Then it's a lot of money, and you have to be very careful. And that's when we encourage people out there to actually speak to their financial advisors firstly, absolutely. Because then you'll get probably a good, insightful, independent view. And then at least, you don't have to always listen to your financial advisor, but at least they make sense. You know, they're going to cover the risks, and they're going to speak about your investment portfolio and how much to spend, and how to actually make sure that you don't actually take too many risks in terms of your overall portfolio and your savings, which are super important.
What if your financial advisor knows nothing about crypto? You wouldn't go to him for advice?
Well, first of all, your financial advisor should know something about money, and should know something about speculation and the risks associated with that. They may not know everything about crypto. We actually encourage both financial advisors and clients out there. We have a website, petrockinvest.com, and people are welcome to actually come online, subscribe. We have a cool monthly newsletter we're launching next month, and we have a lot of information there for financial advisors specifically, legal structures, tax advice, and things like that. Just some guidance, and a lot of info on our website. But it is a difficult and complex discussion. I think that's what you're alluding to. You know, it's not a simple thing. and people must just be wary.
All right, we are going to leave it there. Thank you very much, Paul Kasserin. Brandon Topham, great discussion on cryptos.
Thanks, Kieran.
African Bank released its annual results earlier today. CEO Kennedy Bungani will be joining us to talk through the financials. Tune into the SAFM Market Update tonight from 6 to 7 p.m. as we unpack the day's business and investment news. You can live stream and download the latest podcasts on moneyweb.coza or via the app. Brought to you by APSA, the bravery to imagine. That's Africanacity.
Moneyweb, your trusted source for business and investment insights.
That South Africa has myriad problems on all fronts, I think, is a given. Criticism, grandstanding, and point scoring really is a national sport. Noise is, though, the essence of democracy. But the time has also come for us to collegially and with level heads start to look for real solutions from all sectors of society. And that is the idea, the premise behind Moneyweb's new podcast series. It's called Fix SA. I'm Jeremy Maggs, and I've been in the business of talking to and interviewing people for years and years. And this podcast is going to offer tough conversations around South Africa's national problems, spanning service delivery, governance, social cohesion, and the economy, and a whole lot more. But here's the difference. Our intention is to interrogate creative ideas and workable solutions on how South Africans can navigate and ultimately solve problems, drawing on the insights of South Africa's top business leaders. Starting in early November, you can download episodes every second Friday on moneyweb.co.za, the Moneyweb App, Apple Podcasts and Spotify, or follow Moneyweb News on social media for more updates. I'm really looking forward to you being part of Fix SA. Moneyweb, your trusted source for business and investment insights.
He's going back to himself.
Conference, I think it has been an absolute blast. I think many fantastic insights have been shared with us today. My highlight was Rihanna Khan, who said, make volatility your friend. And I'm one of those people who, when I get my statement at the end of the month, my investment statement, and there's a red number, I really hate it. But I think there are strategies you can follow to make volatility your friend and to seize opportunities. I would love to hear feedback from everyone regarding today's session. Please send your comments to events@moneyweb.co.za and tell us, what did you think of the conference? What topics do you think we should address in future conferences? And we will definitely discuss those. Thank you so much for joining, and watch out for March next year. Then we will host the third Better Investor Conference.